Day one was all about setting the stage. Today is in fact about turning insights into action. We've got bigger voices, bigger ideas, and the kind of energy that can truly shape what comes next for the India's growth story. All that happening right here inside this hall. So I'd like to once again urge each and every one of you to settle in, but continue staying curious, because today we're not just talking about the future, we're actually coming together to build it. With that, before we march ahead and deep dive into the sessions that are about to unfold over here, I'd like to firstly invite on stage Alokesh Bhattacharya, Deputy Managing Editor, Mint, to take us through what day one looked like and what will day two be like for us all. So let's have an energetic round of applause. Please help me welcome Alokesh Bhattacharya.
Thank you, Kavya. Good morning. Nice to see a full hall right in the morning. Welcome, everyone, to day two of the Mint India Investment Summit and Awards 2026, presented by JSA and powered by SAIL Industries. We had an incredible start, like Kavya was saying yesterday. It was a fantastic day. We had sharp insights, we had meaningful dialogue, we had a forward-looking view of India's investment landscape in today's increasingly complex and volatile world. So we began with Neelkant Mishra, the noted economist, and we stepped back and looked at the big picture, decoding global shifts, understanding India's place in the evolving economic order. As Mr. Mishra highlighted, India stands today at a powerful intersection of macro stability and long-term structural opportunity, but at the same time, he also highlighted the risks that we face, which are real. You can read more about it on the page one story of Mint today, where we have highlighted what he said yesterday. Then as the conversations progressed, we moved from macro to momentum on the ground. We had leaders like Parth Jindal from JSW, who spoke about the resurgence of Indian manufacturing, how scale, supply chain resilience, and global competitiveness are no longer aspirations, but really active priorities for India Inc. We also heard from Aryaman Birla. He brought in a refreshing perspective on next generation leadership, building businesses with purpose, taking a long-term view on wealth creation, and how he has enabled his organization to connect with India's consumer story. It was a fascinating discussion. Another important dimension that came into focus yesterday was the role of policy and regulation in deepening India's financial ecosystem. We had Mr. Siva Subramanian Raman, the chairman of the pension fund regulator, and he shed light on how pension reforms and the evolving role of the PFRDA are set to play a critical role in channeling long-term capital into Indian markets. We also looked at innovation in manufacturing, and conversations highlighted how technology, automation, new age processes are driving the next wave of industrial growth in India. Technology remained forefront, as it is today across everything that we do, every industry. Artificial intelligence is no longer a future disruptor, it is a current day multiplier. What also stood out across all these conversations was a shared sense of confidence, which is very heartening in this volatile and very difficult times. Confidence in India's domestic economy story, confidence in India's policy direction, and in the resilience and ambition of our entrepreneurs and enterprises. So if day one was about understanding forces shaping capital, shaping markets and opportunity, day two is going, like Kavya said, is going to be even bigger. We will start off with Jay Kotak, is here with us, graciously agreed to spare some time for us. It will be wonderful. I'm looking forward to his conversation with us. And we're going to have the Mint India Investment Awards for this evening, where the top performers in the investment ecosystem will be awarded. We'll have the Financial Services Secretary, Shri Nagaraju, with us in a fireside chat. We'll also have the governance expert, Mr. Damodaran, with us, and Aditya Puri, legendary former Managing Director of NBFC-Bank. Apart from that, there are several other really key sessions, which I'm sure you would have seen in the agenda. It's a great day, and let's start with Jay Kotak, and we'll start on a happy note. Kavya, thank you very much. Have a great day.
Thank you so much, Mr. Bhattacharya. I must admit, the kind of energy that you bring in, and if I could pick a word from the Gen Z vocab, I would say we indeed had a banger of a start for the day one of the summit, and we're back again with bigger voices, bigger topics, and some really interesting topics there, a really interesting theme. So thank you again, Mr. Alokesh, for taking us through what yesterday looked like. But that being said, while we will deep dive into conversations coming in from this side, I'd love for all of you to also keep your conversations coming across social media using the hashtag MintIIS2026. You can go ahead and tag us at @LiveMint. We'll also ensure that the connections continue for the day too. So we have the intro bot. If you still haven't gone ahead and scanned the QR code, you can do that today as well, right up on the screen, as well as the 10 cards that have been placed on your tables. So go ahead, make those meaningful connections, get to connect with your fellow delegates as well. And with that, let's now bring your attention to our very first session for the day two of the summit. Now, we all know that leadership is being redefined in real time. It's no longer just about legacy, it's about vision, it's about agility, and the courage to build what doesn't yet exist. We all know that India's next generation of leaders, they're not waiting for the future, they are the ones who are creating it. And at the forefront of this shift is a voice that represents the intersection of tradition and transformation. And as part of a new wave shaping India's financial and entrepreneurial landscape, he's someone who brings fresh thinking to legacy institutions and a global lens to India's growth story. We're mighty delighted to have with us Jay Kotak, EVP and co-head Kotak 811. Let's have a thunderous round of applause first up. And to spearhead this fireside chat, it's only befitting that we have with us Shayan Ghosh, editor, BFSI, Mint. Can we have a youthful round of energy? We're talking about the next gen. Let's bring the energy back in the air. And thank you, Jay, for joining us. And with that, Shayan, over to you.
Thank you. Welcome, Jay. Welcome to Mint India Investment Summit. Thank you as you would have heard, this is like a series of conversations we are having with the next gen business leaders. We had 2 of them yesterday, and continuing that. The first thing I wanted to ask you is, you've spoken about your time at Harvard, your initial career there, but what actually made you come back to India and try to build here in India?
So I had a great time in the US studying, but I'm patriotic. I think that over the last few hundred years, you've had very rare periods where a nation has risen, or at least a nation has an opportunity to rise and bring prosperity and shape history. I believe that India is at that crux right now, and was at that crux in 2017 when I decided to come back. So I came back first for what I saw as the opportunity and still see as the opportunity of India, and second for family. And I'm very close to my family, my parents, my grandparents, and so it felt appropriate, and I've never regretted that decision.
Right. I think you have said in the past that it was a call from your father, Mr. Kotak, but were you already sort of in 2 minds? Were you sitting on the fence? Were you on the fence whether to decide the next move in your career when you got that? Was it just a nudge that made you come back?
I was reasonably clear. I think the nudge helped, and when you're far away, you always want to evaluate other opportunities, and America is a very exciting place. But I was always quite clear, and I took that decision.
And in these 8-9 years, how have they been? You would have had some targets when you came in, thinking that these are the things you want to create in the next 5-10 years. How close are you to those goals that you set for yourself?
I like to take things as they come, as far as possible. So it would not be fair to say that in 2017 I had a target for where I would be or want to be, either personally or as a business in 2026. But as I said, I'm very happy with the decision I took to come back, and I'm really excited about India and what we are building in India today and at Kotak.
And was 811 entirely your brainchild? Was that your idea?
No.
Not really.
No. 811 started as 8th November 2016, which was the date of demonetization when India changed. I was still in the US. I graduated in 2017. So 811 started as an idea before me from various people at Kotak. When I returned to India and I started working at Kotak, I saw the 811 business as an exciting opportunity. I am in some ways a digital evangelist, and so I picked up and grew with the business.
How hard is it to set up a fully digital, paperless business? There would be a lot of competition right now, right? I mean, there are other players, big, small, who are all trying to go for the same set of customers, perhaps. How do you plan to stand out there?
So it started as a mission to democratize banking in India and has since manifested itself into a mission to democratize financial services in India. Of course, it's competitive. All markets are competitive, but relatively speaking, I don't think many of our other peers are chasing mass India in the way that we are, mass and mass affluent India in the way that we at Kotak are, certainly in the private sector.
What do you mean when you say chasing the mass India? Is it the rural customers? Is it the urban? What kind of customers are you chasing?
So the 90th percentile monthly income in India is somewhere between 25 and 40,000 rupees, depending on how you think about it. In that context, the idea of a zero balance account for scale is in itself something that started as disruptive, though now many people are doing it. We are chasing A, the mission, which is to democratize financial services in India, and B, to do it in a way that is a good and sound and scalable business. And for us, it's less about what our competition thinks, as long as we have conviction on our business model and our customers are happy with us.
India is also a very price-sensitive market, right? So zero balance accounts, and then when you try to scale up, when you try to sell, cross-sell some of your other products, is that a challenge that you see in the market, right?
It depends on the products. Products have to be tailor-made for customers. You're absolutely right. India is a very price-sensitive market, and you think about some of the companies that have succeeded in India, they manage costs extremely well. They tailor their products and propositions towards what customers want at price points that make sense. But if you keep control of cost, you can make money because the target addressable market in India is huge and incomes are growing. So bank accounts are sticky, long-term products, and bringing young people into the banking net early, we think is a good strategy.
You spoke about keeping costs down. So 811 has these engineering centers in Hyderabad and in Bangalore, where I think you develop the in-house capabilities. Does it not raise costs when you have an in-house team compared to when you're outsourcing it to vendors?
So this is a classic build versus buy in technology question. I think there is a place for building technology and buying technology. But when I think about our consumer-facing interfaces, when I think about producing a product for the customer, I'm inclined to build in-house if possible and if it's appropriate and scalable, because while that may create an upfront cost, technology is infinitely or near infinitely scalable. So the cost of an engineering team is high when you hire it. But if the product or service that they build scales substantially, then that's a far lower cost than a repeat annual vendor contract with a mandated escalation.
And is that true for the other segments of Kotak's business in terms of in-house talent versus outsourcing? Is that a philosophy that you follow across the board?
So I don't want to speak about the larger Kotak with authority because it's not a business that I directly run. But yes, at Kotak as well, we have a large, capable team of in-house software engineers. And the philosophy is always to thoughtfully trade off on build or buy. And I would like to think that relative to many others, we do build more in-house.
If you step back a little, what is your, broadly, what is your vision for 811? You have about, what, 25 million customers now? Your presentation says that the target is to reach 1 billion Indian, sorry.
Yes.
From 25 million to 1 billion, how is that journey going to be?
So, we don't seek customer numbers in the name of the vanity of having customer numbers. We want real, tangible, engaged customers. But the mission is a bank account for every Indian. And that continues to be what we chased. You asked me why I came back to India. It was for pursuing a mission. I back then didn't know that it would be this mission. But yes, and we are very mission oriented at 811 and at Kotak to build a scale banking franchise in India.
But you know, are there other areas beyond 811 that you're currently working on?
Yes, I spend time also the main Kotak banking app. The new Kotak banking app is something that as of recently I've started overseeing, and the idea is just to bring the best practices of what we are doing at 811 and building world-class customer interfaces and customer applications. I spend some time with our wholesale businesses. As you know, and you know, it was discussed about other leaders that have been on this platform. Corporate India is seeing an intergenerational transfer, and alongside that, it's important for us at Kotak and our wholesale businesses also to build partnerships with the next generation of Indian business leaders. So I'm involved in that as well. But my primary time is spent on the 811 business.
Right. And when you say building for the next generation, wholesale banking, etc., is it where you're tapping your your personal relationships with some of these leaders who you would have crossed paths at your during your education abroad? Is that something that you're bringing to the table? Your kind of personal relationships with them?
In some cases, yes. But I think the larger framework in how I think about it is, if I were a business owner partnering with a financial institution, I would want a trust-based relationship and partnership, and a personal connect definitely helps in that context, and a personal connect of somebody in a similar age group helps even more. But at the end of the day, it's on merit of the relationship between the two institutions.
And coming back to 811, with all the scale that you're talking about, the reaching more people, banking more people, is there a plan? Do you see 811 becoming a separate business altogether, like hiving it off at a later stage?
No. At this stage, we are part of the regulated entity, which is Kotak Mahindra Bank, and I see no reason why that changes. I don't know what the future holds or how some of this changes, but we are really happy where we are.
On AI in banking, I mean, that's a conversation that's happening across all industries. I saw a photo of you with Sam Altman at the recent AI summit in Delhi. What are some of the conversations that you're having with these AI companies? And if you could talk about some use cases that you're seeing being implemented in Kotak or specifically in 811.
So I would rather leave what we're doing at Kotak on AI out, because that's something that I think should be disclosed by management in the appropriate forum. I will talk more generally about AI, and this is nothing I say we don't already know, but I think AI is going to transform banking. When I think about a business like us, first, a technology business has a voracious or infinite appetite for code. And if we are able to generate scalable and production grade code cheaply, for 100 engineers, if you could generate X lines of code, and now you can generate 10,000 lines of code, which then results in your ability to ship that many more products and services quickly to improve your customer product experience. And that becomes an integral use case, which is number one. I think about voice. As you rightly said, in order to serve mass and mass affluent India, where customers are price sensitive, it requires costs to be kept under control. And in order to do that, we have to look at other areas like how we look at voice, like how we look at a variety of other cost pools in our business. But as with a new and developing technology, we have to be very careful that what we are replacing in the name of saving cost doesn't 2 years later turn out to be actually insidiously increasing cost because the technology didn't deliver as we thought it would. So we will be calibrated in that context. To me, the area that we are seeing clearly that a big disruption is happening is in the life cycle of creating a digital product from concept to design to code to production to customer, and the feedback cycle of that. That is something that is going to move very, very much quicker now than it has in the past.
One of India's largest NBFCs, put out some staggering numbers on the use of AI in their business. The kind of calls that those bots are handling, agentic AI, etc. At Kotak and at 811, are you seeing any kind of the significant change in the business in how, I mean, you spoke about the life cycle of a product, but any other kind of tangible results that you're seeing already?
Yes, but to me, I think we're underselling how important product innovation is. To me, that is a very, very big change. Today, if we look at our banking apps, we look at our customer interfaces, there's so much more that we want, which is why fintechs are able to gain mind share and engagements, because they provide a feature like a Splitwise. They provide all these other features that banks don't have. So I think it is going to change, and in this very context.
You spoke about competition. I mean, you answered that question on competition and price sensitivity. In this sector, you're not just competing with other banks and NBFCs, but also a lot of fintechs who are building probably much faster, who are more nimble than a regulated institution can ever be. Is that something? Is that some sort of a challenge? The kind of regulation that we are currently under, the banks.
No, I think the fact that we are regulated, the fact that we are a credible brand and the public trusts us is very, very important. So we would not trade that for anything, and that means adhering to regulation. That means discussing and talking and cooperating with regulators, and that's part of the game. That said, agility is extremely important, and I don't think that regulation is the reason why banks cannot be agile. I think often it is more about a legacy business versus a young, hungry new business, and that's really what we are trying to build, which is a young and hungry business unit inside a large, respected financial institution.
The banking industry is also going through a very, very challenging time when it comes to deposits. You know, how do you see that from the context of a digital-only offering of 811? Has it helped the bank reach deeper into India to get more deposits? Because that's something that you know that all banks are trying to figure out how to get more deposits.
Yes, but I would rather leave how it has helped or the scale of how it has helped for the investor disclosures. I will say, however, that one of the advantages of our business model is if you are a primary transaction account for a large slice of mass and mass affluent India, the deposits will come. Because at the end of the day, we all use our bank accounts to transact. There'll be a stock of money you leave, you pay your bills, you interact with various other products and services, you invest, and you redeem. And as long as you're chasing retail and granular India, that is the way it will be. Now, if you've built a deposit franchise on only ultra-high net worth customers, then yes, you risk being susceptible to many savers who are now becoming investors, because why would anybody rationally want to leave a large pool of capital in a very, very low interest rate instrument?
But credit also has been a challenge, right? In the sense that while financial inclusion has led to a lot of, I mean, most of India's customers having a bank account. Do you see credit as a challenge too? And is there a way to solve that with technology?
So credit is an opportunity and a challenge. Yes, it's a challenge if you try and scale too quickly without the right underwriting guardrails, without the right collection mechanisms, etc., etc. But credit is also an opportunity if it's done well, because A, you're doing good for the economy, you're transferring capital from folks with excess capital to those who need it. As long as it's done in a prudent way, that's good for the economy. It can be very profitable for financial institutions because that is the business model of banking. So unsecured retail and secured credit is critical, and absolutely there is a lot of intelligence that has to be built into doing this well.
Coming back to you and the bank in general, how do you sort of try to stand out in in your work in an institution that's been built by your family, that's managed by professionals now, and is governed and is regulated by the Reserve Bank of India? How do you go about trying to make a mark in that?
So Kotak is a regulated entity. Kotak is a bank. Kotak is a listed company. We take that very seriously. I take that very seriously. And at the end of the day, it has to be basis merit and what is right for the various stakeholders, the shareholders, the customers, most importantly, the employees, etc. I run a business within the bank. The business has a P&L, it has business targets, and I am evaluated basis the same, like any other professional would be.
I'm just curious, you spoke about coming back to India. Was banking always what you wanted to be in, or was there a plan B?
So it of course factored into my mind that, banking is an opportunity here. I didn't come back for banking. I came back first for country and for family. And the 811 story came a little later as I joined Kotak and then found the mission and found that passion.
When we talk about digital-only banks, what comes to mind is this Brazilian bank, New Bank, and its founder, Mr. David Velez, frequents India, meets business leaders. Have you had a chance to meet him?
Yes, I have. Nubank is a business that we have been tracking for many, many years. It's a business we greatly respect, as we do Revolut, which is another British fintech company that's doing extremely well. So yes, these are businesses that we intensely admire.
Are those models, is it possible to replicate those models in India? Currently, there are no completely digital bank in India.
So both these businesses have very, very different models. Nubank in Brazil is much more driven by unsecured lending, unsecured credit cards, driven by the regulatory ecosystem in Brazil. Revolut, on the other hand, is more focused on liability, trading, forex, and fee income. And the reason I highlight those two differences is to make the point that digital banking is not necessarily the same. It depends on the customer franchise. The per capita GDP in Revolut's markets is 5x higher than that of Nubank's markets. The per capita GDP in India is a little lower than that of Brazil and Latin America. The regulation in our market is different. But yes, bringing banking digital is something that is extremely relevant and necessary in India.
Just a couple more questions before we go to the audience. Do you sort of see any primary issue in the banking industry right now, which you think you would want to solve for?
No, I think to use the word issue would be a very, very strong word.
Challenge maybe.
We are well regulated as an industry, well capitalized, and ready to weather most storms. That said, always doesn't hurt to be very paranoid about these things. I will say that we as banks need to continue to work to be better with our customers. I don't think there's anybody here who would say, I really enjoy waking up today and the first thing I want to do is go to my bank branch to conduct some banking activity. That's rarely considered something that you would look forward to. And it's on us as banks to change and to improve the way our customers interact with us and provide a delightful experience in managing something as important as your money.
Okay. We'll now go to the audience. Does anyone have a question? Yeah, there.
Hi, Jay. My name is Ram. I work for Cedar Consulting. There's a lot of discussion that we talk about how India has actually been spearheading the transformation when it comes to payments and how it is actually seen as a reference point globally, right? But if I took that analogy, extended to digital banking and what we seem to have been doing here, and you did talk about what Nubank or Revolut have been doing, do you foresee in the next few years something that the Indian banking system and the digital banking that we tend to actually drive in this country be a reference point or as a benchmark for the rest of the world? I mean, do you foresee something that actually would be specifically be born here that would be adopted globally?
Digital banking to me is a part of banking in general and very, very important part. So I don't think that we in India would be necessarily focused on building a great narrative around digital banking, but I would rather that we build a credible global narrative about being an agile, customer first and digital first banking sector. Yes, but it doesn't mean there necessarily has to be one champion. And by the way, the payments companies have done an outstanding job. So we, as Indians, should be very proud of that, even if as banks, they have taken away a lot of our customer engagement. So maybe we need to work a little harder.
Anybody else? Right. Huh? There. Yeah.
Okay, my name is Satish Dandekar. I'm from Assetwise Advisors. Just wanted to know the use of blockchain in banking. Should it be extended? And I mean, I'm not talking of the digital currencies that are there now, but the use of blockchain in banking, should it be more, the government should put a more emphasis on it? Do you feel that way?
That's hard for me to say. I have always heard and understood how important blockchain is, and I have a sense of that, but it's not really helped our business in any scalable way today. So I would not probably comment on that.
Right. Oh, nobody else. Okay. That's it, I think. We'll come to the end of this. Thank you, Jay. It was an absolute pleasure having you here.
Thank you. Thank you.
Thank you. Thank you very much. And if I could please request Shahan to present a token of our gratitude to Jay Kotak. Thank you so much for joining us here at the summit, and thank you for your valuable time and your thoughts. We'll have a quick photo op as well. Thank you so much. Thank you. All right. On that note, ladies and gentlemen, we're now about to set the stage for another very important discussion. We're talking about the value creation through bolt-ons. And we know we're not talking about just headline-grabbing mega deals, but precise strategic additions that deepen capabilities and unlock synergies. It's not just about building a new engine, it's in fact about turbocharging an existing one, and that's why it's such a pertinent theme for all of us to discuss right here at the summit. We've got our expert panel lined up, our expert speakers lined up, and we're about to get started. Meanwhile, I'd like to once again remind all of you to please keep your conversations coming across the social media using the hashtag MintIIS2026. Now, as we set the stage, once again, to spearhead the session, we have with us Neha Shah, Editor Deals and Startups Mint, who will be extracting all the relevant insights from her panelists. And with that, we'll also go ahead and invite our speakers. But first up, Neha, let's have you on stage. And I love the part where you and I can welcome your speakers as well. So let's do that. But ladies and gentlemen, we've got such incredible leaders joining us here right from the start of the summit. So without any further delay, they've been waiting over here. I'd love to bring them right here on stage. First up, let me please invite Mayank Bajpai, partner, TPG Growth and Rise, to please come on stage, sir. I'm going to please invite you. I'd like to further invite Saurabh Chatterjee, Managing Director, Chris Cap, Hari Gopal Krishnan, Deputy Co-Head, Private Capital Asia, EQT, Ashish Kotecha, Partner, Bain Capital, and Vikram Raghani, Partner, GSC Advocates and Solicitors. You know, let's also add some value to that applause. Let's make it loud and clear and welcome our amazing leaders here. We're about to deep dive into a very important discussion. So with that, Sneha, over to you.
Thank you, Kavya. First up, thank you everyone for agreeing to do this, and welcome to Mint India Investment Summit. For us at MIIS, private equity is one of the key topic, and when we were trying to come up with this entire idea of what should we talk about, what should we get the leaders to talk about, I think bolt-ons has been, or buyouts has been the flavor of the season. And if I could throw some numbers in the last 1 decade, we have seen almost 117 billion being pumped in through buyouts by large as well as mid-size buyout funds in India. And that constitutes almost 24% of the capital that's flowing from private equity into the Indian market. So that's huge and it's growing. So with that, let's dive in right in. And I just wanted to understand what are the various ways of value creation for buyout funds? Ashish, if you can take this up first and talk about, because Bain is a buyout fund, what are the different ways, and is platform becoming the way to create value?
Sure. Thanks, Neha. Look, I think often value creation is a misused term. If you think about the investments that we make on the buyout side, in large part, you're betting on an attractive macro theme. You're betting on a good competitive position that you can build off. But the way we approach value creation is, for us, we feel there's a handful of things you need to do in a business to unlock value. Often there are hundreds of things you need to do to run a business, but there are a handful of things that we feel can disproportionately help us create value. We identify those. You get that out of underwriting, but you live in a dynamic world, so you keep that refreshed. And once you've done that, you eventually then make sure that you make good progress quickly in a timely way against those initiatives. Typically, it varies by company, by investment, in terms of what are those 2 or 3 things. If you ask me, are there patterns and specific things, we have maybe 5 or 6 building blocks. We tend to spend a lot of time on making the right strategic choices in our investments. We call that blueprinting. Part of that is as much about what we want to do with the business and what we don't want to do with the business. So I think driving that strategic clarity is one really important piece of our playbook in terms of how we approach value creation. The second is building for-purpose boards and teams and making sure that while you can have a collection of A players, how do you build an A team becomes very important. So we spend an inordinate amount of time upfront building the right team. I think the third is we typically then will run initiatives in cost, cash, pricing, all of which depends on the investment, the industry. And part of that M&A often ends up being an important tool. What that M&A does, it really does vary. I think Mayank was mentioning earlier to you that sometimes the only way to play a theme is by cobbling together a bunch of assets and creating a platform that makes sense. Sometimes a bolt-on acquisition can give you a customer, or it can give you a market segment that you don't have exposure to, and just accelerates the value creation journey. So M&A is a key part of that. And then we spend a lot of time thinking about how to think about the right home for the business for the next chapter once we leave. And often that entails years of work, either getting a business ready for an IPO or otherwise thinking about how to make a business more attractive to a strategic buyer potentially. So I'd say those are some of the elements of our playbook, and then you vary that based on the industry and the type of deal you're doing.
Right. You've recently concluded fundraise, and I would want to dip into a bit of that experience and ask you on how are LPs thinking about, what is the mandate of the fund? Are we increasingly going to see funds being raised to do more buyouts, to do more platform deals?
Yeah. So first of all, pleasure to be here. Thank you. So LPs, historically, Chris Capital, we've always had the flexibility from our LPs to invest in both listed and controlled deals. So we've done over the last 27 years, 110 deals, of which probably 95 to 100 have been minority deals. We've had 85 exits, of which probably 80 have been from minority situations. So we are primarily and historically have been a minority-focused firm, minority investment-focused firm, but we've been doing more controlled investments over the past 2 or 3 fund cycles, not because we think every control deal is better than every minority deal, but because that's what the market is throwing up, right? So when we started investing, there were very few control deals in India. 10 years, control investments made up about 15% of the market. Now it's 30, 35% and growing. So we are evolving in conjunction with the market. And historically, look, I think Western LPs or LPs from developed markets have preferred firms that do control deals because that's what they're familiar with, because they come from a background in which private equity was created to take control of companies and so on and so forth. So if you go and tell them that, look, we'll do control investments, it's a slightly easier path than a more nuanced discussion of, look, give us the flexibility to do control and minority, and then give us the flexibility to go where we can find better returns. It's a tougher sell, but it's a more honest sell in the sense that it's more indicative of what we think can generate returns. So now that we're doing more control, I think LPs, I wouldn't say are more excited, but we're getting sort of more into their comfort zone, but they also want to understand that a change from more minority to more control, are you building the capabilities that allow you to do more control deals? Are you building the muscles that allow you to deliver value and value creation on the control deals? And there, I'm happy to say that we've made sort of tremendous strides. So in 2017, we set up Enhansin, which is our portfolio operations group, sort of internal consulting arm, to really go in deep at our portfolio companies, both control and minority, to do value creation activities. After a bit of a slow start while we figured out the right person to lead the team and the right model, over the last 5 or 6 years, it's really gone from strength to strength. Now we have 10 plus full-time members on that Enhansin team, plus senior advisors who are on a part-time basis. We started out by doing more light touch things like revenue enhancement strategy. Now we're still doing that, but also some very operationally complex things like supply chain optimization, cost optimization, obviously M&A, post-merger integration. And we're doing this across control and minority. So I think to sort of come back to your question, yes, LPs want to make sure that there is a market opportunity for what you're doing, that you can deliver returns, and that you have the capabilities to deliver returns in those segments. And if you're slightly evolving to where the market is going, like we have, that you're changing the firm and the muscles that you have in order to deliver returns in whatever new thing you're doing. So it really depends on what you're set up to do, what you're able to do, and where you have the right to win. If you're participating in a segment of the market where you have the right to win, LPs are happy to back you.
Right. Hari, EQT has been doing a lot of buyouts of late, and it is one of the largest, I mean, if we were to see, you have been the most active in the last 3 years in the Indian market. So what has the experience been trying to do buyouts as well as bolt-ons in India? Are the assets available?
Sure. Thanks, Neha. Hi, everyone. So as EQT in India, we started doing buyouts way back in 2013. So for the past 14 years, 13, 14 years, we've really focused on buyouts. Maybe there's 1 or 2 deals that have been minority. And but overall, our platform is really focused on buyouts, and that has really worked well for us. I would say one of the things that we've done well is we chose certain sectors where there was a deep pool of management talent already in play that helped us do these buyouts. And so when I started, people would tell me, hey, there are no buyouts in India, there will be nothing for you to do. So I was thinking, hey, are we going to be successful at this? But over time, more Indian founders are open to the idea of, finding a good home for their businesses. More of the younger generation is excited about different things than their parents were. And as a result, the proportion of buyouts has actually increased across sectors. And we think that, we're still scratching the surface. If you look at a country like us, we have 4 trillion GDP, total buyout volume last year, maybe 15 billion, which means that we're still very underpenetrated. So I still think that buyouts are going to grow much more than in the past. If you look at 15 billion as the deals that happened last year, if you assume that each of those deals it returns at least 2 times in the next 5 years, that secondary base of deals itself is 30 billion, assuming all of them do well. And then there'll be more primary deals as well. So at EQT, we are really excited about the opportunity in buyouts, and we see that as a big growth opportunity.
Right. Mayank, for almost a decade, and I've been covering this for a decade and a half. Earlier, the question was, where are the exits? Now, at least that question has been answered for private equity investors. We've seen in the last 5 years, people have taken a lot of money off the table. So are the exits and the numbers encouraging investors to pump in more dollars into India?
I think that has largely been the case. I mean, India has always been a great opportunity set for a lot of global and now homegrown investors who've scaled up kind of a thing. I think there was always the promise, but if you look back and step back, like at least the last 5 years, I would say, people have actually realized a lot of those opportunities right now. And I would at least say from our perspective right now, when we started off with a one product play in the market about 20 years back, today we are currently playing 4 products in the market, right? Different strategies and different sector focus, but all equally bullish, and India playing a significant role as a percentage, both from a deployment and realization perspective, across all the products. So I would say, yes, the private equity ecosystem has evolved a lot, and we've seen a lot of these results in the last 5 years especially.
Right. Building on to what you just said, Mayank, does it really help to have these buckets of, or rather different pools of capital? Does it help you access deals better because even founders and sellers have become selective? So the kind of experience that you get through different pools of capital, the kind of operating partners that you get to the table, does that help you access deals better?
So what is one thing has become true is, for good companies, capital has become a commodity, right? So they're asking a lot more from the capital partners as to how can they help value add, whatever you say, during the journey of investment, right? I think for us, the genesis of different products came from the focus on different sectors. I think we've always tried to be sectoral. We felt it's hard to do good things in a few sectors, let alone do too many sectors. So we have different teams right now. Again, but within each product, there are 1 or 2 sectors and largely niche areas within those sectors we try to focus on. So what that allows us to do is build both the investing capabilities as well as what we call the business building capabilities with a very sharp focus within some sectors, right? We can't play across a wide variety of choices or different sectors because we've chosen to focus on them. But once it's within our kind of play zone, then there are a lot of learnings that we can bring from both global and regional investments and stories that hopefully we can add value to the founders right now. Having said that, it's all, at the end of it, it becomes a pure partnership play with that particular company and that particular founder management team. I would say value creation is a truly customizable, in fact, journey. I wouldn't even say a plan right now because honestly, I would love to say most of the value creation journeys that we have realized, we saw it at the day of investment, but things have pivoted so much that you have to be agile and work in a partnership model with them to focus on the right areas and hopefully reduce the probability of mistakes right now along the way.
Right. Vikram, what are the likely sectors that we are going to see where more buyout and bolt-ons opportunities are going to throw up?
Sure. So I think from a sector perspective, well, conventionally, we've seen a lot of buyout in financial services, healthcare, right? Most of our large hospital assets are now private equity owned. Real estate. I think at this point of time, if we are talking about sectors, we have to talk about AI, right? Because I think private equity is going to play a key role in our AI initiatives. I think whether it comes to Viksit Bharat and achieving the aim of 30 trillion by 2030, whether it's the AI India mission. I think we had the AI India Summit where close to $200 billion plus have been committed to data centers, whether it's the AI compute policy. I think largely from a sector standpoint, the data centers, chips and power, right? Because with large investments in data centers, there will be a need to invest in renewable energy as well because of the power requirements of data centers. And of course, the government is very keen that India becomes a global hub as far as manufacturing of chips and semiconductors is concerned. So, the government has come out with this, it's a policy where they are going to fund procuring 18,000 GPUs and so on and so forth. And we already have the first largest fabricator in Gujarat. So I think while financial services, healthcare, all of these will continue, we will see a lot of investments in the entire AI space going forward.
Right. Hemant, a very essential ingredient of getting bolt-ons or buyouts right is the talent that's available in terms of operating expertise. Do you see that the Indian market is now ready with that kind of talent? Because you need those kind of people to really help you drive portfolio value portfolio management as well as value creation. Sorry, Hari, can you? I'm so sorry, I'm so sorry.
So I would say it's increased over time. I think we have a business that invests across North America, Europe, Asia. I genuinely feel that India has some of the best talent globally. And that is across different sectors. We have homegrown talent, we have great institutes. We also have a lot of both Indian corporate houses and MNCs that have proven to be good training grounds for this talent. So, like if you just look at the numbers, we have 1.4 billion people, median age is 28 years. We have so many graduates coming out of CF, so many STEM graduates coming out of. So we've found an increasing number of managerial talent interested in working with private equity in buyouts. I remember when we did our first buyout and we had to, we had to make management changes or bring in a new CEO. The questions I used to get, hey, what is private equity? Or are you saying that after 5 years you have to exit? Then what will I do? I'm working for 30 years with my current employer, etc. And so it was, we had to, sell the idea of private equity and what it does and the operational flexibility and the value creation opportunity there. Today, it's changed a lot. Today, we get a lot more managerial talent coming and telling us, hey, I really want to work with private equity. So it's been, in 15 years, you've seen the market shift, and it's reflective of what we see in other markets as well. So I do believe that, first, India has great talent. Talent is shifting towards private equity. And it will continue to grow as a source of talent for buyouts and bolt-ons.
Right. Ashish, M&As are the most trickiest part, and we've seen that the jury is still out there on M&As really work or not. So what are the a few things that a PE fund watches out for to ensure that you get the M&As right?
Yeah, no, I think lots of lessons learned along the years. I think M&A works really well when the strategic logic for that M&A is clear. I think I touched on it before. What we've found is sometimes, particularly in IT services, the ability to bolt on, tuck in small businesses, which give you again a new product or a new capability or a new customer, incredibly easy. Now, the way you do that and the way you set yourself up to do that is different. So that's one archetype. I think the second archetype where we've seen M&A work is what we call a little bit more of a scale acquisition. So if I reflect back on my time at Axis, the acquisition of Citibank, as an example, gave us a bulk of premium customers that would have been very hard to organically build. But that was a relatively bigger bet. I think the way you think about those, the bar for those, the amount of diligence you do, and then how you think about integrating that is very different. And then I think the third is, again, sometimes we feel the best way to play a theme is to cobble together. So from day one, you know that you'll have a subscale asset, you're investing in a platform, but that in 3-4 years, you'll have enough of a portfolio. And again, the things you do there are different. So I'd say the first and most important thing is strategic clarity on why you're doing this. I think the second lesson we've learned is to be a lot more thoughtful about then the integration. Again, we've been in situations where sometimes the right answer is to, just completely absorb the management team and have one platform. Sometimes we've learned the right answer is to let a business sort of go and maybe in 18 months absorb it in. So I think being very thoughtful about the right way to digest what you've acquired is probably the second learning. I think the third learning for us has been, again, when we do our, call it the base deal or the main deal, the level of diligence we do is quite deep. Often if you're doing a small bolt-on acquisition, you can't do that level of depth because, again, it's a much more focused bet. So I think we've spent a lot of time thinking about the right capabilities to have in a company versus how much we have in the fund, and then how our deal teams work with the biz dev team or the M&A team in our companies to make sure that we're helping, but you're not sort of burdening the company with sort of the way we do deep diligence on really large assets. So I think if you get those three things right, it can be incredibly powerful, incredibly accretive, and like with everything else, you've got to buy it at the right multiple, right? Which I think is the 80-20 of it as well.
Just a couple of points on our experience there. So bolt-ons and IT services companies have been a big part of our strategy as well. So in fact, we've hired a gentleman a couple of years ago whose only job it is to hunt for bolt-on acquisitions at IT services company. He's the head of M&A at Chris Capital. And on average, we've done about 4 bolt-on acquisitions per IT services company. Overall, I think they've been successful. And as mentioned, it is you find the right company that helps you add a client, add a logo, add a capability that helps you enter into a certain market. There's a couple of learnings that we've had. One is the cultural aspect and in the integration. So over-communicate when it comes to the company you're acquiring, over-communicate to the team members as to what is going to happen, what the plan is, because there is, their company just got acquired by some private equity firm. They may not know much about what happened. So there's a lot of uncertainty there, which can lead to attrition and can sort of put your plan back right from the get-go. When certain team members leave, all of a sudden our entire division leaves and you don't expect it. So I think over-communicate in terms of what the plan is, what their role is. If they don't have a role, communicate that as well, right? And the other thing is maybe be sort of accepting that the company you've acquired might have something to teach the parent company as well, right? In terms of systems and processes and ways of thinking about people, ways of sharpening go-to-market, ways of structuring the sales teams, ways of doing incentives, incentivizing the sales team. So it's not always the case that the company doing the acquiring is better at everything than the company being acquired, right? There are some things you can learn. The flow of knowledge can go both ways. So I think if you have those two things, the softer sort of things covered, then that helps in the integration as well. And the diligence part is very critical, right? Because sometimes these companies are, the main company that we buy, the platform, quote unquote, is say $150 million, $200 million in revenue for Chris Capital. The companies that we're acquiring only $20 million. So how much diligence can you do? What are the systems and processes? Sometimes the diligence that you do for the newer company is nowhere near as deep and rigorous, not because you don't want to do it, because the company is just not set up for it. So that brings with it its own set of risks, which you have to sort of adjust for and plan for. But those are the 2 or 3 things that I think we've learned in the PMI, post-merger integration process.
Right. And what are the kind of regulatory risk, Vikram, if you can talk about that for these kind of buyouts as well as bolt-ons?
I think, we've seen clients consistently do bolt-on acquisitions, right? So from a regulatory standpoint, I think things have become only better year after year. So if you look at FDI, for example, there are hardly any sectors where FDI approvals are required now, right? So whether it's IT or healthcare, all of these. And even where approvals are required, like banks, for example. So we did the largest investment in a private sector bank last year. And across various approvals that were required, we managed to get those in under 3 months. So I think regulators have become more and more efficient. They're sophisticated. They understand these transactions. They understand time value of money. Approvals are coming in fairly efficiently. There are areas where clarity was required, like this entire PN3, the Chinese LP ownership in private equity firms. There was a certain market practice that was being followed, which has now been formalized last week. So I think the government has been pretty much on the ball, trying to ease the regulatory landscape to facilitate these investments. Acquisition financing is another area where our ECB framework has been opened up to allow raising funds for acquisitions. Indian banks are now allowed to give acquisition financing. It was considered a big disadvantage compared to some of the other jurisdictions, so that's opened up. Even from an IPO capital markets perspective, right, the time taken by SEBI to get through filings has become much quicker. They've increased the headroom for anchor category participation. If you see last year, the exits by way of OFS were record numbers, right? Almost like 95,000 crores odd. So all of that has, I think, been really good enablers to sort of incentivize some of these acquisitions. So I wouldn't say there are any real challenges, but when you're setting up a platform, when you're sort of building substance through various acquisitions. There are a couple of issues that need to be dealt with. There are core investment company rules of the RBI and so on and so forth. But I think by and large, it's been very enabling as far as the regulatory landscape is concerned.
Right. Hari, the deeper capital markets, do they help? Because I'm sure, at the exit horizon, having this kind of deeper market where you're able to sell down to zero for a buyout fund, it's very important. So how does the way the Indian markets have performed in the last 4-5 years given you the confidence to do more buyouts and bolt-ons?
Yes, definitely. Yeah, definitely having a vibrant capital markets is important for the growth of private equity. It is critical for minority investors because that's the primary path in most cases. We've been also unique in some ways that we've bought control of listed companies, which we then sold down on the market as well. So, we're comfortable buying control of listed companies. And that's a big proportion of transactions as well. But I'm also conscious that for buyouts, if you buy 100% of a company, it's also not easy to sell down completely. But as the market matures, that will happen over time as well. And we'll see more private equity firms take a company from 100 to 0. And I can see today every Indian company or almost every Indian company has an anchor promoter, whereas in other markets internationally, the concept of promoter is not there. They are all board-managed companies. And private equity can be the catalyst to having so many board-managed companies in India. And I feel that will definitely help the deepening of the market. So it's great to have that flexibility.
Right. Mayank, valuation is one thing that Indian market is always criticized about, like the kind of rich valuations, or rather a lot of global funds, they feel vis-a-vis other markets that they operate in, the valuation multiples in India have always been sort of prohibitive in that sense. How do you see valuations? Do they help do more buyouts? Do they help you do more, put more dollars to use in India?
I don't think I'll comment on the valuation aspect of it right now because it won't be fair to do so. But what I would say is I think over time what we've seen is the approach and the time and effort required in understanding why the valuation is there is improved across, I would say, global funds, local funds, whatever it might be. I don't think there is any unit, a large-scale successful unit in India that is being run from US. You have a complete seasoned local team that understands is well entrenched in the market, has the credibility with the global peers kind of a thing, and they drive the investment thesis and obviously support the valuation ask, right? Obviously, it's a case-by-case, varies across sector. And hence, again, we believe it's important to be deep in some sectors because then regardless of the lift required post-investment or the critical ask at the time of investment, you're able to play around that a lot better in a global investment committee, right? So again, it's not about just holistic, or I can talk about the growth, the macro environment, but again, when it comes down to a specific deal valuation, there are a lot of factors that come into play. And then it's the understanding and the credibility of the local team, which I think has come a long way in the last 2 decades from being a kind of a small unit of a global firm to actually being a full-fledged one, which is contributing a lot both for deployment as well as realizations at the global front end.
Right. Saurabh, Priscap has also raised a continuation fund. Now, we are increasingly seeing private equity trying to do continuation funds for their hero portfolio companies where, wherever you have more confidence, you're able to raise that kind of capital from LPs. Can you talk a bit about that? Is capital available for continuation fund? What are the LPs thinking?
So LP views on continuation funds, I think, vary significantly. I think if the LP has a secondary arm that does continuation funds, they're a lot more excited about it. And if they're not, they're not. A lot of LPs want plain vanilla investments where they invest in a private equity fund. It does 10 years, maybe 2 more years for an extension, then that's it. And then they don't like this continuation fund because it can bring in some conflicts of interest. Is the GP rolling over carry or is the GP crystallizing carry? What value is the asset being sold at? to the continuation fund? Is it being sold at NAV? If it's being sold at NAV, great. If it's being sold at a discount to NAV, why are you doing that? Because most people, most LPs who come into continuation funds want to buy things on secondary market at a discount. So if you're selling at a discount, then are you being unfair to the LPs who are in your main fund? So there are those things to consider. And in our case, when we did the NSE continuation fund, we did not crystallize carry. We rolled over all the carry into the next fund. So there was no one made any carry at that point. And we did it exactly at NAV. So, and that was a big sticking point for us. We actually gave up economics to the incoming investors in the continuation fund because we said that, look, whatever happens, we will not sell this thing at a discount. We do not want to give our existing investors a haircut in any way, shape, or form. So I think if you do those things the right way, then that gets you a tremendous amount of faith and respect and support from your LPs. But in general, I think it's a great way to hold on to, like you said, hero assets, right? Assets which you think will still compound at 20-25% dollar IRR over the next 5 or 6 years, because incoming LPs want to see a net of 20% in a continuation fund. I think when LGPs get in trouble is when they try to do a multi-asset CV and then slip in a substandard asset with the 1 or 2 hero assets. And look, it's not a 20 portfolio asset, right? It'll be like 3 or 4 or 5. So in that case, LPs will sniff it out. They will not appreciate it. And it'll just affect, instead of the good asset raising the value of the poorer asset, I think it's the other way around. The poorer asset will bring down the value of the overall portfolio. So I think it's a good way to hold on to marquee assets. It's not a good way of buying some more time to exit out of substandard assets.
Right. Vikram, last year when the Blackstone Global Management was here, they had a point to make. They said that if India opens up its take private policy and regulations, we'll see more buyouts happening. What is your take on that?
So actually, India has opened up its take private rules. I think we've come a long way from the reverse book building process where price discovery was largely in the hands of shareholders to then a counter offer mechanism. And after a lot of requests from the industry, we now have fixed price take private rules, right? So we have moved a long way in the sense that buyout funds can now hope to sort of drive the pricing decision in a take private transaction. It hasn't met with too much success as of now, simply because our capital markets are doing so well. But in terms of does the law now allow a fixed price to take private? The answer is yes. Funds have done it. For example, Advent had done it with DFM. They sort of bought the company and then they delisted it. So it's really up to the buyout funds now. If at the right price they are able to delist a company. I think it's a function of how the markets are and where the prices are. Yeah.
Right. Ashish, Bain has started an automotive platform, or at least has the aim to do an automotive platform. What is the thought behind that platform? And are there any other sectors where you likely see that over the next 10 years a platform can be built?
So we've made 2 investments in the auto component space recently. One is in commercial vehicles and one is in two-wheelers. The idea is to keep them separate. But I do think within the commercial vehicle investment that we've made, which is RSB, an important part of the thesis was taking the business through a journey whereby they would reduce cyclicality in the business, because CVs are cyclical, and that happens by, for example, growing exports, aftermarket. But it also goes from adding new products and potentially diversifying away from CV. So I would say that investment does have a platform thesis. Again, strategically, that platform thesis is designed to reduce cyclicality, increase where in the value chain you play, and therefore the profits you can make through the value chain. It's been a great experience. Look, I do think, to Hari's point, there is a deep pool of talent in India. I think it's deeper in financial services, consumer, IT services. So, an important part of this journey for us is building the right team, and it is a family that we've partnered with, but it is a family that has given us control. So we're taking this business through a professionalization journey. We're taking the business through a, strategically make it less cyclical, make it more value add. And we're also taking this business, which is private, on a journey to get them ready to go public eventually at some point in time in the future. So I think it's a very interesting platform build. It does, again, I think this is one where you had back to my categories, it's in the middle, where you had a strong base business, a large base business, and through tuck-ins and, point acquisitions, you can build it out. I think, look, in some of the other sectors, if I look at data centers, we built a very different platform. There we acquired, one asset actually we started in Southeast Asia with no assets, with a management team. We built out Southeast Asia, then we merged into a very large data center platform in China. It runs 90% of ByteDance and TikTok's volumes. So I think, that's a little different. So I do think in tech, I think selectively in industrials, where even in chemicals we're building out a platform, there are some interesting platform opportunities that we should see in the next few years.
Right. Hari, if we have to analyze, largely private equity investors have stayed with old economy sectors. We are not seeing a lot of capital flow into, say, new age, digital or D2C disruptive businesses. Is it going to change? Is the playbook changing over the next, 5 to 10 years? Do you see a lot more investments going into, say, new age businesses?
Yes, Neha, that's an interesting question. See, I would say that a lot of new age businesses are started by young first generation entrepreneurs, okay? Who may not want to give up control, okay? So buyouts by definition may not happen, but at the same time, private equity can still be minority investors there, and private equity has been, invested and helped the growth of many of these new age businesses. So that's one thought to consider. And, as these, founders decide to move on to do other things, etc., buyouts open up there. The second thing I would really say is that tech services is also new age in many ways, because tech services changes every 5 years. What you start as app develop, we started as Y2K, then app development, then then ERP implementation and cloud migration. So in that sense, tech services has been a big source of deal flow for private equity. So I would say private equity investors, see the composition of private equity investors are pension funds, insurance companies, etc., who are very risk averse, and so capital protection is very important for them. And so the bulk of buyout capital goes in businesses that that are perceived to be downside protected, giving regular returns over time. And so established businesses naturally gravitate to that at some level.
Right. Mayank, as a growth fund, how do you, to Hari's point on capital protection versus value creation, being a growth fund, how do you really do that with, say, being a minority partner? Which side do you weigh more?
So, look, ultimately, I think from a value creation journey perspective, right, yes, you could have a complete controlling stake or a deep minority stake, but at the end of it, what we've realized in our principle, one thing we know is we are never running the company, right? I think we found the right founder or partner with the right CEO, and we're trusting them to run the company, right? We are the right, our job is to be the thought partners and obviously enablers and improve the probability of success, right? So at the end of the day, once the deal is done, you have to work in a partnership model, right? It worked in the growth, it works this way for us in the growth fund, where more often than not in new age companies like you've mentioned, we are deep minority and working in a collaborative way, not just with the founder, but with a wide range of stakeholders at the cap table. And then if I flip over to the climate fund right now, where we are starting a lot of platforms, in fact, de novo investments right now, but yet once you get the human capital right, which hopefully is the first and the biggest step, then it's more of a partnership model regardless of the ownership.
Right, interesting. So I think we have just 2 minutes to take any audience questions, if any. Do we have? Yeah, the lady over there. Can we get? Please identify yourself and also point out to who do you want to answer the question.
Thank you. Thank you, everyone. This question is for Mayank. My name is Namrata, and I work as an ESG risk expert with investment banking. My company does EV mobilization across India, and we are a Macquarie Group portfolio company. My question is directly in connection with what you just mentioned. In terms of carbon impact, climate impact, or impact fund mobilization in India, do you agree that we're seeing largely international funds, international regulatory requirements being pushed, and maybe somewhere Indian regulations need to join hands to make that a larger reality for us, or do you think otherwise?
Thanks, Namrata, for your question. I think I'll just try to simplify it in some ways the way I see it right now. One is you talk about global funds playing this space, and the second is regulations, right? So I think from a regulations perspective, I think India is way ahead of the curve compared to a lot of other markets that we see and we are trying to play in. So both from a clarity of regulations as well as a stability of regulations, I think India has done a fantastic job. And it has allowed us to drive climate investments in India in the last 10 years, much more ahead of any other developing market. As far as global funds is concerned, again, I don't think it's just a pure play global funds play, but what we have at least realized, basis our own experience, is climate is a sector which requires large size checks at pretty early stage companies. True. Because you're either scaling things up from very small level or you're betting on technologies that are yet to kind of scale up properly. So for that, it requires much larger funds. We had to raise a much larger climate fund as a result, dedicated pool of capital for that. And we had to pull up a growth muscle to try and take those bets very early on in companies, right? So that's what at least we can say from our approach, but I see it as a very important agenda, and I see a lot of other global peers have bulked up this effort, and I hope to see that in the local market as well.
Okay, thank you, Mayank.
Right.
Firstly, thank you so much for the wonderful session. My question would be to CRISCAP has been one of the earliest funds to do a continuation vehicle in the last 3-4 years specifically. Many of your peer funds have also done multi-asset continuation vehicles, but you guys have done something anchored around NSE. So my question is more around the fact that, do you think India has the potential to do more single asset continuation vehicles? Is there an appetite for that right now?
Of course, 100%. There's definitely an appetite for that. Once again, like I mentioned, it really just depends on the asset. And I think every or most private equity funds in India will have one or two hero assets which they want to hold on to for a little bit longer. It makes sense for the GP, it makes sense for the LP. If it's a control position, they want to maybe stick around with the company a few years longer and sort of see through what they've started. So I think there's definitely an appetite from LPs. The GPs are wanting to do it as well, and you're seeing that in the market, right? And I think you will see more single asset continuation vehicles in the future. Single asset CV just depends on how strong that one single asset is, right? If you have we were fortunate enough to be investors in NSE, right? So, but there are other companies in our portfolio right now that eventually could be single asset CVs. So obviously we'll take that call as and when it happens, but I think it's going to be a booming industry. It works for everyone. It provides liquidity to existing investors, allows the GP and the new LPs to hold on to these new companies. Yeah, I think it's honestly, it can be, if structured well, a win-win for all.
Right. On that note, we'll call it a wrap. Thank you so much, guys, for agreeing to do this, and it was wonderful speaking to you. Huge round of applause for them. Thank you.
Thank you. Thank you very much, Sneha, and thank you to all of our panelists as well. I'd like to request you, Sneha, to please present a token of gratitude to our speakers. We managed to extract some incredible perspectives from all of them with this session. And we'd like to thank you all for your incredible presence with us here at the summit. If I could request all of you to come together for a group photograph as well, we'll just have you all come together. Sneha, I'd like to request you to join in as well for a quick photo op. And before we move on to our fireside chat, I'll also be requesting our speakers to remain on stage. In fact, I'd like to just a quick request for our speakers to remain on stage, all the speakers here. The reason is, in fact, yesterday at the day one of the summit, we had the opportunity to launch the India Inc.'s Challenge, the book, which is all about staying competitive in a turbulent environment. It was the official book of Mint Leadership Dialogue Season 2 in partnership with JSA Advocates and Solicitors. So I'd like to also request Neha to please distribute these books to our speakers. And while you're up here, we'll also have the AV on the screen that sort of captures the roundtables, the discussions that took place across 4 cities. So I'd like to request our speakers as well to go through the books, take a look at the video. The video is also for the audience. Let's have the AV on the screen, please. Well, yes, our speakers are also deep diving into this book, but let me tell you, it captures the essence of these roundtables, enriched further with thought-provoking guest articles from the very leaders who are shaping India's economic future. So on that note, let me also inform you that these books will be distributed right across all the tables to all our delegates as well. But with that, on that note, I'd now like to thank our speakers for joining in, for being part of the discussion, and also for being part of the launch of this book that we had on day 1 and right here day 2. Thank you so much again. Can we have a huge round of applause? And meanwhile, I request you all to be seated because the books will be distributed right across to all of you as well. Thank you so much again. Thank you very much. All right, so with that, what we're now about to do is move on to our next fireside chat. It's a feisty topic coming your way. I'd like to request everyone to continue being seated. Well, the good thing about a good discussion is that there's always a post-discussion, and that's what exactly happens with our delegates and our speakers. But delegates, please be seated because these books are also coming right across to you all on your tables, so please be seated. And we're also about to get started with our next session. All right, so meanwhile, let me also set the context in terms of what the next session is all about, because we have aptly called it the Fireside Chat. It's all about the influencer-led businesses. Now, this is where we're about to explore how influencer-led businesses are transforming marketing, shaping consumer behavior, and also creating a new frontier of entrepreneurship. We're talking about from fashion and wellness to consumer goods, and we see that these ventures are proving that influence is something that is way beyond popularity. It's about capital, it's about strategy, and also about scalable business model. And we've got 2 incredible brands, and I must admit that we've got 2 super brands, and underneath it all, you and I are also customers and consumers of these 2 brands in some way or the other. In fact, I'm really delighted, and I'm eagerly looking forward to this session, and I'm sure many of you are as well. While the session will be spearheaded by Mansi Verma, Senior Correspondent Mint. So first up, Mansi, let me invite you on stage. You know my drill. It's all about ensuring that you and we can invite your speakers, we can welcome your panelists on the stage. All right, so this is all about the influencer-led businesses. We're talking about two incredible brands that have already made their mark. First up, we have with us Nikunj Biani, co-founder SuperU, and we have with us Vimarsh Razdan, co-founder and CEO Underneath. Can we have a super round of applause, everyone? We're talking about influencer-led business, and this is the pertinent theme of the hour. I'm really excited. So I'm going to say, Mansi, really excited to see how this discussion pans out. So over to you.
No pressure. Good afternoon, everyone. And thank you so much, Nikunj and Vimarsh, for joining us here at the Mint India Investment Summit. I'm sure all of us would have heard about brands that are on this panel here today at Underneath and SuperU. The theme of this panel is, influencer-led businesses. But if you look at the two brands here, they are both very different on the face of it. But there's much more common with both of them, apart from just being led by influencers, right? If you look at both these brands, they are younger than 18 months. So they are new age stars of the business world. Both Nikunj and Vimarsh have dabbled their way into the business world. Vimarsh is somebody we can call a serial entrepreneur. And Nikunj has, of course, been through businesses and also has a large family legacy from the Future Group. At the same time, both of them are making their consumers look good. One with shapewears, the other with, of course, better muscle mass. So it's going to be an interesting session. Maybe we should start with the fact that both of these brands, when they started in the first 6 to 8 months, they crossed an ARR of about 100 to 150 crores. I would like to start with that and try and understand how that happened, what kind of growth, how did you see that kind of growth, first of all, and how has that worked out since then?
I'll go
maybe
first.
Nikunj, you can go first.
Sure. So thank you for having us here. Yeah, I think, growth is often, a number is often just an output together is when something works. Because if one thing is also out of place, you don't get that kind of momentum. So I don't think it was just one thing that led to that kind of growth. I think there was this whole few things that we did right, which was innovative product, good distribution, good set of marketing, and focus on just building the operational side of the business. But it was the tailwinds that were so strong with just better for you and protein. So I think enough a bit of that kind of enabled the kind of growth that we did get.
Vimarsh, if you can talk a little bit about that, where did the idea, Vimarsh? If you can talk a little bit about that, where did the idea come from? If you can talk a little bit about that, where did the idea come from? How did you get into this business? And why the 4 limited SKUs in the beginning of the business?
Yeah, so I don't know how many people know this, but the idea came on a basketball court where Ranveer and I were playing, and then I had this thought of building for better for you. I've been in the food FMCG industry for the last 12 years. So I just thought that, okay, I understand this space a little bit, so worth kind of taking a shot here. Why just one product and 4 SKUs? Because I've learned the hard way that simplicity solves for way more than what one can explain. And it's in all these hidden ways, And we had very strong conviction on the product. So when we were going to launch, we actually had 3 products ready. We chose just to launch with one because it would give us this single-minded focus on just making sure that this product lands with the consumer. And in a world that's so void of attention, I think when you throw a punch, you have to throw one singular punch. So that's what our strategy on it was.
I would slightly change that question for you, Vimarsh, because I think initially, as a consumer, what we saw was a community being talked to about shapewear and things like that, and then the brand was actually launched. So if you can talk us through that, how did the strategy come into play, and take us through that journey a little bit, the initial journey of underneath.
So I'd say, when I reflect on it now, it seems to be a lot of things we worked out, which also included finding a white space where the big players are not there. Because you can't take the big players head on when you are just, let's say, two credible founders, and then you don't have that kind of a bandwidth and presence and distribution muscle. So it started with that white space, and then we also created a community much before even designing the first product. And we had a lot of conversation with our customers and tried to narrow down how many problems are they facing which are not being addressed by the big players. So I think for us it was reverse engineering, and we ended up having just 12 products, and we said, why make more when either there are not many more problems, or we can't have a solution, we don't have a solution for those problems. So I think it worked out very well from business perspective also, as we say in business, that you have to limit the number of variables, otherwise your P&L takes a hit. And especially in the fashion category where inventory exposure is one of the major risks, it kind of worked out, but I would credit it more to my community than to my founder mindset, that they led us to a very narrow SKU exposure.
That also brings us to the point that, there's a very clear change in the way newer businesses are being built right now, right? What is your thought on that? What was the innovative aspect of building these two businesses, and how have things changed over the years when it comes to that?
Okay, this is a difficult one. I'm a fourth-time builder now, and I have to say it very honestly. I can pick up a very fancy language and say, we cracked a new code, but the fundamentals of business remain the same. As Nikunj also said, you have to solve for the product, the price, the place, and the promotion, and then also the people who actually make all this happen. Yeah. So 5 Ps, as we call it. So, but we also have to see where, for each vertical, what is happening now. For example, let's talk about promotion, which seems to be a very important topic for this context. That promotion was earlier on television, then on print probably, then radio, then television, and now it's on social. Yeah. And within social, it is with the creators now. So obviously, any business which wants to promote will go where the most attention is. And the best way now is to tie up with the creator and say, okay, let's do it. I think that is one difference which every founder has to see, that where have these pillars actually moved, but the pillars remain the same, I would say.
Nikunj?
Yeah, I think the best way to answer that is, today a lot of doors have opened up. So there's this line that I loved, I'd read this somewhere, saying, it's never been easier to start a business, but never been harder to sustain one. Yeah. So I think getting started is easy now, because let's say you are a 18-year-old who has a certain idea. The manufacturing ecosystem in India today is amazing compared to 10, 15 years ago. So that's solved for. Your distribution ecosystem has now opened up. You have a digital direct to consumer option available. And no matter what category you're operating in, everything is opened up now. So the opportunity to start and present product and get and find PMF with consumers there, better than ever before. You could never do this. Like 10 years ago, there was no chance we could have done this. Tested in a small community, tested in a small way, without spending big dollars on marketing, impossible. Yeah. So I think that's the one big change. But just to reiterate what what he said is, the rest of it is the same. The fundamentals haven't changed at all.
Interesting. If we can talk a little bit about the fundraising process, because both of you, of course, in the 18 months or 1 year of your journey, have raised funds. You with Fireside and you with Gruhas and Rainmatter. How was the process like? Because we realize that there's a clear preference with investors for second-time founders, for operator-turned-founders. So with a celebrity on your top deck, how is it working out through the process?
Yeah, so,
I'll take that one.
Yeah, please.
So I'd say that fundraising in India has become easier, but only in context of what was happening 5 or 10 years back. I have, for most of my career, operated in the US or UK. Their risk capital is, I would say, still 100x or 1000x more available than India. A 17-year-old boy in the US can pick up enormous amount of risk capital, which is not there. That appetite still is not there. But we are getting there. I mean, it's a great change from what 5 years or 10 years back situation was. It is easier if they understand that the approach of the founder is good. People are taking bets. Seed round without a product in hand also, I see a lot of companies getting funded now. So it speaks a lot volumes about that, you know, at least the early VCs are betting on founders, and they're trying to assess whether, you know, they have the resilience to go forward, because as he said that starting a business is easy, sustaining is the hard part.
Yeah. There's also a consumer wave going on, right? So you were sort of in the right business at the right time also when it comes to risk capital. Would you?
Yeah, I mean, look, I think the fact that capital is more freely available today is definitely true. Having said that, that's also because there have been favorable outcomes. Yeah. And now those have created their own reference points, right? So I think even VCs getting into this now have a benchmark saying, okay, look, in 5-7 years from now, there is the potential for XYZ to happen. So I think a lot of our peers have probably laid that out for us in that sense. But to answer your question, what's the difference between a celebrity-led brand raising money versus a non-celebrity-led brand raising money? I think bare minimal. Because a business, at the end of the day, you know, numbers don't lie. And that answers everything. So a celebrity doesn't alone solve for everything. The way I like to say it is, again, a large puzzle. A celebrity is one piece. And then there's many other pieces, and then your investors are looking at the overall puzzle, not just one piece of it.
Would love to understand how everyday, day-to-day operations look like. What part of it is Kusha and Ranveer? Are they actually involved in the day-to-day, or is this more from the brand and point of view?
For us, the mandate was that I will be into it full time. It was very clearly laid. Even though you can draw a lot of contracts and have co-founder agreements and have a lot of paperwork, but the essence of it is that you're on mutual understanding. For how we operate is that the marketing bit and also how the brand has to position itself and the voice of the brand. Also, I call Kusha the voice of the customer inside the brand. The role is actually reversed. She represents the customers more than the company.
Yeah.
So,
is that a problem sometimes?
Sorry?
Is that a problem sometimes?
Of course, there are difference of opinions. Of course, there are a lot of things which we don't agree upon. But then at the beginning, we had a mutual understanding that you will have veto over these things, I will have veto over. So we respectfully disagree, and then the person who has the veto moves forward with that decision. And sometimes those decisions don't work out also. And that also has to be respected. I mean, that's how I am functioning right now.
Yeah, so I mean, I'd say same for us, but just, yeah. So when we were launching, Ranveer and I had this conversation, and he said, I trust you with what you are going to bring to the table, and you trust me with what I'm going to bring to the table. And what I bring to the table is this nuanced understanding of content and how to land a certain message with consumers today. And what you're bringing to the table is everything on the operational side of the business, right? So developing a product, distribution, supply chain, blah, blah, blah. And I think it's always been like that. So is he hands-on? Is he involved? Very. Every product is not only approved by him, but also his family. So very involved in that sense, but not in things that he's entrusted me with.
If we can talk about growth a little bit, how does scaling for you look like from here on? Like we were talking about earlier also, you know, the various distribution methods that you will be looking at, and how will you be also looking at offline stores maybe going forward, because that's been a large trend for D2C brands, right? So if you can take us through that a little bit.
Yeah, so I've stopped referring to ourselves as a D2C brand. I just refer to us as a brand. Okay. And the ambition... Why is that? Just because D2C is a channel. We have nothing to do with one channel. Our quick commerce is a much bigger channel for us. So it doesn't make us a quick commerce brand is what I'm trying to say. And at the end of the day, that's how the consumer sees it, right? But again, to answer your question, I think the stated ambition is we want to build 1,000 crore business, and we want to build a strong FMCG company, much like the likes of HUL and Britannia and so on and so forth. And I think for that, we need to build it across channels. So we will continue building on D2C, we'll continue building on marketplaces and quick commerce, because quick commerce is giving us a large opportunity to really build that out, because they're solving for distribution. But at some point, we're also, and not some point, we've already started, but I do see a large channel becoming general trade as well, because no matter what, even with our base of consumers, general trade is a large percentage of the business even today. So we're small on that channel today, but as we get to that 1,000 crore ambition, I think it'll become a large part of our business as well.
Who would you be competing with when it comes to, general trade there? Because like we were talking about, there's protein brands haven't really existed that much before in the general trade.
Yeah, again, we're a food brand, which means we're going to compete with all the big boys. So my competition is going to move from, let's say, a year ago was probably a few D2C brands to now the likes of Britannia. So for example, one of the big categories that we're going to get into in the next 6 months is going to be biscuits. And biscuits means then I'm competing with the Mondelez, I'm competing with the Britannia, I'm competing with a Parle, etc., etc. So that's going to be who we're going to be competing with. Having said that, not in its entirety. So for example, we're not trying to solve for anything beyond 8 to 10% of India. Like we don't want to go beyond that. We don't think we can today, till 1,000 crores at least. So just that part of what Britannia competes with and stuff. So not every single product category.
Got it. Vimash?
So for us, GTM was quite clear before we even started because this category did not exist in India. And we had data points from the West. And India behaves very differently and you can't copy paste that model in India. So for us, owning that first party data was very important. Even though we had a lot of pressure from our marketplace, online marketplaces, we stayed 6 months only on our own website, talking to the customers, understanding our NPS at product level, understanding CSAT, understanding all the metrics, why a customer is coming back and why this customer is not coming back. What are the natural repeat cycles for us to understand all this. So in terms of where we want to go is we want to reach more and more people. We can put a number in context here, which we have put for our investors, but we want to make a large company. And for any other distribution channels, we'll again go very EBO first. Not to scale, but per se to understand. We want to sit and see where the customer is going. Is she picking up a particular SKU or she is just straight away going to what she saw digitally? So it's very important for us to understand the category firsthand and then to scale. Of course, we want to make a large company. I mean, similar numbers, maybe more. Yeah.
Definitely. Are you in offline, the offline store ecosystem?
We are right now only e-commerce led.
Yeah.
We are on the platforms like Myntra, which is going to be larger than our D2C in a few months. We are on quick commerce because we, not necessarily to gain more revenue, because we saw, I was telling Nikunj, we were sitting together and I said, there was so much search volume on these platforms that it felt unfair to leave that. Because today, Indian customer is very spoiled. If he or she doesn't find you on quick commerce, it's a very faint chance that they will go to the DTC platform and then buy from there and wait for 2 days. So gratification, people who are used to quick commerce will have to be served through quick commerce. People who are used for offline will have to be served through offline. So we look where the demand exists for our brand. We see the search volume on platforms and then we go to those platforms.
But do you plan to get into the offline store?
Offline, definitely we'll start with our own EBOs, which should happen in the next 6 months, maybe a couple of them, just to understand customer behavior.
Okay. Interesting. The next part of it would be, how does the next round of funding or things like that look for you, both of you, of course. If you have any view on that, are you looking for the next, it's been...
Always. I believe that there's a lot of investors in the audience. So yes, we are ready for funding. Of course, please DM us and reach out to us and we'll please leave your card here. But we are touchwood in a good situation. We raised our seed round when we did not have product. Our investors believed in us. And within 6 months, we saw what we had committed to them. We'll do 4x than that in terms of revenue, what we had given them as a plan. So within 6 months, they were very, they were great partners because they offered to give us the next round immediately, even without DD, I told him. And of course, the DD happened for reference, yes. But right now, we are in a situation where we are EBITDA positive. We have surplus cash. We don't need to raise like tomorrow. But for our big plans, the kind of numbers both of us are talking about, there will be fuel will be required, and we'll be ready when we see the right partners. For us, it's not only money, it is also the knowledge and the doors they open for us. That's also equally important for us.
Yeah, I hope we don't have to raise for a very long time. So we're not raising right now. We've been able to build the business very capital efficiently, and we want to continue doing that. You'll hear a lot of entrepreneurs joke about this, which is that just fundraising is such a painful journey through
100%,
VC.
100%.
That's the last time I raised, I was like, bus, abhi iske baad aur nahi.
It's the only time, sorry, I have to add this point, it's very funny because I tell my team that, this is the only time, all the time, 99% of the time, founders are thinking, yaar, hum kam kar rahe hain. This is not enough. And when you have to raise funds, you have to put your best foot forward and say, okay, we are the best. And it's not a great situation for a founder to be, at least in the initial 2-3 years.
Right.
You have to always stay in that hustle culture and say, I'm not doing enough. It doesn't mean long hours, for sure. Now technology is at our side. But mentally, you have to be really hungry. And hunger will only take you there where you want to go. And now businesses are going to a large revenue at a very fast pace. And both of us are examples of that. So I think fundraising is a lot of bandwidth taken away from the business for the founder, yes.
And we're also raising debt. So we're going to use debt for all our working capital and all of that. But just, yeah, I'm being a little delusional when I'm saying I'm not going to raise. Because to get to that scale, like he said, we'll need some fuel, but hopefully not anytime soon. And debt can take us a long way as well.
Can you explain why you're opting for debt, not equity here?
We just want to protect dilution. Using equity money for working capital and inventory would be very, very silly. We've made that mistake in the past, but not going forward. So we'll use debt to service all of that, and then use equity money only when we really, really feel we want to take a very large bet, do something very disproportionate, and then build the company from there on.
We have a couple minutes left on the clock. If anyone has any questions, please.
Hi, Sinha from Mint. Vimesh, I wanted to ask you particularly, in the last 5 years, we've seen a lot of content to commerce playbook that was launched by, say, founders who were there in 2020, 2021, and all of that got disrupted. How are you trying to do it differently? Because there is no enough proof that there is the flow of commerce through content. So how are you trying to do it differently? Have there been any learnings? How are you trying to see how content actually flows into commerce?
So I'll answer this question in 2 phases. First phase is I'll throw a few facts to you. So there's a report by Goldman Sachs which says that creator commerce is at $250 billion. And within 1 year, it will be $480 billion. Of course, it's driven by US and TikTok mostly, but that is the way which is happening. Again, for advertising, the OG is Ogilvy, and his latest report, the team's latest report, 2026 report, says it's a tectonic shift in the trust economy that, creators will take over. So these are a few facts. Also, Unilever is going to take 50% of their marketing budget, which is 50% is 5 billion, by the way, to only social and creator commerce. So everyone is moving towards that. There are enough proof points, recent proof points in India and globally, which is telling us that the attention is there. I don't know whether in 5 years it will stay there or go somewhere else. But right now attention is there, and both of us are optimizing for that. And again, just to reiterate that we have solved for the other 3-4 Ps, and this we have been lucky that we have co-founders who are acing at this promotion bit of it.
We have one more question at the back.
Very interesting session. I am Ninad Karpe from 100X. We are a VC firm. So guys, please don't stop raising money. We'll be out of business. But on a more serious note, Nikunj, you mentioned quick commerce a couple of times. My question to you is very simple. Will quick commerce overtake e-commerce, and when?
So, look, I don't know the answer to that. Can it? Yes, it can. Will it? Time will tell. But I think I don't think that really matters. Because at the end of the day, the way we see it from our POV is, there's a customer, there's demand for a certain product, that product has to reach that customer from either this route or that route. So whatever route helps us reach that customer, we'll do that. To the rest of your question, it definitely has the potential to, but I don't know by when.
I think that's about it. On that note, thank you so much, both of you.
Thank you.
It was a lovely conversation. Thanks.
Thank you for having us.
Thank you so much. It was a fabulous conversation indeed. I'd like to request Mansi to please present a token of gratitude to both of our speakers, to Nikunj and to Vimarsh. We'll have a quick photo op as well. Let's have the three of you come together. You know, the green plant is also symbolic to being that asset that does not respond to the markets tomorrow. So it's green, it's prosperous, it's wealthy. But it's also a way for us to say thank you for all the incredible time and insights you've shared. Thank you so much again for joining us. All right, with that, we're now moving on to our next session. And this is where we're setting the stage for another beautiful, another powerful panel discussion. In fact, we're going to set the real estate of this side of the stage, because our next session is all about premiumization of real estate. We're looking at the opportunities and the risks. Now, that being said, let me also take a second to set the context what it is about. Meanwhile, do keep your thoughts coming using the hashtag MintIIS2026 as well as you share your thoughts. We know that India's real estate story is undergoing a dramatic shift from affordability to aspiration. Now, across cities, we're also seeing a surge in demand for larger homes, for amenities, and lifestyle-driven living. So premium, as a term as well, it's no longer niche. It's in fact becoming a whole new mannerism. But with this wave of premiumization, what comes is a critical question. Is it sustainable evolution, or is it an overextension? And our developers, for that matter, are they unlocking higher value, or are they taking on greater risk? There are a lot of questions around this, which is why we've got the right set of speakers on board to answer all those questions and all that more. But first up, I'd like to request all our members of the audience who are still standing to take your seats. Our speakers are set. Our moderators set as well. We have Madhurima Nandi, who's a senior editor, Mint. Madhurima, first up, I'd like to invite you on stage. If I could request our fellow delegates to take the questions offline with our previous set of speakers. And if I could request our team as well to please help me out, so then I can go ahead and invite our speakers. So firstly, Madhurima, thank you for joining us. With that, let me go ahead and invite your speakers on stage. First up, we have with us Harmohan Sahni, Managing Director and CEO, Raymond Realty. We have with us once again Vivek Chandi, Joint Managing Partner, GSA Advocates and Solicitors. And I'd also like to please invite Shirish Godbole, CEO, Knowledge Realty Trust, REIT. Premiumization of real estate. Can we have a real round of applause out there? What a topic that we're eagerly looking forward to. I'd like to request you all to take your seats. We are eagerly looking forward to the session. With that, Madhurima, over to you.
Hi. Good evening. Sorry, good afternoon, everyone. I'm requesting your patience for the last half an hour before we break for lunch. So before we listen to our very interesting panel of speakers, I'll just take 30 seconds to quickly set the context. So India is in the 6th year of a so-called boom cycle, for the real estate sector. And one of the key defining trends during this period has been premiumization. And premiumization not just for the residential sector, but also other asset classes like commercial office or even hospitality and retail malls. So I'll first start with Mr. Sahni from Raymond Realty. If you could tell us a little bit on, because just like affordable, premium is also a very confusing word right now. We don't know whether a 1 crore home is premium or a 25 crore home is premium. So what does premiumization mean in the residential context? And is it something that you think is a temporary trend, like a lot of other things in real estate? Or is it something that has really sort of reshaped the sector in the past few years?
It's a very interesting question. It's like asking what is good and what is bad and what is right, what is wrong. You will never get a straight answer on this, depending on who's answering, which city they are in, where they are, what their context is. So the way I understand premiumization, I think it's a term which is probably coined by the media and not by the industry in that sense, is probably one way of looking at it is in the context of Bombay, below 1 crore or 1.5 crore could be termed as not premium, and anything above that could be premium. Because depending on which location you are in, the price points are very, very different within MMR itself. The price ranges all the way from 7,000-8,000 rupees a square foot and goes all the way up to 1,50,000 rupees a square foot. So that's one way of defining premiumization. And if I was to just reframe this, if you permit me, I'll take 30 seconds on that. According to me, this is not premiumization that is happening, because it will lead to your next question when you said whether it's sustainable or not. It's really quality correction which is happening in my view. Because with the increasing affluence which is coming in India, since COVID, there is obviously a K-shaped recovery pattern which has played out. And most industries are experiencing this, especially the large ticket items, cars, apartments. In any case, after a crisis, people, get into a mode that they want to fulfill all their desires because they probably face death or somebody close to them has, faced their mortality. And once something like that happens, then obviously coupled with that, you have the K-shaped recovery. So income is now getting into many more hands. If you see for last 5 years, the data, I think there are about 9 lakh households which are dollar millionaires in India today, which is twice the number of households which were there just at the time of COVID 2021. So in 5 years, there's been doubling of households. So affluence is widely distributed. While everybody says it's very concentrated, it's because that's very visible, so everybody thinks like that. But it is also widely distributed. If you pick up any report, whether it's Hurun or JLL or Knight Frank or any other international reports, I mean, the data is very clear that there is been democratization of wealth in that sense in India. So people want quality. They want to experience products which they haven't experienced before. Their benchmarks are no longer that there should be a pool. Their benchmark is what's happening in Dubai, what's happening in London, what's happening in New York. Can I get something close to that based on whatever I can afford? So location is one way, they will choose their price point, but they are definitely, this is becoming almost like hygiene. So it's a quality correction in my view. So that's how I would term it.
Shirish, I wanted to ask you, premium housing is something which at least we are familiar with in, the scale may differ. But premiumization in office has been a big, I think, surprise over the last few years. What does it mean when we talk about premium offices? I mean, besides an office lobby looking like a 5-star hotel or, great locations where offices are coming up, what does it mean? And also, what does it mean for, occupiers or tenants?
Yeah, no, thank you, Madhurima. Well, I think all of you probably are experiencing premiumization in office, and I think it's a trend that's here and will continue for a long time. So I think 2 or 3 reasons, let me just quickly outline, and then talk about what it means to be sort of premium office. Number one, I think, India as a whole, and I think in office in particular, institutionalization of sort of space has really started occurring. And, the markets are maturing, right? So 20 years ago, where India was, whether it's residential or whether it's office versus where we are today, is a market difference. So it's really matured. And with that, expectations and differentiation as to how you differentiate from one asset versus the other has obviously gone up. So that's one factor. Second, COVID really was a changing point. A lot of people, employees did not come to work. So to get them back to work, you obviously had to entice them with a lot of amenities, a lot of features which make them sort of feel comfortable coming into the office, right? Whether it's hygiene, whether it's, just gym areas, whether it's play areas, a lot of things to get them back. And the third thing is, I think talent acquisition and getting the best people to work for you is a very, very important criteria for all companies now. And obviously giving them the best space is one of the reasons, besides paying them obviously, but making them comfortable, giving them the best spaces, getting them excited about coming to work, I think is another reason. So all of these reasons combined, I think you've seen premiumization, especially in office. And what it means is not only great lobbies when you enter the building, which is a factor, but all the amenities you might think of, right? So whether it's a gym, whether it's a creche, whether it's a conference room within the office tower so that employees can get together, whether it's game areas, whether it's especially outside of Mumbai, as you go to Bangalore and Hyderabad, you have more campus-like settings. So these are, much more spread out. And so there's landscaping, there's a jogging track, there's a cricket pitch, there is football fields. So there is a lot more that a tenant is offered today. And that is what is really sort of changed dramatically, I would say, in a decade. And I think you will continue to see that. And finally, one needs to differentiate your product, right? So how do you differentiate from one Class A building to another? And I think this is, one way to really distinguish. Finally, I'll just add that the, tenants themselves, in our case, so if you look at a large BFSI, whether it's a JP Morgan, whether it's a Morgan Stanley, or a Google or Amazon, if you go inside their spaces, the amount of money that they spend on their space today is dramatically higher, right? So it may cost X rupees a square foot, but it is not uncommon to have 10 to 15,000 rupees per square foot spent in fit-outs by the tenant after getting in, right? And so when you have that kind of spend, the quality is excellent, and they want the overall building and the experience to match that level of internal quality. So that's how I would put it.
Vivek, if I could kind of bring you in here, that, we heard, both from the residential and the commercial side. But, this so-called flight to quality, as everybody calls it now, does it have any impact on sort of on funding in real estate or institutional capital, into India's real estate sector?
Yes, I definitely think it does. So firstly, I'll just answer the previous question that you raised on what is premium housing. I did some research before this panel, and I was given to understand that apartments in the range of 5 to 7 crores would be treated as premium housing. And I understand that year on year, since last year to this year, the sale of apartments in that category have gone up by 85%. And now to answer your question, yes, I think it's a lot about the money that's there in the market. Today, it's much easier to access funds. REITs now, with effect from, I think, the 1st of July, they'll be able to borrow money from commercial banks. Earlier, ECBs were not permitted, in the real estate space. Today, you can get money from abroad in the form of ECBs. Also, acquisition finance is available. So even if you're acquiring a company, earlier you couldn't use it on acquire on borrowed funds. You can do it now. So all this has brought more money into the market, and people are able to have better quality, premium, residential spaces and office spaces.
Sure. Harmoon, if I could ask you, since we are in Mumbai, and in the last 4 to 5 years, I think the biggest shift that Mumbai has seen is this huge redevelopment, craze or whatever we call it. And now that Raymond has entered into the space in a big way, outside your land bank in Thane, how do you kind of, how do you position redevelopment and sort of premium housing? Because a lot of society redevelopment projects are very premium projects as well. And you have picked up a number of properties in premium locations like Bandra and, Mahim. How are you kind of, positioning your redevelopment projects within the overall premium housing strategy of Raymond?
Yes, redevelopment is a very strong theme which is playing out, particularly in cities like Bombay. In fact, probably only in Bombay just now in India. And there is a strong reason for it. Naturally, for real estate development, you need the real estate, the land. And land is not easy to come by in prime locations as far as Bombay is concerned. While land is available, but you have to go into far off suburbs or even beyond, edge of MMR. But if you want prime piece of land, that's already developed. And it's fortunate that we have a policy of redevelopment in Bombay where buildings which are 30 years old or older can go for redevelopment based on the regulation. There are various regulations under which you can do your redevelopment. And once you have chosen to be somebody who wants to do development in strong locations, deep markets, then it becomes necessary for you really to look at redevelopment as one of the avenues where your raw material will come from, because land is a raw material for us. Particularly, the brand I represent, Raymond, we don't think of land as an asset play and we want to hold on to that land. For us, it's clearly raw material. So we are not looking at signing projects and hoarding them. And the thing is that we have to quickly monetize that asset. The locations are good. Now, within that, premiumization is another theme which will be superimposed on top of that. When you have strong locations, when you have a certain buyer profile that you're trying to address, so it becomes almost necessary for you that you would be doing a certain kind of product which will appeal to that target market that you have chosen. So, yeah, within that also there are nuances now, because there are certain redevelopments where you end up doing composite development, which means in the same building you will have the existing residents and the new buyers will come in. Now, how does that mixing work? Does the profile match? It doesn't match. Can they afford the payment for all the premiumness that will come with redevelopment? Because your outgoings can change. Your property taxes can also change, because as you build a higher quality asset, the government also changes the tax norms. So those are the kind of nuances how we are tackling it is that we are looking at larger projects where we can segregate the existing population from the new buyers. So there is a choice available to both populations as to how they want to live the rest of their life.
And for the free sale component of these projects, how will Raymond kind of position these projects? Will these be super premium? What kind of positioning will these projects have?
Yeah, so our chosen strategy is that we want to stay in deep markets, and that necessitates really that we are not looking at either at the bottom of the pyramid, because that market is not been doing well for the last almost, even pre-COVID it was not doing well, and after COVID it suffered even more. And we are not looking at uber luxury also. We are not looking at 80, 100, 50 crore worth apartments. We want to address the largest segment in the market, which is ranging between 2 crores going all the way up to 10, 12, even 15 crores. The products are always going to be in line with the brand ethos. So Raymond stands for trust, quality and excellence. So quality is a given. That's something we are never going to compromise on. And in the name of premiumization that you're saying, and all our projects have, whether it's a 2-bedroom community, it will have all the bells and whistles and amenities. typically in our projects we have 30 to 50 or sometimes even more amenities that we can talk about.
Sure. Shirish, I wanted to ask you, you did mention about, this whole, the kind of money that companies spend on fit-outs and interiors, okay, something that we'd never heard of that kind of thing before. In all of this, what is the role that global capability centers have played in kind of upping this whole interior and...
It's a very big part of it, But before I go there, let me just sort of point out I think maybe people are aware, but I think post-COVID we have seen an incredible phenomena, right? Where while there has been democratization of wealth, Harmon, I feel like unfortunately there has also not been as much. Where I think the people who were promoters or who were working for promoters or CXOs of promoters or in that sort of inner coterie have made a ton of money. And so what's happened is this class of people need to spend that money or invest that money elsewhere, right? And that's partly why premiumization over the last, especially half decade, has really gone up, because these people have had the wealth to spend, and then you can't take the money outside the country, really. And so what you're doing, and we as a REIT have also benefited, and so IPOs and investments into the sort of capital markets have gone up, and it's all related to this whole phenomena. So premiumization, investments, the amount of money going into the stock markets, IPOs, they're all sort of connected. Where there has been wealth created, it can't leave the country, it has to be invested, and real estate is in the heart and soul of most Indians, right? And so it does get invested, and that's kind of why, we are where we are, I feel. What the story now is what's going to happen in the next half decade, which will be interesting to see, but hopefully, we're able to continue. But coming back to your question about GCCs, that is a very big part of the story, right? So global capability centers are really changing, I would say, how much demand there has been for office, and that has also had a trickle-down effect on every other part of India, including the 2 to 10 crore purchases, I would say. So while there has been high wealth, which is, spending it more than 10 crores, but the people buying the 2 crore, 3 crore, 4 crore apartment are typically service-oriented economies. They're working maybe for a BFSI like a Morgan Stanley or a JP Morgan or a GCC. And the more GCCs that are entering the country, those numbers have been staggering, how many million jobs they have created over time, and I think will create over the next half decade despite AI, etc. And so all of that means that they want the best employees to work for their companies, right? And if you want to attract best talent, as I was saying before, they feel it's part of the overall ethos or equation that you need to provide. And as part of that is where this whole premiumization of office has also come up, where you need to create an environment where you attract the best employees, and because you're doing that, you have to spend money, and so that kind of fit out is okay. And also more and more of such companies are coming in, so everybody's demanding this space, sustainability, ESG features, so all of that have become tenant demands, really. So it's no longer an option, honestly, as an office owner. We have to provide these amenities. It is absolutely required, and the more GCCs that come in, the more that demand is going to go up. And distinguish between what we call Class A and then Class B or C buildings, because the B or C really are going to suffer relative to what amenities and packages the Class A providers provide.
Sure. Vivek, your thoughts on this? I mean, you spoke about acquisition financing a few minutes back. And, as a lot of developers also try to sell, their commercial assets to, say, REITs, okay, do you think other developers also have to kind of pull up their socks and, build at par with the kind of standard that MNCs or GCCs kind of demand?
Absolutely. So we've represented several GCCs who've spent several thousands rupees per square foot on their fit-outs. They've required developers to build them build-to-suits. So now the developers are really up their game, and even when they are developing themselves, they are developing premium buildings and then tenanting them and then selling them to REITs. Now the good thing, which is slightly off the topic, is that we facilitated several $1 billion of sales to REITs, and we found that REITs are very careful about what they buy. They typically, even if there's a office building that is fully let out with very high rents, they won't touch it if, for instance, there's a significant overbuilding or the zoning is wrong, even if they've got a great tenant. So I think that has brought some discipline into the market with the REITs coming in, because REITs are regulated. And that, I believe, is very good. You find otherwise, here we are dealing with top developers, but you find smaller developers often cutting corners, building twice of what they should otherwise be building. I think hopefully that will start coming down.
Harmon, I wanted to ask you, I mean, and this is, particularly about residential real estate, because real estate developers, if I may say, always have a sort of herd mentality. So if 2 developers are doing luxury, 10 other developers also want to do luxury. So this ongoing trend of, chasing luxury projects or luxury sales, is this something that you think will continue? Or as soon as the market plateaus or, the market turns, developers will again start talking about mid-income and affordable housing projects?
Okay, interesting question, and I get this asked quite often, and typically I avoid answering it, but since here there is an audience, and before I go there, there's one thing I just want to come back to you on. You talked about money needs to be invested. So when we are talking of ticket size between 2 and 15 crores, our experience, at least in the last 5 years, including this quarter, 80% of that demand is actual user driven. That's been our experience. I don't know what the other developers' experience is. I reckon it is a good, anecdotal evidence that if ours is, and we've done significant volume in the last few years. So if that is the case, then it's really demand which is broadly based, and the assets will actually be put to use, and they will not really be. I don't know so much about when we are talking of super luxury and luxury. There may be some element. I don't know. I can't answer that because we are not in that segment, but I'm just guessing.
I was just mentioning like a 360, with the amount of apartments they have, which are all at 50 crores and higher, those kind of.
Yes. So buildings like that, some of those buildings are ready, and 60-70% of the stock is still unsold for various reasons. And one could be because they're waiting for buyers. One could be they don't want to sell to the buyers who are approaching them. Third could be they want a price which nobody is willing to pay today. Maybe it will be paid tomorrow or day after tomorrow. There could be several reasons. So without going into that, now, if I was to unpack your question and look at the nuts and bolts of it, you come to first principles, which is basically why does industry like real estate have cycles? Because what you're really asking me is, are we at the top of the cycle? What if the cycle turns? What's going to happen? That's really the underlying question. So to unpack that, we have to see what does a cycle comprise of, and why do we have cycles? One is, of course, demand and supply, availability of money, macroeconomic conditions in the country, which means the interest rates, how they are, inflationary trends, how they are. And if we look at some of these fundamental issues, India is, of course, a growing economy. It has been growing. So if I was to look at, even if I didn't believe government's number, we are still growing at 5-6% for sure. And if you believe government numbers, we are growing at 7+%. And I would rather go with what institutional number is there for want of a better number. Otherwise, it's all guesswork. And then inflation being the way it is, there is nominal growth of at least 13 to 15% in the economy every year. So that's money going into the system. Banking system is very strong just now. A cleanup has happened a while ago, and the balance sheets are pretty good. Banks are ready to lend, and maybe my friend can shed more light on that. And I had the privilege of being in the financial industry for 3 years, so I can claim little bit of knowledge, not too much, but yeah. So from that knowledge, I believe those balance sheets are strong. Inflation is not very high. If you look at demand supply today, demand remains strong. And supply position, any report you pick up, depending on which report you pick up, who's speaking, they are talking between 18 months to 24 months of supply, which is there in the system.
But my question is on, will developers continue chasing luxury projects even when the market sort of falls flat or turns or plateaus? That is my question.
So let's look at the past, because history is a great teacher, right? It cannot predict the future, but you can learn from it. So historically, if you see every cycle, and this is the 5th cycle that I am seeing in my career, it's been almost or little over 30 years that I've been in this industry. So every time this happens, when the cycle goes down, then affordability is what always matters. So everybody wants to downsize the apartments, cut down the cost, because it's risk off, right? So if you want to be risk off, what will you do? You will reduce cost, you will decrease the ticket size, and necessarily that means premiumization will get reversed to some extent.
So are we anywhere close to that mark?
No, but this I am telling you theoretically. Now, every cycle, now, so there is a minimum standard in every industry which gets lifted in every cycle. Right? The cars that you were used to a while ago, I don't think anybody's ever going to buy an Ambassador or a Fiat today. No matter where in the cycle you are, what happens to economy. And same is the thing with houses also. If you see every 10 years, the benchmark gets reset. So the watermark where it was rises and nobody wants to go below that. So I don't think it will get reversed or we are anywhere close to that. There is no evidence whatsoever of the cycle turning as of now. I don't know what's going to happen tomorrow, but today it's not there.
Sure, I'll quickly, because we are running out of time. Shirish, I'll quickly go to you. That is, in the coming 2 or 3 years, what are the new interesting trends or patterns that we should expect from the commercial office sector after what has happened in the last 4-5 years? Are we going to see kind of, this trend continue? GCC demand remains intact? What should we expect?
Yeah, no, I think it's more of the same, honestly. So I think the GCC demand is intact. I think at least in our foreseeable future, looking at the kind of discussions we're having, the meetings with tenants, the existing tenants want to expand, and new tenants who have never been in India before, want to come here, right? And so there are, I want to say, 20 requests for proposals, RFPs that we know of, which are large, I would say over 250,000 square feet, ranging to 2 million square feet in Bangalore, in Hyderabad, in Gurgaon, some in Mumbai as well. So,
but now that you're mentioning cities, I just wanted to quickly ask that this whole India office story, this continues to remain in the top 6-7 cities, right? This is not going to trickle down to tier 2 or beyond.
So I think it is talent driven, right? I think the question is, can you get the same level of engineers? Can you get the same level of, quality service if you go down? So, and I think it will happen because I'll tell you the costs are going up, right? And so part of the reason that the GCCs come to India and why we've been successful is cost. So if you can go to, I'm just saying, a Coimbatore or a Lucknow and get the same quality, I think you will see some portion of the GCCs going there as well. So I think that'll happen.
Vivek, any closing thoughts? And we can
I kind of agree with that, but we are seeing a lot of, in fact, talking about GCCs, there are about 1,800 in India, and many coming in. In fact, at the moment, our firm is, working with about 10 of them who are actually looking at India entry. So I think it's just going to get better and better, but people are looking at smaller cities because I disagree to some extent about talent. Because a lot of the talent over the past few years was moving from smaller cities to bigger cities like, Bombay, Bangalore, Hyderabad. And now I think, say you go to a Coimbatore or a Pune or a Nasik, you'd probably have, enough good people to set up a 500 people GCC. So I think some of our clients are actually looking at, and we're doing something in Coimbatore, we're doing something in Mysore, and I think that's something that's going to change in the future.
Great. Thank you very much, and thanks for coming in today, and thanks for sharing your thoughts with all of us. And
Thank you so much. Madhurima, I'm going to request you to present a token of gratitude to all of our speakers. And I know the conversations will continue, which is why after gathering food for thought from our speakers, let's put your thoughts on food, and we'll do that for the next 45 minutes with a lunch break. So I'm going to urge all of you to head to the pre-function area. Of course, you can please connect with our speakers as well to take any queries, discussions forward. But please do enjoy the lunch, and see you all exactly in 45 minutes. We'll begin our next session at 2:30. Madhurima, let's have you join in for a photo op. And ladies and gentlemen, please do take care of your belongings, but see you all by 2:30 p.m. for our next session. Thank you. Everyone, we're about to get started and gear up for another panel discussion coming your way. And that being said, meanwhile, I do hope you've managed to also take a look at the intro bot. That's how you're able to connect with one another. We are making connections more meaningful. And at the same time, it could also lead into some business partnership as well. So we've utilized AI to ensure that we create those connections over here. If not, you can go ahead and scan the QR code one more time, or you can scan the QR code on the tent cards that have been placed on your tables as well. So as you continue to do that, meanwhile, let me also inform you that we're about to right away get started with our next panel discussion, which is all about democratizing wealth from private banking to retail platforms. Again, another pertinent topic at the summit over here, and we've got our leaders lined up here, all set to share their thoughts with you all. But first up, to spearhead the session, we have with us Alokesh Bhattacharya, Deputy Managing Editor, Mint. So, Mr. Alokesh, let's have you on stage so that you and I will go ahead and welcome your speakers. Well, with that, first up, let me please invite on stage Nikhil Agarwal, founder and group CEO, Drip Invest, to please come on stage. Mr. Nikhil Agarwal of Drip Invest, thank you so much for joining in. We have with us Vineet Malhotra, co-founder and CEO, Compound Express, and Deepak Daga, Head Strategy and Investor Relations, Geo Financial Services. Can we have a nice, wealthy round of applause there? We're talking about democratizing wealth. So let's continue gathering insights from our speakers, and let's do that with another really gripping session, if I may put it that way. So with that, Mr. Alokesh, over to you.
Yeah, I can't see the timer. Hi. It's probably the most difficult session to do, the one immediately after lunch, especially if you've had rice. You know, which I did. You tend to feel sleepy.
We'll make sure it's extra interesting.
We'll make it interesting, yes, indeed. And we are talking about democratizing wealth through markets and products. And as we all know, especially in equities, like Vineet pointed out when we were just chatting outside, you know, ever since COVID, the participation of retail investors in the market has skyrocketed like anything, right? From very, very low shares to very high share, whether you call it a success of the mutual fund Sahi Hai program, or whether it's, you know, people just realizing that, boss, COVID hai, I can die tomorrow, let me just try and make as much money as I can. And that thing has really carried through. Even today, there's huge, huge participation. But we'll here focus on bonds mostly. And, you know, if you look at it, more than 800 million UPI users today, each carrying a smartphone, bank account, and most importantly, the mindset to transact online, which was not there earlier. People used to be really afraid of frauds. Now, there is also growing affluence and the regulator, SEBI's tailwinds, right? For example, higher mutual fund distributor commissions in smaller cities, lower ticket sizes for bond access. These mean that the full spectrum of investment products can now truly reach a mass market. But is it really able to do it? Are we getting there? And these are the people who are making it happen behind the scenes, who are with me on stage today. So we'll have a conversation with them to find out what it entails. We'll start with Deepak. Deepak from Geo Financial. So just for reference, Geo Financial has about 500 million telecom subscribers, which is like a huge, huge base. But even otherwise, from an industry point of view, when you look at things that are happening around, what does this, you know, the theme of the topic, democratizing wealth, really mean in practice? Is it a distribution thing, product problem? Is it a trust and financial literacy issue? What's your view on it?
See, I think it's a mix of all of them actually. It's not like either product or kind of a distribution or a trust, but I would say the starting point is the trust. You know, if you look at the, unlike say a lot of other products, you know, where the platform has to take a call. For example, if as a platform I'm lending someone, the risk is more on the me. The borrower, that much the risk is less. But when someone is parting their own money, the same diligence that person does when they look for a platform. So I think the trust, and I think that's where there's a bit of a lack in the industry, more particular on the bond side, if I were to say. On the equity side, people have started understanding, especially thanks to mutual funds, say a campaign and all those. But on the equity trading side, unfortunately, a lot of the screenshots which get shared on the Twitter and all those, that has not helped much and people have lost money. And that's where people are a little bit scared. So I think as a relevant player in the industry, one of the key roles all of us have to play is kind of educating investors and kind of also ensuring that the products which are designed and kind of sold to a particular customer are relevant for them. Right. I think that part also is not happening. Unfortunately, financial services have of late become more like financial product factories, which is not really supposed to be. By definition, services is supposed to serve the customers. That realization has to come sooner than later. And the third part, I think distribution, partly due to the regulation, there were thresholds in terms of what people could enter certain market and segment, for example, bonds and equity and all those. And also the channel through which it was kind of catered to. Historically, if you look at, for example, on the wealth side, it was, again, more of a high net worth, RM-driven kind of a model. Thanks to the technology and the rising, the middle layer, as we call it, the affluent and the mass affluent, which is amenable and able to being catered through technology and app. So that distribution kind of is the third layer which needs to be solved. But more importantly, everything has to start with the trust and investor education to make them comfortable to be, part of this entire ecosystem.
Right, absolutely. So I'll come to Vineet, after that. And basically, most consumer fintech in India has been about remove the middleman, right? Bring an app and say, oh, you want to invest in stocks, but aise kar lo. Just scroll and pick and you're done, right? No complicated laptop screens and all that. But your company, Compound Express, is doing exactly the opposite, right? You are betting that the MFD, the RIA, the FA, the IFA, they are not going to go away. So what is the thinking behind that, and how does this work? What makes you so sure that this is the right way?
Okay, I'll try my best to answer that. Firstly, thanks everyone for joining. I hope you can stay off your phones. I know it's hard after lunch, but bear with me.
Yes.
So I'm going to ask the audience a question to wake them up, okay? When was the last time you went to a doctor who had one stethoscope and one thermometer in his hand? And he stuck the thermometer in your mouth, right? And then diagnosed you. When was the last time you did that?
I don't remember.
Rare, right?
Yeah.
Now, using that analogy from the medical world, there are MRI machines, there are X-rays, there are modern blood diagnostics, right? Why should the average investor be deprived of that? So, to answer your question, whilst others may be trying to treat the patient, we're trying to treat the doctor.
Indeed.
And I don't say doctor treating the doctor, but we're trying to enable the doctor.
Yeah.
Compound Express, the company that was born, out of the DSP group. Aditya and I co-founded this. I've moved back from the US to India about 1.5 years ago, just with the sole objective of taking all this institutional knowledge, packaging it, and making it available to the distributor, so that the end goal of serving the investor is good. The second thing is there is perhaps a misconception that the distributor does the transaction. The distributor owns the relationship, but the actual transaction is done by technology. Okay. So when you work with advice, relationship, and the experience, all three in the same box, it's a lot more powerful way of serving the customer than trying to give a point-to-point solution of here is this mobile app and go and just buy something of it. These are long-term relationships, and distributors need tools to serve them. So that's why we went that way. Of course, you know that in India there are, still a large majority of funds are, through the assisted channel. As I think as a race, we like things assisted, right?
Yeah.
We have somebody to do something for us all the time. So therefore, we like to play to that assisted channel, and I'm a believer that everything today will be very hybrid. There will be a space for those who want to DIY themselves, and there will be a space for those who want to do it in an assisted way. So we are trying to help reach the end investor.
So what's the advantage of assisted? Is it the expertise that comes with it?
I think the cost of intelligence has really dropped today. So making these distributors and advisors more intelligent using tools, that's one. Second, helping customers to blend their portfolios and see the end result. Simulations, tools, analytics, the speed of completeness. There are a lot of advantages that we'd like to bring in.
Awesome. Sounds good. So, Nikhil, Grip Invest is in a very, very interesting space, right? You're in bonds and fixed income for retail, and bonds, like we were discussing, something that not many people understand very well and are hesitant to probably walk into. And these were entirely sort of the preserve of HNIs, right, and institutions at some point. So tell us, what specifically changed on the regulatory and the market side that that made you believe that this is the right way and this is the right moment to do this?
Yeah, so one is that bonds have existed for decades in India. Every year, Indian companies issue over $100 billion in corporate bonds. And as you correctly said, this has been largely the purview of institutional investors and family offices. I think SEBI, with all of its wisdom and data, realized that the performance of bonds as a product has actually been incredibly stable. Default rates have been low, investors have got their money back as an asset class. And I think looking back at the data, they saw an opportunity to now reduce this or make this available as a product for retail investors. A few things changed, and both to Deepak and Vineet's point, they enabled both trust and access. So a ticket size of transaction of bonds earlier used to be 10 lakh rupees in 2023. Right? Today it is 10,000 rupees. So SEBI reduced it by 99% in 2 years. That's not an incremental change. It's a fundamental shift in how SEBI has thought about the access to bonds happening. To solve for trust, they ensure that every bond transaction now gets executed on a stock exchange. So there is no money movement that happens, or money does not come to a platform like GRIP, but actually goes to the exchange and the bond gets credited into a customer's Demat account. The government of India then followed up with changes to TDS to make it more accessible. And finally, I think there's a lot of change happening to what Vineet said, where the role of the RI, the IFA, the MFD continues to be very important in India. And SEBI is now working on a policy to actually allow the distribution of bonds to also happen through third-party distributors. So across the board, from transparency, access, quality of product, level of information, ease of distribution, all of that has transformed in the last 2-3 years. That's the opportunity we saw at GRIP and went after it.
And have you seen outcomes also based on the opportunity? Are people going for it?
Yes, I'll talk about just give you some numbers from an industry perspective. 3 years ago, or 2.5 years ago when this happened, we were obviously at $0 invested in bonds. Today, that number annually is about $3 billion coming purely from retail investors. We are seeing the market grow almost 300% annually. What is very interesting for us is that almost 50% of our users are now coming from below top 15 cities. So it's also happening, the demographic spread is happening quite wide. That 10 lakh ticket size has now translated into an average ticket size, which is in the 50,000-60,000 zip code. And investors who come into bonds are transacting maybe 8 times in a year. So every second month coming back to make a repeat transaction. So highly compounding investment behavior, which obviously suggests that the product is working for them.
That's good news for the bond market, I guess. And it is spread across different kinds of bonds, or is there a certain bias towards a certain type of bond?
So we offer everything from AAA to BBB, investment grade, but retail investors have a bias towards yield. At a AAA, they would rather invest into an FD because it gives you similar kind of returns. But when you come into the A category, it's 10 to 12%, and that's what's most attractive for a retail investor. It's a good risk-reward benefit that happens, and so that's what we see the bias towards.
Right. Some stunning numbers, growth numbers, Deepak, from Nikhil. 300% you said, right? Awesome. What does that do to, the advisory platforms like Geo BlackRock itself? Just for reference, again, you have launched with an advisory platform with 10,000 rupees minimum and a flat annual fee. And there are other advisory platforms, doing different things. What is this advisory community, if I may refer to it as such? Who are they trying to serve? Is it they're trying to capture the underserved middle class, or like Nikhil said, people beyond the top 15 cities? Or what really is the target that you're looking at?
I think if you look at, the India pyramid, and I think that is a well understood stat, so I'm not going to just repeat the number, but broadly, if you look at, there are almost like 300 odd million people, which we call is the, below the mass affluent, and then there are mass affluent, HNI, HNI. Historically, wealth management, by definition, when we think was always a forte where kind of UHNI and HNI kind of used to get catered. And partly that was also the function, the way the industry was working, right? You have expensive RMs, so obviously the economics just doesn't stack up if you go down the line. Thanks to the technology, I think the middle and the affluent and the mass affluent, as we call it, that certainly becomes serviceable through the technology. That's A. B, obviously, as the country grows, we cannot be having India growing at 8-10% over, say, next 10-15 years without the entire pyramid also increasing their income, with disproportionate coming from this middle layer. That's how any country will kind of grow, right? And suddenly you have a segment which was never kind of thought and served, which has an aspiration and has the wealth. And by the way, they are not used to the classic old way of being serviced. They are okay, they are amenable to technology, and kind of, as and when you move up the curve, then obviously there are new products which get added and there you require a service. So at least the way, at least I see it, eventually in the end state, it's a hybrid model, as he also pointed out, a mix of a human and kind of a machine. Machine, I think, does a lot of the part which they're supposed to do, and human do the more of the higher end of the work. So, the portfolio rebalancing, kind of, onboarding, KYC, asset allocation, and all those. The machine will be able to do it much more sharper, with much more rigor, and unbiased way. I think where the human element becomes relevant is more about the human psychology. How you kind of ensure that the client holds the portfolio and doesn't give up to the volatility we see in the market. Like, for example, what we have seen over the last few months or so. So you really need an advisor who have gone through those cycles, seen that, and kind of make you believe that, there is enough long runway for the growth and you continue to have certain portfolio and allocation. I think that's broadly how kind of we see the entire spectrum.
Awesome. So, Vineet, if you can just add to that, if you look at especially given that your experience with BlackRock in the US and in the Asia Pacific, there would be some learnings into a market like India, where we are still on a growth path really in this and more of an nascent thing. So if you look at the average MFD in a tier 2 kind of city, what is the biggest gap, between what they need and what the market is giving? And what are the learnings that you can bring in from outside?
Yeah, look, I think we'll leave BlackRock and all aside for a moment. Let me tell you one simple stat. What percentage of MFDs have an email domain which is not Gmail, Hotmail, or Outlook? Anyone wants to guess?
You're giving some really good questions.
Yeah. So what I'm trying to tell you here is that we're at a very basic level.
Okay.
Okay. Less than 5% of MFDs have their own domain. Really? We talk about some pretty big goals here. So every country has its own unique dimension. I'll name 3 countries and tell you the difference. Sure. US is all advisor-led, tech-enabled. All right. If you go to China, it's all peer-to-peer influenced buying. Now, when you come to the Middle East, it is all trust-based. Unless I've shaken your hand, I'm not doing any business with you. India, again, I go back to my point, we are hybrid. We like to take the best of everything and bring it here. So we've got all types of models. So tier 2 city MFDs today have one very important thing which nobody has, and that is the client's trust. And anybody who can enable that trust will be a winner. The other thing is products. Their availability of products, if you go back 10 years, a 5,000 rupee SIP was, whoa, that's such a winning moment, right? We did a 5,000 rupee SIP 1 decade ago. Now a 10,000 rupee bond purchase on a mobile app, that's the new frontier. So we've got to enable these guys with more products, and my dream is that every MFD or advisor will become a private banker to their client. There are only 15,000 people in India who have a private banker. Look at the disparity here. We talk about private banking, but there are only 15,000 human beings. In a country like the US, there are 450,000. Granted, it's a very different economy, and I don't like to compare India, US. That's not the point. The point is these people should have access to these products should be accessible by a lot more people. And therefore, technology will play a very big part in whether it's bringing bonds and fixed income to these folks and allowing them to simulate their portfolio, knowing how a bond will feature in their portfolio. And that's where the MFD comes in showing them that entire experience with the right tools.
So what is a good share of the portfolio for bonds today?
Today? Yeah. My share?
Not yours, for them.
It varies, right? I think we go back to the whole point of risk profiling and your tolerance and your customization. We are living in the world of hyper-personalization. It's like asking me, who makes the best suit?
Okay.
I wouldn't put a number there.
There would be a range, no? About 10%, 10 to 20, less than 10.
I think it'll go back to market cycles, it'll go back to asset allocation, it'll go back to your individual risk tolerance. There is no set number. If you ask my grandfather, it was 100% FDs, right?
Yes, my father too.
Sorry, I'm not going to give you a number on that.
Yeah, maybe I can change that question if I have to take the liberty to say how many people have access to bonds today. Because the investment decision is a bit different.
Okay,
I think
question changed.
That number, to me, is probably still maybe 20%. Okay? And I think that's the big opportunity to solve. And bonds I'm using just as a placeholder for financial products. Even other financial products, awareness, access is still needs to be solved to a large extent.
Both Vineet and Deepak spoke about trust. Where are we on the trust scale, really? I have a specific question for you also, but before that, you didn't say anything about trust so far. Sure. So you tell us a little bit about there has been a lot of thing about advisors and trust issues with advisors and all. So where are we on that? Of course, SEBI has done a lot, like we mentioned before. But your views on where are we on the trust scale? Are we much improved from before, and why?
I think we're certainly much more improved than before. At the same time, we're living in an age where it is very easy to fake and very easy to create mistrust. At the same time, people have the ability to get access to incredible amount of information very transparently, very cheaply. So we're living in a funny situation. I think the regulator obviously has a role to play. But platforms like us, platforms like everyone here on the platform, on the stage, has a role to play in making that happen. If you ask me on a score or an index, I think generally the trust element is still not where it needs to be from an investment product perspective. I was meeting someone in the audience today who were talking about cooperative banks, and the trust element that happens there is fundamentally different, right? What you talk about Middle East is fundamentally different. But definitely as a country, we're a low trust economy, and that plays out in investment products.
Sorry, I'll just take the trust thing 30 more seconds, but Deepak, what if trust is not exactly where it should be at this stage, the trust scale, what is going to take us there? Is it going to be regulatory push, self-regulations from advisors, or what's the way?
I think there's little honesty on the regulatory side. It's more as an ecosystem players, it's more our responsibility. And if I can just add, I think the way to think of democratization is not only about access, it's also about relevance. So once you have access plus relevance, that's where the trust gets built, right? So somebody knows that this product is not being just sold to me because someone else is making money, or this is the only product which he can offer, right? It's basically really understanding you and giving you the right sort of thing. And it takes time to kind of build it, but I think once it's built, then it's really, really very sticky.
Right, awesome, okay. So Nikhil, I'll come back to you, that specific question that I was referring to. So, Grip Invest has built a B2B2C model, right? Where banks and fintech platforms, they integrate your bond distribution. I'm having to read this because it's rather complicated. You do a lot of complicated stuff, infrastructure, right? Rather than you building it, yourself. So for a fintech, right, that has been thinking about adding fixed income to your product suite, what does that integration look like, right? And why don't you just do it in-house? Yeah. Isn't that easier?
Yeah, no, this has been a very interesting last 12, 15 months for us. To what you started earlier, if there are so many people having some form of fintech app, primarily a UPI app, the question that we were getting asked is, as a fintech provider, as someone who's helping with payments, why can't I do more for my customer? It could be digital lending, it could be investments. And so those questions gave us the opportunity to think about a B2B2C model where customers can come to Grip, but customers can also use their existing application to buy into a bond. Over the last 1 year, starting with Tata Neu, Grip now offers bonds on ET Money, MobiKwik, Paisabazaar, HSBC Bank, and Vineet, if I can take the liberty, very soon Compound Express, allowing whether you're an advisor-led or direct-to-customer access these bonds. To your question, I think every investment product creation, the trust behind it, the regulation, the compliance, the customer experience, the technology is nuanced. And for a platform who is doing a primary job of payments or lending or advisory, it is often hard to build the back end of it as well. They can't do both jobs in the best possible manner, which is where a partnership becomes very powerful. Think of it like an embedded finance partnership where Grip does the heavy lifting on the nuances of bond,
and the platform does the heavy lifting on the nuances of customer experience and distribution.
Right.
And that has worked very well.
Right. So Deepak, tell me, we like Nikhil gave some astounding numbers some time back, and looks like bonds are getting more popular, right, among people. But what will it really take? Are we then on an autopilot, and things will go like 300%? Will it keep going, or is there something extra that is needed to bring investing in bonds to the mass market and make people like Vineet maybe a little less shy about giving numbers as to what should be the share in your portfolio?
No, I think, absolutely. I think there are 2-3 things. One, obviously, that awareness quotient that has to increase. I think we have to also look at the entire historical trajectory. As I mentioned, the product distribution and the kind of the trust part, right? On the product, or let me go to the distribution. On the distribution side, partly due to the regulation, the 10 lakh cap and all those, it never took off. Thanks to 2023, the changes. Now, obviously, it is just the distribution has kind of opened up for the rest of the middle and the affluent, as we call the segment, right? On the product side, obviously, historically, again, given the nature and the regulation, nobody was actually focusing also in terms of designing and customizing products for catering to these markets, like SDIs and some of the other special constructs which has come in, especially for the retail. So that is the second part, right, which obviously has to change. But more important, the third part is about the trust and the awareness among the masses. And obviously, there is a kind of an inflection point which comes in any industry. We have seen that in UPI. We have seen that in mutual fund industry. Hopefully that comes in the bond market as well. But my sense is it's going to take at least some time, before that awareness and that influx point kind of comes in. And for that to actually make it happen on the ground, again, the fourth part, which is again important, is the relevance part. As we start distributing these products, we have to ensure that people really have a good outcome at the end of it. It's not really about just making them the product accessible. It's also ensuring that at the end of the 3 or 4 year, whatever the goal they had in mind, that is actually being achieved out of that, that will only drive the consumption and the usage.
So tell me, do you need a bond market sahi hai kind of campaign to make the tip into the sort of the UPI moment? And this question is to all of you.
Maybe I think we could do that or some similar version of it. But I think one important call out is, and there is bond market jo mere liye sahi hai. So it has to be a very customized kind of a thing. And we have to appreciate that India historically has been an FD market. So that journey to kind of a BBB kind of a bond is while the yield looks attractive, and as Nikhil said, people are typically more yield chasers. But we should also tell them that these higher yield also come with some kind of liquidity. It also comes with some interest sensitivity. And there are a bunch of other credit risk also involved there. As long as we are able to make people aware of the conscious choices which they are making, and with some kind of, the specialized product much more broader than just kind of a standard corporate bond out there, I think we will have the market kind of picking up.
Vineet?
So, Alakesh, I'll just use my medical analogy here.
Okay.
So bond market...
I love your analogies, by the way.
Bond market, say, is like a vitamin, right?
Okay.
You can't substitute vitamin for a healthy lifestyle. So the first and fundamental thing is people should follow a healthy lifestyle with the right mix of ingredients. True. And bond should become part of our staple diet. Yeah. Once that happens, you can infuse things with campaigns, awareness, etc. But the crux of it all, I feel, is data and the transparency that you can provide, and that can only come through tech. And that tech, once you know your risks, to Deepak's point, your risks, your returns, your illiquidity angles, all of that, customers will be far more educated and be more receptive to bonds.
Awesome. Nikhil?
I think we have all the ingredients to make bonds a mass market product like equities or mutual funds. I won't put a timeline to it, but it will happen. The campaign is a boost in the arm to do it, but it will happen one way or the other. It's just a matter of how.
Okay. We are out of time. I have several more questions to go, but which I unfortunately cannot ask. But one question I will definitely ask, and Vineet, you have got to give me a number this time. Okay. In 5 years, what percentage of Indian retail investors will hold a bond? You gave a certain number, but in 5 years, what's going to happen? All three of you need to answer.
Yes. So this is a forecasting guide. I think Claude may give you this answer as well. But if I'm to guess, I feel like, about retail, if I split retail and institutional retail, we should be seeing somewhere between 8 to 10% of pure retail. And I think if you look at the overall through debt funds, etc., I would hope that number is more in the 35 to 40% range.
That's a lot. Nikhil?
Bonds today is where equity was 10 years ago. From a penetration perspective, we're at 3% of the entire market. In 10 years, I'd like us to see 15% of retail participation owning all of bonds in India on the pure direct side, and much larger allocation through debt funds.
Okay.
No, 10 years, definitely, I think 15 to 20% is where I see.
5 years.
5 years, thoda sa tricky hai. 5 years, I think, will be more will be 8 to 10%. But 10 years, mein to it has to.
We have consensus. That is awesome. Terrific. Thank you so very much. It was such an enlightening conversation, and I hope all of you start pumping your money into bonds starting right now. Thank you very much for listening in. Thank you.
Thank you. Thank you very much, Mr. Alokesh, and to all of our speakers. I'd like to request Mr. Alokesh to present a token of gratitude to our speakers as well. And what a fabulous sort of session for us all, especially after lunch. All of us, our attention has been arrested with the right kind of insights. And I'd like to also urge you all to keep your thoughts coming using the hashtag MintIIS2026. With that, let's also have a quick photo op as well. And immediately, we're about to now set the stage for our next fireside chat, which is all about the rise of retail and HNI investors. That's coming up next. So let's continue with all that curiosity and with all that eagerness towards our next session. Thank you once again. Now, the next discussion, it's not just a participation story, it's in fact a power shift. When we're looking at retail investors, we know that they're no longer spectators, they are in fact influencing the market momentum. So what does this new investor era really mean for markets? What does it mean for businesses, and especially for all of us who are navigating this landscape? That being said, another very interesting chat awaits us. So to spearhead this session, once again, we have with us Deepthi Bhaskaran, editor, Mint Money. And we've got two of our esteemed speakers joining us as well, who will be coming up on the stage in just a minute. But first up, we'll work around the aesthetics of the stage. That's equally important for us to get it right. Well, as you can all take a look at the agenda, we're going back to back with the sessions. It's going to be extremely packed the second half, and that's where it's going to be even more interesting. So first up, let me go ahead and invite Deepthi on the stage. Deepthi, let's have you right up here. And with that, let me also go ahead and invite our speakers for the session. We in fact have with us Shravan Srinivasula, Executive Director and Head Investment Solutions, Avendus Wealth Management. And we also have with us Sushant Bhansali, CEO, Ambit Asset Management. So let's have both our speakers on the stage, please. Thank you so much for joining us.
Hello, everyone. Good afternoon. The topic today is rise of retail investors and HNIs. The rise of retail investors is a very well-documented phenomena by now because, we've seen the SIP books grow, we've seen the kind of IPO participation, we've seen the demat accounts grow. So I wanted to understand from you, what is causing this fundamental shift or what is causing this rise of retail investors? And I'm going to ask, both of you, Shravan, starting from you. You have the mics on your side?
Yeah. So I think the participation of retail investors, I think, is a journey, right? I would say I would attribute it to more than 20 years of journey that has happened, accelerated by a few enablers. I think the first one is the regulators giving the comfort with the MFSIA campaign. I think that's a big enabler. The second enabler is the advent of discount brokers. I think that has been a big game changer. The third one is, just digitalization, right? Everybody has a mobile. the ease with which people can access the investments, I think has become, as an enabler. And finally, I think it's the returns from the market. End of the day, the returns have to be made, right? And if you look at the last 5-year, 3-year, 10-year returns, so in 2024, the number was about 15-16%. In the last 2 years, markets have been muted, but even now we clock a number of about 13% or thereabouts on a 3, 5-year and 10-year basis, right? So that interests a lot of people to come into the markets. People are hearing the stories about, somebody making a post-tax double-digit return, right? Why can't I even, do that from a traditional investment? I think these are the reasons why you see a lot of interest being built out. IPOs, again, as you mentioned, has been a propellant of retail participation coming in. So we have seen, retail investors participating on day one. In fact, the first hour of the trade, right, it gets fully surprised by retail. And finally, I think platform like yours, Mint, there's a site called Chittorgarh for IPOs, and many other platforms which disseminate information has made this information arbitrage completely go away, is helping a lot of, I think, positioning from a lot of investors coming into the markets.
Sure. Sushant, do you want to go? What I also want to understand is there a behavioral shift? Are people becoming more, less risk averse? Because maybe it's, looking at returns, is it FOMO or, so is there a fundamental shift in the retail investor?
Last 5 years, the risk seems to have disappeared. Markets have been, I think, the drawdowns have been quite low compared to the previous cycles when the drawdowns used to be 30-40%. Last 5 years, the maximum drawdown has been not more than 15-17%. So that, I think, has given comfort to people that this is here to stay. But in addition to what Shravan said, in terms of these record-breaking numbers, both in terms of demat accounts or mutual fund units, holders, folios, etc. Two more things. One, I would say that financial literacy has played a very important role, and Shravan has played, I would say, a part of it, he has said already. But the rising role of influencers, finfluencers as we call them, has been quite massive. And this has led to, I think, a new class of investors, which is the youngster students. Right? I remember when I was in college, I had never heard about shares, etc. Right? Or probably if at all you read in newspapers, there was a lot of fear that time. In today's world, my son, who is, before he turned 18, he used to ask me in terms of which are the stocks I should buy once I become an adult. He forced me to open a demat account for him, although it was a minor account. But he forced me to open an account for him and buy some shares in it. So I think that class of new investors is something which is breaking the numbers. In addition to this, I think the only thing in which I touched upon in terms of discount brokers, but the wider point is the friction, which has come down massively in terms of how easy it is to open an account. Like I run an asset management business where PMS is the key product, and used to take almost 70 signatures. Used to take almost a thick booklet of pages to be signed and then re-signed, because when you sign so many signatures, there will be 3 or 4 signatures which will not be in order. So you have to send them to the client. It used to take almost a month for many PMS providers to open a simple PMS account. It has turned down to now digital, that single day, same day you can open an account. So, and if you go to open a new demat account or you want to become a new mutual fund unit holder, it takes few minutes, probably in some time it will be few seconds. That I think has led to a lot of new people coming, because otherwise you sign a form and then you forget about it, and then probably after 2 months or 3 months you realize. So the rising role of, I think, frictionless is the most important game-changing moment.
Great. You've given some very interesting insights on this whole rise of retail investors, and this ties in very well with my next question. And this is more about these investors. Are they looking for wealth creation, or is it just about access? You've talked about this new gen investor that's sort of looking at buying stocks, and we've heard about F&O trading, increasing. It's a 1 trillion, margin trading is a 1 trillion market now. And, SEBI's documented this, that 90% of people lose money in F&O, right? So what is, is it being driven by wealth creation, the rise in investors, or is it just the access to, let's say, platforms? Is it just because the friction has gone away? So what exactly is happening here?
No, definitely. I think friction has made it easier. Less of friction has made it easier for people to enter and be there. But I think it's for wealth creation and nothing else. I don't think people open Demat account for the fun of it. FNO is a different story. I think a very small part of the whole market is getting into FNO. Right? You pick up the people here, probably not more than 10-15% people will be doing FNO in a metro. And you go down below, then there are much lesser numbers. The numbers are starking because retail investors are, as per SEBI reports, etc., they lose money, and it is, I think, quite a lot highlighted. But if you look at the numbers of Demat accounts and the stock, my cousin is a co-founder of Grow, and he tells us that most of the investors who have opened Demat accounts, they buy stocks and just don't churn them. So they are genuinely long-term investors who like to buy companies after doing some research. There's a lot of information available now, a lot of screeners, etc., available where you can research on your own. And these DIY investors, I think, are leading this growth. So it's for wealth creation, and it has well supported, I think, by a great set of market for the last 10 years. Last 10 years, Nifty has not given a single year negative returns. So that has bolstered the confidence on wealth creation journey. So it's here to stay. And definitely, if you look at from a digital perspective, just about 35% of new mutual fund units are getting opened through digital channels, but 65% still offline. Demat accounts, definitely 80% are digital now, but 20% of the new investors are still coming offline. So it's not just, I think, access, it's also about the impact this is creating in everybody's mind in wealth creation.
Sure. So I think people have different buckets of money, right? So there's money for long term, there is money for trading. And in a bull market, you will see that trading becomes a national pastime, right? So I mean, I've been, an employee of an IT firm. Till 3:30, nobody used to do anything. It was only trading. After that, the work used to start, right? So if you look at the numbers, so MF equity is about 36 lakh crores, right? The number grew almost by about 60% or more in the last 3 to 5 years, right? If you look at the holding period, we discussed briefly in the morning, and I checked about the numbers. 56% of investors hold more than 2 years.
Correct.
Their mutual fund investments, right? This number 10 years back was at 40%. So the number from 40 has become 56, right? And I looked at number on 1 year also. The number which was almost 16% has now become 20% for greater than 1 year, right? So it's not like everybody is trading in the market. There is obviously quite a bit of activity going on in F&O, etc., because people want to make that easy money and quickly available. Sitting in the room, getting bored with a panel discussion, open an app, do some trade and reverse the trade, etc. But I don't think that's a great activity that is looking at. There are many people who using established platforms, and now that we have various vehicles, right? Now we have a PMS vehicle which is sizable, we have an EF vehicle which is sizable, and mutual fund and ETFs have grown massively in size. They're looking at long-term wealth creation. And I just put out the numbers, right? CAGR growth of 13% over the last 10 years is not a small number to grow.
Okay. So I'm going to now shift gears very quickly to the HNI investors because we just have 10 more minutes to talk about it. What has fundamentally shifted there? Because there's also a rise of first-gen HNIs or entrepreneurs, as we call them. So what has fundamentally shifted there? Are they what kind of products they want access to?
So I think the fundamental shift happened in 2015-16. One of the big companies was bought out by an MNC. A lot of liquidity came into the founders and a lot of other employees. That's when people started realizing that there is money to be made in startups, right? So since that time, 15-16 onwards, we've seen a lot of interest getting created into the VC PE funds, right? And I think it's about 3 lakh crore of size at this point in time in commitments. That's a sizable commitment pie that we're talking about. A couple of years back, thanks to the tax changes, debt, which was supposed to be a safe investment, you would have put money in a AAA bond fund and you would have earned post-tax 7% very easily because of the indexation benefit. That is now gone, right? So you put in money into a bond fund index, you don't even beat inflation, right? So you're now putting money into credit funds. So there's a launch of, I think, hundreds of credit funds across the country. So the interest there is taking place. And we just discussed about the equity markets. There's a lot of equity allocation that is happening. So when I used to construct portfolios 3 years back, for me, fixed income was a very easy proposition, right? Typically, investors have 60-70% fixed income, 30-40% in equity. Fixed income used to have some MLDs, which had a tax benefit, which had AAA bond funds, etc. Today, the toughest part is to build a fixed income portfolio. And today, people don't want more than 20, 30, 40% of allocation towards fixed income. Most of the risk is being taken in listed equities and private equity and VC funds. So there's a sizable shift in risk taking that we have seen among the investors, especially the HNI, ultra HNI investors. And the opportunity set has also increased, to cater to those needs of the investors.
Okay. Shashank, you want to come in?
Yeah, I think in addition to this, the biggest shift in my view is that shift from real assets to financial assets in the last 10 years. And definitely the new age founders are investing a lot. I don't think they believe in real estate as an asset class the way old age founders or probably promoters used to invest. So that's a big shift in itself, which I think will do really well for long-term economic growth of the country. More money in circulation, more capital being provided to entrepreneurs will lead to. So I think that's the biggest shift from real asset to financial assets.
And also because I think they're inherently risk takers, right?
Of course.
So
see, when you have only made like money in 5-10 years without investing any capital, there's a lot of risk which you yourself have taken in your business, right? And that quick money always lead to quick risk taking as well. That person believes that I'm a well qualified person, even if I lose, I didn't start with anything any wage, right? Compared to old generation promoters where it's family heritage coming in, decades of wealth creation which has led to a sizable corpus which you are taking risk on. So the new age founders are, I think, of a different breed. That I don't have much to lose. If I make it, let's make it. It's like double or quits.
how does that change the way you operate? How does this change your job fundamentally? Given the new breed of investors that are coming.
Big time. I think the new money is quite impatient compared to the old money, which is very, very patient. So they will play 3 and 5 year cycles. The new age money will not do like more than 1 or 3 year cycles. They will start questioning you after 1 year, and 2 years, if you don't deliver, and 3 years you don't deliver, money is gone, right? While new age, while old age people, I would say not people from an age perspective, but the old money, that money is more sticky. They will give you at least 1.5, 2 years before starting to ask questions to you, and then they will be with you between 3 to 5 years. If you deliver reasonably well, then probably more than 5 years. So it's very tough. You have to, in our business, the biggest cost is like cost of acquiring a new customer, right? And if the customer is churning, then you are always on the treadmill and still staying on the same path.
Okay. Shravan, do you have similar experiences?
Yeah. Our job is to innovate and get products which are relevant to the clients, at this point in time. There is 50-60% of corpus still being invested into traditional asset classes, but there are new asset classes that are coming, that are being invested into. So we are, we're trying to, curate those products, support people. In fact, we have helped a couple of categories build up from ground up at Avendus. So we are in always scouting for those opportunities to come in and try to cater. So I think our job in the last 10 years has tremendously transformed, and in the next 10 years, I see that the transformation is still in the work in progress.
Okay, great. So I also want to understand from you, how is the market sort of evolving, or for example, the regulatory landscape evolving to enable this shift? So we've seen a lot of, framework from SEBI on the AIF front. So there is co-investment vehicles, there's accredited investors and all of that. How do you view these changes, and what do you think needs to be done more? Like, do you have a roadmap ahead?
Yeah, I think we got one of the best regulators in the world. Definitely. I think look at the way they have, tried to ease out, the workings of an AIF. The SIF platform practically were created in less than 2 years. SIF today has got a EM of almost 10,000 crores, right? Some simplification happening with the PMS front, etc. But I think there's much more work to do. For example, I don't understand this logic of allowing accredited investors to put in 25 lakh rupees in an AIF. right? So you're talking about ultra HNI taking a AI certificate with a net worth of more than 7.5 crores, and he would, rather well invest into an AI with a minimum of 1 crore, but there is a 25 lakh enablement that is given. I don't understand that, right? But having said that, there are a lot of other changes which they have done, and these like some of the things which you mentioned. But more to go. For example, AIF has now become an investment vehicle, right? But it's limited not to invest into, let's say, a mutual fund or a PMS, etc., right? Which is actually adding friction to the entire investment journey. This MF, so interregulatory understanding has to be better. This MF limit of investing into foreign is actually hurting the retail investors, right? HNIs are finding their way out, so putting money through Gift City or OPI route, etc. But retail investors want to participate, but the funds are shut for 4 years now, right? RBI is not allowing the limit. So there is more work to be done, but last 10 years, I think the kind of ground which the regulators have covered is phenomenal. But I think, again, it's more work in progress over the next few years, I will see.
Okay, great insights. Shashank, do you want to come in quickly, and then we'll probably open the audience round?
I think regulator has been quite forward-looking and very engaging. I'm vice chairman of EPMI and deal a lot with SEBI regulator. And I think over the years, the approach they have taken of ease of doing business, although there's a lot of bureaucracy which comes in, but the mind, open mind which I think they come with, especially I would say the senior leadership of SEBI, is quite meaningful. And one of the key reasons I would say behind this whole retailization, etc., is a great regulatory framework which has been quite solid, giving trust to every individual that my money is safe with these mutual fund managers or with these brokers, etc. I think that trust which the regulator has been able to build in everybody's mind is the single biggest contributor of this whole wealth creation journey and the number of people getting associated with equity markets and capital markets.
Okay, great. Great insights. With this, we'll open for a couple of questions. So you have wealth managers here on the stage. So if you need to ask any questions, please raise your hands. There's one more there. Please do introduce yourself.
Hello. Hi, my name is Prachi. My question is to Sushant sir. Sir, we are seeing that FIIs are selling back-to-back in India since last 1.5 year. So is there any global structural shift in capital inflows?
Definitely. I think one, the interest rates in global markets as well as equity markets in global developed markets have been doing really well over the last few years, and that's why there's a big shift from emerging markets. If you look at last 15 years, India has been the only country in the emerging markets which got flows. 2011 till 2015, everybody got flows, but in the last 10 years, 2015 to 25, India was the only emerging market where we had meaningful FPI inflows. Everybody had net outflows. Last 1.5 years have been tough. There's a lot of movement, I think, and we have seen post-COVID last 5 years, money comes in, goes out, comes in, goes out. So that trend, I think, will be here to stay. Valuations in India, I would say, are much more reasonable than they were 1.5 years back. The economic activity in India was, before the war, I think, coming out quite well over the last 6 quarters. I think we had a downward trend. Suddenly in last quarter Q3 results, we saw that upward trend. And if that would have continued, then I would say there was a big case for global investors coming back to India in the next 3-6 months. But this war thing, nobody knows how long it will last. If it gets sorted in a week or two, then I think definitely second half of this year, there will be a lot of global money which will come to India. But if this goes towards probably May and June, then I would say God help everybody.
Absolutely. Okay, there was one more question here. Can we get the mic here, please?
Hi, I'm Apurva from Mint. My question is for Shravan. You briefly spoke of the accredited investor framework, and SEBI seems very positive to push this further. Do you think this is the right way to take for the AIF industry? Because the chairman had said that the future for AIFs should be accredited investor only. Do you think this is the right way? And also, if this framework has to pick up, what would it take? Because it has only grown modestly as of now.
Yeah, I think it is the right way of going forward, because AIFs are meant to give flexibility, right? That's why there's a Cat 1, Cat 2, Cat 3 structures, and each of them have the strategies laid out, and leeways given. additional layer of leeway is being given by having the accredited investor. So this is other AI that we should be worried about, apart from the artificial intelligence. We are very excited about it because it gives flexibility on sectoral limits, on individual investment limits, right? There are some disclosures that you have to make. There is some leeway given on disclosures, etc. So when you have to take it to market, I think it's faster. There is a LVF framework, large value fund framework, that has been introduced. Fortunately, they have reduced the size from 70 crores to 35 crores. That's also very good, I think, step the regulator has taken. So we'll see more and more. There are a few frictions that I just pointed out in terms of lack of investments into some of the investment ideas. But once that is taken care of, I think it is going to be used very actively. So today also, if you look at AIF commitments, CAT to AIF gets a lot of commitments, right? And now I see that if LVF and AIs is something that we work upon, CAT 3 will take over the CAT 2 AUM, from now, right? So I think I'm very excited about AI as a enabler for garnering more investments into AIF.
Okay, I think that's all we have time for. Thank you so much for all your insights. Thanks.
Thank you. Thank you so much, Deepthi, and to our speakers. Deepthi, if I could request you to please present a token of gratitude to both of our speakers, to Mr. Shravan Srinivasula and to Sushant Bhansali. Thank you so much again. All right, we're about to march ahead to our next session, and before we do that, of course, I also wanted to share a quick announcement with you all. Now, so many of you have tried out the intro bot. I've also heard that a lot of connections were sent across as a request. But while you have been receiving connection requests, I'm also going to inform you that your fellow attendees and potential partners are actually looking out for you. So don't just stop it at the request. You've got to go and approve it as well. So all you have to do is scroll up the chat with the bot and review the requests, and then you can start accepting them. So please don't forget to do that. That's equally crucial than just sending out a request. We've tried to ensure that it's safe in terms of the way the entire AI has been curated. But we'd love for you to go ahead, review the request, and then accept it accordingly, so that way you can continue staying connected. And that's where the conversations continue as well. With that, yes, in case if you still haven't scanned the QR code, you can do that right now. Again, the 10 cards have also been placed on the table for you all. Moving ahead, our next session is all about the returns, risks, and exit routes for investors in Indian realty. And I've been told that our speakers are here inside the hall. All right, so with that, let me firstly go ahead and invite Madhurima Nande, Senior Editor, Mint, who will be spearheading the session. And as we look at this very interesting theme for the panel discussion, let me also invite our esteemed speakers on stage. We have with us Vipul Rungta, Managing Director and CEO, HDFC Capital Advisors. And we also have with us Ankur Gupta, Deputy Global CIO, Head of APAC and Middle East Real Estate, Brookfield. So if I could please invite Mr. Ankur as well to please come on stage. Thank you so much again for joining us. As you all take your seats, I'd like to quickly request Madhurima to take it over.
Hi, good afternoon, everyone. So today we have two of India's largest institutional investors in real estate. On one hand, we have Vipul from HDFC Capital, which is easily the most active, aggressive, and largest residential investor. On the other hand, we have, of course, Ankur from Brookfield. Brookfield is one of the largest global investors in real estate and has now diversified its portfolio across several asset classes within real estate. I'll start with Vipul first. Residential, of course, occupies and constitutes the largest pie in the real estate universe in India. Vipul, when the market is anyway doing well and sales are good, developers are expanding, what are the opportunities or investment opportunities that you see? And what kind of demand for capital is there, from developers today?
Thank you. Before I delve into your question, I think you used the words a little not so distinct. So largest has a different meaning. The gentleman on my left, I think, manages 7-8 times the kind of money we manage. So that probably is this thing. Brookfield obviously is a very big investor doing all kinds. We only do residential. To your point, I would obviously as you mentioned, I do residential. Residential is still not very seriously looked at by Brookfields of the world. So by virtue of that, we are fairly big. But having said that, residential market in India is almost, they say, between different estimates, but 2/3 to 75% of India's real estate market is residential. Everything else, commercial, retail, hospitality, healthcare, data centers, blah, blah, as of today is only the balance. And there's enough and more stuff that is happening as far as the market is concerned, both from the developer's perspective, both from the customer's perspective, something which touches probably everybody in this room. To your question about where is the demand coming from, we basically do supply side financing. We do equity and credit, mostly credit, senior secured. I think the market is clearly consolidating towards the top 10, 20% of every region. And what that is doing is that it is bringing a lot of the developers to funds like us. We manage almost 5 billion odd funds like us, which is for expansion, for land acquisition, for approvals, for doing something which is beyond just the projects. There's also a hold and lease strategy that is emerging in as far as rental housing is concerned. So we are very active on that part. Yeah, so I think we are seeing more deals now with the market kind of tapering in some geographies in India.
Right.
So demand for formal capital is going up.
Right. Ankur, in terms of, where India kind of is positioned in Brookfield's overall investment strategy, allocations for India obviously has gone up. India has become more important. So what is the, in terms of investment thesis, when you look at India from a Brookfield, like is India competing with, other Asian countries, or is it competing with a London? Where does India fare in, Brookfield's sort of strategy?
Yeah, thanks for having me on this panel. I would say that, whichever way we slice and dice, India is a top 5 global economy, if not top 4, or certainly will be top 3. $5 trillion moving to 10 to 15, so you're doubling. And I think that is important for us to contextualize, which is real estate investments are about growth, they are about scale, and ultimately they are about housing the economy. We are not the economy, we house the economy. Whether it's the residential sector that houses the 400 million Indians who are moving to urban India, or moving up the value chain, income chain, etc., or events like this that need to be organized in hotels and travel, tourism, commercial real estate, GC. So all of this globally, just to put context of where India is, globally the commercial real estate sector, which is the rent producing, income producing real estate, including housing, including lodging and logistics and office, is about $60 trillion. That sector in India, if we add everything, is probably less than $500 billion. The ratio should be about 1:1 of GDP. So our fair share of built rent producing real estate should be about $5 trillion right now as we speak. And it's about 1/10 of it. So the question is not whether global capital allocation is right or wrong. The fact is that we need significant capital to build our real asset infrastructure to be able to push the economy from 5 to 10 trillion to 15 trillion. And when you have, as Vipul said, they create supply of housing. in India, capital is required to create the infrastructure, which means we today are a guzzler of capital as a country. And now let's contextualize where should capital go, where the cost of capital or the need for capital is the highest. And hence, while India may compete with itself in terms of how much capital India can take, it's right on top of our track record of global investing, but right on top of our best idea in the world, where as a country, there is respect for capital, there's return on capital, and there is good avenues for us to harvest capital. All three are very important.
Vipul, over the last 4-5 years, we had a session earlier in the day today on this whole luxury and premium housing thing, right? Now, HDFC's, your investment thesis has been based on mid-income and affordable housing. Now, the whole definition of mid-income and affordable housing has probably shifted in India. What are your thoughts on that? Like, have you all also shifted your strategy accordingly? So where is HDFC on this now?
So I don't know about whether we have shifted our strategy, but let me tell you a small thing that happened. So when we set up our fund and we announced closing of our fund, so there's a developer, he came and he said that, I'm doing these homes in Bombay, and so I said, what's the selling price? So he said about 8 to 10 crores per apartment. So I said, but we do affordable and mid-income housing. He said, no, it is because somebody can afford it. So that's why we are doing it. And that's, I think, the crux of the issue. The issue is, today, the term itself, affordable housing, the government has 2 or 3 definitions of affordable housing. The income tax has a different definition. RBI has a different definition for this thing. So that is one. Somebody defining by size, somebody defining by units. Mid-income housing, what is mid-income housing for Bombay does not apply to Delhi. I don't know if you know this, but the gross value of sales in rupees between Gurgaon and Bombay was almost similar last year. Yeah. Now, what does it mean? And the average unit's price in Gurgaon was 5.5 crores per apartment, and in Bombay, I think, was 3.5 or 3 point something, 3 crore plus. Now, does it mean that suddenly Gurgaon has become a bigger market than Bombay, or does it become more unaffordable? Because we tend to generalize. So first of all, I don't think it's a general definition. To your point about affordable mid-income housing, HDFC Capital set up 10 years back. In fact, we're completing 10 years in another quarter or so, with a specific objective of doing homes for the middle class. Middle class as defined as people earning 50,000 rupees to 3 lakh rupees a month. It is not like, as I always say, we keep joking. I was joking with a friend of mine in the morning that the world in India especially, or maybe globally, Ankur, you can say, is divided into 3 kinds of people: the haves, the have-nots, and the have-lots. So the developers of the world, and in India specifically, especially in housing context, are catering to the have-lots. The governments are catering to the have-nots. And it's the haves who are stuck in the middle.
And there's fourth, which is have lost.
So it is, so these haves who are, probably the proverbial middle class and whatever you define it, whichever parameter you use. The fact of the matter is that whether I'm trying to buy a 2 crore home, or I'm buying a 5 crore home, or I'm buying a 1 crore home, I can't afford it today. Without my parents and parents-in-laws, I don't think how many people can leverage only their income and buy a home in any of the top 15, 20 cities. So obviously intervention required. To your point, what have we done? We haven't changed our definition. Our definition is exactly what it was. We have funded, as I said, about 4 lakh homes so far, out of which about 1 lakh homes in the top 5 cities below the selling price of 40 lakhs. Another 1 lakh homes between 40 lakhs to 80 lakhs. Another 1.5 lakh homes between 80 lakhs to 1.5 crores. And balance is above that. Each of these homes are with top developers because it is a supply side issue. It is, can I supply chain be integrated, that I create efficiencies to make those margins, which is sold. These are not chumries and these are not sophisticated slums or anything. These are something that each one of us can go and live if you're okay with that size. So there is enough and more demand, and it's something which I think is beyond the cycles as far as the market is concerned.
Ankur, in the last few years, I think you all have considerably diversified the portfolio from just an office-focused approach within the real estate universe. So you have, the Leela-led hospitality portfolio now. You, of course, have a REIT. You have retail and hopefully logistics soon as well. So what are the, if you could tell us a little bit about how these sort of asset classes have performed, and are there new real estate classes that you're looking at in terms of potential investments?
Globally, back in the day, there were 5 asset classes: office, retail, lodging, logistics, rental housing. And everything was around these 5 asset types. And in India, you mentioned we cover, or we will cover all as in fact, we are building our first rental housing project now in one of our portfolios, and we'll probably do a lot more in that space as well. Now, within that, there are at least 25 sub-asset types today. In rental housing, you have student housing, you have senior living, you have build to rent, and you have so many others. And in every sector, in hotels, you have hostels, and you have other forms of. So every sector has subsector and there's specialization. As I mentioned, ultimately, we have to go down to, like Vipul said, they haven't changed the definition. Just like that, we haven't changed the definition of what is the space that we invest in India, which is, largely speaking, you'll see us have a consistent theme towards the urbanization of India. It was manifesting itself in office spaces where large amounts of employment was being generated. What did we do? We provided by buying and building commercial assets to house the massive amount of job creation that was happening in the technology, services, urbanization space. Similarly, on the back of it, there was almost no hotel creation that had happened for 10 plus years, which is when we acquired the Leela business from 8 hotels, now 25 hotels and growing. So ultimately, you house the economy that is existent today and likely to have strong demand parameters. Nobody can predict the future. What we are doing is solving the present. I think as investors, if we can solve the present, we'll make good returns. So what is the present today? We need more manufacturing, which is the reference you had for logistics. We need more business parks, industrial parks, like we did IT parks, because manufacturing needs to happen. There's more Atmanirbharta that we need to have. The world is a funny place right now. To Vipul's point on housing is just unaffordable, period, globally. In the US, you have the highest amount of housing shortage and the highest levels of unoccupied housing units. How do these two correlate? Because there is unaffordable housing. In India, we don't have great data, but housing is grossly unaffordable, and you add social factors to it, which just does not allow for good quality rental housing to prosper. So ultimately, you try to solve a problem, and that creates investment opportunities and opportunities to expand that program. So all of these asset types that you mentioned are fair game for us in India. Markets are becoming deeper, markets are becoming more institutionalized. And I think the journey of institutionalizing markets is what Brookfield really likes. We invested in an office where even the REIT laws were not there. And we helped in creating a sector in some way. We're the largest owners of office assets today in the country. We have been the largest foreign investor in real estate for now many, many years. And I think I would still say that the best years of real estate are today and years ahead of us, simply because so much has to be built.
Vipul, within the residential sector, I mean, there's one thing that we've constantly been hearing is the rise of private credit in recent years, right? And so my question to you is that, is this something that you think is a unique India success, I mean, in the current situation, compared to how private credit has performed sort of globally? And what are the reasons? Why is there suddenly this surge in private credit, transactions?
I think globally private credit is probably at its worst time ever, because that is where, with high interest rates, what happened in the last 4 or 5 years is that a lot of funds which are doing pure equity were doing private credit. But there's a very, very key difference, and it is something which is not related to real estate only. It's more related to private credit sector in India versus private sector globally. Globally, especially in the Western world, private credit are leverage structures, which are levered at various things, which are levered at the asset level, which are levered at the fund level, and then you do those things. In India, leveraging is not allowed, at the fund level. AIFs are not allowed to lever. Most of the private credits, whether it's real estate or non-real estate, are unlevered structures. So it's senior secured as far as the Indian ecosystem. I read something, I think yesterday or day before, about how private credit is melting down across the world and what repercussion does it have on private credit in India. But I don't think, with due respects to the author of the article in that daily, that they understood the difference, this difference about it being levered versus unlevered structure. So I think that's a huge difference, because with the interest rates surging up or remaining where they are, thanks to all the geopolitical issues, it's the equity in those private credits, which is obviously, and the fact that you have some kind of AI impact on the asset quality, that's the second factor. But on real estate, which you asked, see, traditionally, private equity in real estate, barring, in the last 10, 15 years, with institutional capital coming in, has not made the kind of returns, say if you take 2005 onwards, that it probably should have, despite the growth. And a lot of it had to do with the quality of managers, or quality of funds, obviously the asset quality, and so on and so forth. And it's only with the, as Ankur so rightly said, with institutionalizing of the capital, that everybody's like, there are classic example, a lot of other funds are classic examples where they are dirtying their hands and getting into the investment itself, rather than just doing a helicopter kind of, let me buy India real estate kind of an ecosystem and approach. It's only when you dirty your hands, you're able to do things. Private credit, which is senior secured credit, in India, whether it's domestic or international, we run what is senior secured credit, performing credit, is doing pretty well because the underlying asset quality is well. It's a simple, straightforward structure. Thanks to the regulators, the things are at the all-time best and simple, more importantly. But
look, I'll just add to on your question of global meltdown. It's facing headwinds, partly because it became too easy. Lots and lots of investors came into the private credit space, people who did not have the experience. And if you have a lot of money to invest, it's fairly simple. You can lend. You don't have to go and build something, etc. And I think that became the norm. And we have a very large private credit business, and we think the best years are ahead of us, because we probably grew the slowest that would have imagined, because we were just very conservative and we were doing it the right way, with good governance and with good underwriting standards. And I think when underwriting standards are not met because you have too much capital, to Vipul's point, in India, underwriting standards are met a lot because, again, it's solving a capital problem. India does not have a lot of capital, so you can choose the developers to fund, you can choose the projects. And I think globally it will go through its ebbs and flows and will settle down. Some managers will not make it through the end of it, and experienced ones will.
Now that you all, Brookfield has sort of a mixed portfolio in India right now across asset classes. What are the return expectations, or have the return expectations changed from India? Because there's hospitality, you'll also have a REIT, which is a relatively new sort of investment vehicle in India and has been kind of picking up in the last 5-6 years. If you could tell me something about, return expectations.
Returns are a function of form of capital and duration, and then the risk. So what we underwrite, when we say underwriting is underwriting risk. So returns are a function of risk underwriting, duration underwriting, and then, what is the cost of that capital. Yeah. So for our REIT, it should outperform the index returns. We should be able to generate... Time's up. So we should be able to generate solid double-digit, mid to high-teen returns year over year. It will be a combination of 7% dividend yield or distribution yield, 8 to 9% levered growth. So you get to that number. In a development project, it should be higher than that. In a private setting, it should be higher than other. So it's a function of not the asset type, but the business plan. If you compare projects globally, I would say for an emerging market risk, and India is not emerging, India has too many words, leader of global south or developing, whatever. For an India-like risk, our business plans should be simpler than in developed markets. Our returns expectation should be at par, adjusted for FX and currency risk. I think if we can calibrate across the world, and across asset types and the risk of the execution, I think then it's very easy. Then you don't have to look, here or there to find many ways to underwrite. It should be a simple metric and it should be a simple decision making after that.
So yeah, I mean, just to kind of gradually wrap it up, Vipul, I mean, what do you, since you are there and you have been investing in housing specifically from HDFC Capital for what now, a decade, what is the future of housing? Like Ankur said in the beginning of the conversation, that, buying a house has become almost sort of unaffordable. So where is it headed? I mean, government incentives or not, whether the definition of affordable changes or not, where do you think it's headed, at least in the top?
So there are no government incentives right now in affordable housing. But let me tell you, if conferences like these are a parameter, then whenever the market is in a crisis, all conferences turn to affordable housing.
Yeah.
If you take the themes of affordable of the talks and conferences, especially related to real estate,
they become... But we are not there yet, right? I mean...
So I, personally, if you ask me, in 2 years, I won't be surprised if you organize a conference on affordable housing, because that is, and when I say affordable, I mean, as Ankur mentioned, this mid-income housing catering to people who are earning 50,000 rupees to maybe 3 to 4 lakh rupees a month, which is probably 95% of the emerging aspirational class of India. You're talking billion people below 35, blah, blah, blah. Just imagine, our average age is 28, and the average age of a home buyer in India is 34. With GDP per capita going up, that many people will come into a home buying age. But where is the supply? As you talked about, where will you house them? Where will they come? And all that urbanization happening, people coming from tier 3, tier 2 to tier 1, tier 2 kind of stuff. So I think it is the single biggest private sector, unaided, without government support opportunity, because it has scale. It has seen enough tailwinds today. And now with this top thing fluttering about super luxury and stock market and so on and so forth, I think time has come where more people will be ready to look at that, and thanks to...
No, but if we kind of look at the housing cycle and so-called boom cycle, are we towards the end of it, and now we have already sort of entered like a plateauing phase? Where are we in that curve?
I don't understand macros. I think generalizing cycles is beyond me. Ankur is probably better.
No, but this is a residential cycle. So
I'm not a macro cycle guy, because I'm not buying the market. I'm not buying index of housing. I'm buying project level. I can tell you that when we started in 2016, it was the worst time to get into housing.
It was the worst time, right?
Demonetization, RERA, everything was happening, and still we have made money. That doesn't mean that I can only make money that way. People have made money in worst of cycles, in best of cycles. He mentioned about private credit, them doing well when everybody else is having headwinds. So I think it's a function of people. And macro generalizing is something, especially in a market as diverse as housing in India, is not exactly, at least my cup of tea.
I'll give you an example. If you look at the global returns in real estate, whenever you have 2-3 years of the red, it's followed by 10 years of green on the rent-producing income-producing assets. In residential, it's the opposite. You have many years of red and few years of green, simply because people get out of their skis and do a lot more. I'm not a macro guy like Vipul wants to claim, but if you just look at top 10 listed home building stocks today, you will know exactly what I'm talking about. Stock markets are a good reflection over a cycle of where the puck's going. They're not helpful to you for us to look at every day, every morning, and certainly not in these markets. But they're a good reflection generally of where it's heading as a sector. And I think it's been the most underperforming sector. Home building sector has been the most underperforming over the last year or so. And I think that's reflective of the fact that the housing that is required is not being catered to. And capital has gone into asset types that seemed very profitable. But too much of a good thing is a bad thing, as we all know.
Let me give you another example. See, real estate and especially housing is also one of the only sectors, in my opinion, where the end product fortune and the fortune of the manufacturer are negatively correlated. For example, suppose I'm in cement industry and cement prices go up. then the chances of cement manufacturer profit going up is also high because they are making and selling on us. But that doesn't mean that if real estate flat price is going up, the developer is making more money because probably he's already sold off all his assets. And there are scores of examples of people not making money, and there are examples where the developer has lost a lot of money and the people who bought his flats have made money and vice versa. So it may be negatively correlated. It may also be a function of my financing cycle, how I've put the entire thing together. So it's not necessary that macro level, if the market prices are going up, that means all developers are making money, and if it's going down, all guys are losing money. It doesn't work like that.
Great. Thank you very much, and thank you, Vipul, and thank you, Singh, for a great this thing. I'm sorry we are out of time, so can't take any audience question, but yeah.
Thank you so much. Can we have a round of applause as well for that candid and yet a perspective-led discussion? I'd like to request Madhurima to also present a token of gratitude to both of our speakers, to Mr. Vipul and to Mr. Ankur. And we'll have you three come together for a photo op as well. Let's do that. Thank you so much. All right, so with that, let's also march ahead to our next session, which is all about the changing M&A landscape. Thank you again, sir. Thank you so much. Our next session is all about the changing M&A landscape. And as we look at India's M&A landscape, we know it's entering a bold new era because on one side, growth-hungry global investors are seeking scale, speed, and strategic footholds. But on the other side, we also notice bullish domestic corporates who are armed with capital and confidence, and they're the ones who are ready to defend and expand their turf. So this isn't just deal making, it's a collision of ambition, strategy, and capital, and who's about to shape the next wave of that consolidation? Who gets to seize that opportunity and who gets to adapt in order to survive? A lot more questions coming our way. But that being said, we've got again another expert panel lined up right now, and we're about to get into the evolving M&A battleground where global appetite meets domestic assertiveness and India's corporate future is being negotiated deal by deal. So let's find out a little more with this upcoming session for you all. Now, that being said, we have Priyamvada C, who's a senior correspondent with Mint, who will be spearheading this session for us all. But meanwhile, if I could also request our previous set of, our delegates to also please take your discussions offline in the pre-function area so we can march ahead and start off our next session. All right, so with that, let's get the session started. But I believe that we're still left with one last bit of the logistics. So we're just going to sort that out really quick because our speakers are also waiting. So we'll do that really quick right now. Sometimes acquisitions are faster than our stage setup, but we'll try to ensure that we do that neatly well, at least. So super. With that, first up, let me quickly invite Priyamvada on stage. And with that, let's go ahead and invite our incredible speakers. We have them right here inside the hall. If I could please invite Devarajan Nambakam, Managing Director, Investment Banking, Co-Head, India, Goldman Sachs. We have Ashish Javeri, Managing Director and Head of India Investment Banking, Jefferies. And Alok Malpani, CEO, Emirates NBD Capital India Private Limited. Can we also merge ourselves with a bit of an applause? Let's bring that energy back in the air. Superb. It's wonderful to see that enthusiasm there, and let the insights begin. Over to you.
Hi, everybody. Good afternoon. I firstly thank you so much for being here with us today. To set some context and get the ball rolling, I think the last year has been a very interesting period for mergers and acquisitions in India. We have seen some of the largest cross-border transactions, be it inbound or outbound deals, take shape in the country, even as the IPO markets sort of boomed. Just to cull out some data, there were over 200 transactions, be it inbound or outbound, worth nearly $45 billion that have happened during this period. So it's been very promising, both in terms of the value and the quantum of deals that have happened in the last year. So to contextualize this further, we have three eminent speakers with us on the panel who will help us get to the finer details of the evolving M&A landscape in India and how the country is viewed by both domestic and international players. Thank you, Dev, Ashish, and Alok for being here with us today. Dev, if we can probably start with you. What were some of the key drivers that fueled the M&A momentum in India? If you can probably start with that.
Sure. And I think when we talk about M&A, we should probably look at a few years at a time as opposed to a point in time or 1 year. If you look at the last few years, let's break up the drivers into two parts. The demand for capital and then the supply of capital. If you look at the demand for capital, fundamentally, is India a great growth economy? Does it need capex for growth? Yes. Are there sellers or shareholders of businesses who are looking to monetize either because they need their succession planning or because like private equity needs to exit the business and monetize? The answer is yes. So is that demand for capital? Absolutely, and it will remain the case for a growing economy. Is there supply of capital? I mean, Ashish, Alok, and I have been doing this in this market for quite a while. I think it's safe to say there is almost no pool of capital that is not available to India today.
Yeah.
Strategic capital, private equity, hybrid capital, private credit. Previous session, we talked quite a bit about private credit. And I agree with the comment that was made that India operates a little bit differently from the rest of the world. So today, the quantum of capital that is available in India is higher than we've ever seen it. So it's a natural matching of demand and supply of capital that's happening. But what's interesting is what drove it. In a good market, this will drive momentum.
Yeah.
In a slightly volatile, and I'm not talking about today, at this time last year, some of us would have said, okay, it's been a bit of a rocky start to the year. You had tariffs, you had some volatility, but this demand supply creates resilience.
Right.
What was quite interesting is the last 3 quarters of last year, the ability of people to digest the volatility, to price it in if required, and to get on with doing M&A because there is still sense in doing M&A. That happens when there is that fundamental demand and supply of capital being matched. So I would say the biggest driver last year was the fact that people, and I think it's going to be tested this year more than last year maybe, but the ability of people doing M&A, whether it's investors or those who are receiving capital, to digest this volatility, to price it in where required, and to understand that M&A is being done for the next 5-year, 10-year horizon and not for 1 or 2 years. You're not playing a quarterly or an annual theme. So that's probably been the biggest mindset shift or driving factor of M&A deals, particularly strategic deals in the last year and a half, I would say.
Right. Okay, thank you for that. Ashish, if you can probably build on that, because today we are seeing, as he talked about demand and supply, we're seeing M&As of all size and scale happen. We've seen some recent acquisitions even in the 100 to 300 million, and of course there are the bigger billion-dollar buyouts that we're seeing. So what are some of the sectors you think are poised for consolidation in the current scheme of things, if you can shed some light on that?
Yeah, thanks for that, Premada. So, if you look at the last 10 years of deal making in India, we've probably seen across, whether it's buyouts, fundraisings, across sectors, probably $1 trillion of activity in India, right? Across inbound, outbound, and domestic. When we started our careers, maybe in early 2000s, India was all about foreigners looking at India for market access. Private equity just started coming into the country, right? And, at that point, we had, the vision. We didn't have the ability and scale. We didn't have the ability to execute at scale.
Right.
Capital was expensive. Capital was not available. reforms, etc., were just very early, whether it was tax, whether it was structural flexibility. A lot has changed over a period of time. Several new sectors have come up in India. I mean, just in 2 decades, right, we've seen, a big sector called infrastructure, right, which has come up massively. $100 billion of probably transaction deal making in the last 5 years in that sector in itself. We've seen EMS, right, as a sector which has come up. We've seen, healthcare and pharma become far more deeper, right? And, these ecosystems are being created now. So when you look at the type of deal making which has happened in the last 5 years, it's been very, very distributed.
Yeah.
It's been across sectors. The depth of the market is so large, whether domestic or whether ability for people to take businesses globally. Sure. That people have transacted in multiple sectors, right? So technology was at one point mainstream, yeah. Whether it was IT services, which was a very large part of deal making. Healthcare, has been a large part of deal making. But we've seen that expand to multiple other sectors like financial services, right? Which recently in the last 2 or 3 years, right? Both from capital raising as well as M&A perspective has become quite prominent, yeah. Right? And new age sectors, whether it's e-commerce, whether it's EMS, so we're seeing deal making everywhere. On your other point, in terms of scale of transactions, if you look at just last year, right, we've had probably $10+ billion transactions, right, which are more inbound transactions, 5 from Japan and Middle East. Right. So we are seeing geographic diversity also kicking in a massive way. So, net, what we are seeing is distributed activity across sectors. We are seeing large-scale transactions, especially in the, $500 million plus bucket. Yeah. And of course, a decent mix of private equity and corporates, right, both being super active across the deal-making spectrum.
Right. Thank you for that, Ashish. Holding on to that thought, Alok, you've had a breadth of experience spanning multiple decades. How are you sort of seeing M&As evolved over the years? Like, are you seeing newer sources of capital come into the country? Can you probably shed some light on that as well?
Sure. Thank you. Thank you for this opportunity. Well, Dave and Ashish already gave a very good overview of where we stand, where are we in the journey. But if you allow me to step back, my experience of M&A, it is more a behavioral. Right. India predominantly is family owned. Right. Even the conglomerates are there, but they are family owned. The decision makers are individuals. While there's a board, but still the decision making is with the individual. Right. So if I go back, after the reforms which Mr. Manmohan Singh started way back in 1991, the first M&A as a child I would have recalled is Chauhan selling to Coke. All your marquee brands, Thumbs Up, Limca, Gold Spot. It would have been, I don't know, $40-50 million type of trade. Right. And India probably would have been like a $300 billion GDP at that time. So that is where, because the M&A was socially not that accepted. Yeah. Why someone is selling? Is he into financial stress? So for society to accept something like that, there has to be a behavioral change, etc., etc. So it went on for a while. There was a lull, Southeast Asian crisis happened, 1997, 98. Then Y2K moment happened, etc. The real M&A activity, if I play, started 2005, where India went on a shopping spree. And the largest of largest M&As, India was calling the shot, whether it was Chorus, ArcelorMittal, or many Novelis, etc. And they were all significantly funded by billions of dollars of trade. How they went, we all know. Many of these hit the bad cycle with GFC. Otherwise, probably things would have been very different. Then the US things played out. I would say that for these promoters to come back, they were strong. They managed to digest it. There was no blow-up predominantly. But post-COVID, the structural behavior has undergone a change. All these families came together, and for them, everything was perpetual. But now this second generation, interested, not interested, capable, not capable, and what are the risks, global risk attached to their business dynamics? All these came to the dining table for a discussion. So that is where we saw a lot of evolution on the on the M&A activity, domestic M&A activity started big time. One domestic buying another domestic. Otherwise, honestly, we did not witness that significantly. The second important thing, I would put it this way, which has changed. If I compare last 5 years of India, F20, where the COVID started, so COVID was a blessing in disguise, and F25, this significant deleveraging has happened. If I take an example of Nifty 50, which is, I would say, 50% of India's market cap today, it would have been like that in any M&A, debt to EBITDA is very important. Net debt to EBITDA, where do you stand in that journey? It would have been at 2.5 times. Today it is 1.5 times. Right. One may think that these guys would have raised a lot of liquidity by selling equity. Not really. The EBITDA of these Nifty 50 companies has grown by almost 12-13% on an average. So they were like at 5 lakh crore in F20. They would have been like 10-11 lakh crore today. So there has been a significant jump in the EBITDA. At the same time, deleveraging has happened. Same happened for Nifty Next 50. So these two components are 75% of India's market cap. So whatever action happens significantly are predominantly led by this. And I'm surprised that the next 50 outperformed the first 50. They have grown almost by 17-18%. So if we have to see where the M&A activity has been and whether they have been able to digest that, this is the top 100 guys who have been able to call the shot. So good part is the corporate India has delivered significantly and government India is also delivered significantly. So both macros and micros are in very good shape. So from here on, as we see, we believe that, and more importantly, the second and the third generation, Western educated, more disciplined, they have come to the workforce. Yeah, some of those were there in your event yesterday, and we saw activity like sports is getting corporatized. And people are saying that why only 51% shareholding? We are okay with 30 also. You have seen the famous RCB deal just 2 days ago. Yeah. It's a solid collaboration of funds, promoter, and the sports stalwart who has been an investor in the sports activity. So all this behavioral, it is all linked to behavioral and the mindset issue. And what has contributed significantly to this mindset issue is the governance. The governance framework, far more to catch, but it is getting institutionalized. That is where people are not scared that I should own 51%, I should have the majority in the board to call the shot. They're saying that so long as I'm well governed within the parameters, no one can throw me out. So all this, I would say, are behavioral, but they give an indication that this activity is going to stay for a long haul.
Got it. Thank you. Dave, can you probably shed some light on, what makes India a favorable destination for investments? Like from your conversations with global investors, what do you think really stands out about this country?
No, I think, and you've already heard from the three of us that things have evolved, right? Let's look at, again, last 5 years.
Right.
The consistent themes we hear from global investors, both strategic and private equity alike. Let's look at India in absolutes. Let's look at India in relative terms. In absolute terms, does the economy grow? Yes. The lowest GDP growth estimate, even if it's sub 6% or 6%, is still higher than what you'll see in most other places in the world. So fundamentally, is it a fast-growing economy? Yes. Does demography, consumption support this growth? Yes. Is there a stable political environment? Yes. Is there a stable corporate governance environment much better in the last decade than the decade before that? Absolutely so. And so India on an absolute basis looks pretty good.
Right.
Does it deserve capital? It does deserve capital. India on a relative basis compared to the rest of the world, fortunately, like I said, growth already we are outperforming many other economies, even through our softer cycles. And then geopolitically, fortunately, we found ourselves in a relatively reasonable spot. And so both on an absolute basis and on a relative basis, global capital finds India to be a sensible place both to make money, but also to keep it safe.
Right.
I think the two of this put together, you go back a decade before the last decade, it may have been one or the other. India was always a fast-growing economy, but is it a stable country? Is it stable corporate governance? Is it a stable regulatory environment? Today, people feel good both about the safety of the capital they're putting in, ability to invest, ability to repatriate, as well as relative to the rest of the world. So to that extent, I would say there is no it's not a secret or it's not a surprise that India is seen as a very good investment destination. So then what could, because it becomes a question, how long will this stay? What India has done well in the last decade is controlling the controllables well. What happens today to oil price, which India can't control, India can't control. But has India been controlling the controllables well? Answer is yes. As long as we continue to do that, for the most part, there's no reason why this sentiment of India being a good investment destination for any type of capital. It can be private credit, can be private equity or strategic capital. There's no reason that should stop. And then the last part of it is, it's a great sign of a mature economy. You mentioned the point, there is outbound M&A happening. Yeah. That shows that there is enough capital generation happening with businesses inside India, which is finding its way outside India for a strategic reason for the sake of growth, which is a sign of a very, very mature economy ecosystem. So as long as this two-way M&A capital coming in to fund the growth and capital going out to make India more global, Indian businesses more global, that will keep it a very, very healthy balance. And touch wood, knock on wood, hopefully this shouldn't change anytime soon.
Got it. So, So Ashish, recently there have been a lot of things that have really boosted, that have really shown encouraging signs of more capital coming in. Like, there have been PN3 easing. Generally, global investors are of the opinion that there is some ease of doing business in India. But, and acquisition financing is also opened up in a very big way. But, what are some of the things that still need to be addressed? What are some of the concerns that, global investors still have with, operating in India? If you can help me understand.
Yeah, so, I think a lot has already happened, in the last 10 years, I would say. Right from private markets, tax reforms, public markets, right, which have been a very good sentiment booster for private capital to flow into the country. Because eventually, private capital finds its way where there are returns and there is, security of returns, and public markets have provided those, right, very meaningfully over the last few years, right? And lots has been done to attract domestic capital, even in times when we've seen, 10 out of 12 years of net inflows from FIs, right? So I think there is lots that has happened, from the capital markets regulator, from tax perspective, expanding the scope of financing to allow banks to lever up, finance acquisitions. I think I wouldn't say concerns, but, top of mind for investors continues to remain, currency for large parts, especially when it comes to private capital. Top of mind continues to remain political stability, which has been, huge contributor to last 10 years of growth that you're seeing across, M&A and capital markets in India, right? And both are interlinked to a large extent, right? I think, these two would be top of mind for people, right, when they are looking at investing in India, especially when you look at the private capital universe.
Got it. So, Alok, just an extension to that, over the last couple of days or months, if I should say, there have been instances of, corporate governance issues that have been flagged by some high-profile banks. There have been accounting discrepancies that have been flagged. So, as a global entity, does that concern you as an investor, with you looking at India as a geography where you're looking to expand your footprint?
Not really. See, these are rare cases, and they have happened not only in India, but even in the Western developed markets also. And I would not be concerned because if I look at the governance framework, if I step back again, and when the private sector banks were born, when the IT sector was born, these are the two guys who brought this solid corporate governance framework. The two top banks run by the two top CEOs attracted 5 times price to book, when all the banks were trading at, including our national bank, was trading at 3 times. Why was it so? If I have to dissect, at least 1x was given to their own credibility. So, and IT was born with a high governance, barring one IT company. So So I would say that it's not that a recent phenomena for corporate governance. India has seen a robust governance framework, and we are working with the who's and who's on the private equity world, many of the foreign strategics, where governance is prime. So they would not accept us, or they would not invest in our companies. They are funding as a partner so many $1 billion of M&As. So all this, without the governance framework, it would not have been possible. So one-off accidents here and there's not too much to read into it.
Got it. Thanks, Alok. So, Dave, I also wanted to understand a little bit on the multiple trend lines that we're seeing in India in terms of inbound, outbound. While on one hand, we're seeing global players come in and do these very attractive acquisitions, we're also seeing Indian entities be very ambitious in terms of how they're looking at their overseas expansion. So how would you sort of explain the dichotomy that we're seeing? I mean, I know there is no one-size-fits-all solution to this, but typically, how are you sort of seeing this pan out in the cases that you handle?
You know, it's an interesting trend. I wouldn't quite call it a dichotomy. Because that dichotomy makes it sound like there is capital need here, but capital is going elsewhere. I would think of it slightly differently. It's a sign of, I think the fag end of my previous answer I mentioned, it's a sign of India maturing to the point where those who need capital are open to receiving the capital from onshore or offshore. But it's also a sign that businesses in India have grown really well. And they don't want to limit themselves just to the great growth that India continues to offer. But there's no reason you need to limit yourself today. You know, if you think of going cross-border, and people always say this, going cross-border is a transformational or a generational decision. You don't do it for 2 years or 3 years. You do it because you want to become a global business. It's not something you can scale back very quickly. But it's a great sign that Indian companies are doing it. Historically, I think Alok made that example. You had early examples of very large conglomerates who had big balance sheets, were the only ones who were looking to go outbound and doing large deals. Today, nobody limits themselves, whether you call yourself a conglomerate or a mid-cap or a large cap, doesn't matter. If you have the financial wherewithal, a solid balance sheet to do it, if there is a good strategic sense in doing it, if you have the business capability to expand globally, there's no reason you shouldn't. So I don't think outbound M&A is necessarily a sign or a corollary or a dichotomy to inbound capital. It's actually a sign that some businesses in India are doing very well and they're thinking far, far ahead as opposed to just for the next 1 to 2 to 3 years. And so one, I think it's a very good sign of Indian companies growing. Second thing it does show is India is no longer just a net receiver. It will be a net receiver of capital, as any country should be as far as growth is concerned. But it's also a good, mature ecosystem of two-way M&A happening, which basically means no business or no pool of capital needs to think of an Indian business as Indian only. Things can transform. When you invest, it may be an Indian business. When you exit, it may actually be a global business. That's a great sign. That actually means you're able to go where the opportunity for growth is, as opposed to limiting yourselves by borders. It is important that it's done responsibly.
Right.
It is important that it's done in a mature, capital-efficient way. Otherwise, there can be a pullback if 2 or 3 high-profile acquisitions go south. But as long as it's done responsibly, which so far seems to be the case, I think it's a very good sign, actually. And it's actually a sign that India will continue to be a big, or Indian companies and foreign capital and Indian capital will be they will continue to find ways to cross borders in a constructive way, one way or the other. And I think it's good for the country overall.
Got it. So, Ashish, this discussion would be incomplete if we don't talk about the crisis that's happening worldwide. So, are you seeing any pullback in the deals that are happening, any slowdown? Which sectors have been immune to any kind of impact, so to say? And how are you sort of deciding on valuations for deals in the current market? Like, what is your evaluation strategy?
A lot of questions there, but I'll try to address them, one by one. I would say, yes, people are, sitting and waiting and evaluating, right, how to navigate the current crisis where to put capital at work, right? There are some sectors, which are globally focused. There are some sectors which are far more domestic, where people have started thinking about second or third order impacts, right? Because at some level it impacts either revenues, at some level it impacts costs, or costs of procurement, right? That said, look, when there are two types of players that we've seen in the market, right? One is, of course, strategics who have a far more long-term view, have the ability to kind of, take these risks and bets in this environment because they are looking at running businesses in perpetuity, right? As the base case. Private equity, there is significant amount of dry powder which has been raised in the last couple of years, which is waiting to get deployed, and the most attractive markets continue to remain India and Japan, right? So this is transient in our view. Yes, you will see whether it's geopolitical, whether it's AI-led disruption, right, which is causing nervousness in certain sectors in India, but still, we continue to see a lot of conversations in sectors like financial services, in sectors like healthcare, in sectors like, infrastructure, renewables, power, right, which are pro-AI, at least in the current environment, right? But yes, I think from a valuation perspective, it's a very case-by-case conversation. As I said, it impacts different companies in different ways. Long-term appreciation of the Indian market has not gone away. In fact, the number of conversations have only increased, I would say. And I'm sure, Dev and Alok also see it on a regular basis.
Thank you for that, Ashish. Maybe, we're almost run out of time now, so we'll take one question from the audience.
Hi, this is Sinha from Mint. We are increasingly seeing that in a lot of processes, the domestic strategics are actually competing with PE investors. And PE investors are often getting nudged out because the domestics are very aggressively bidding. So what do you see? Do you see this as a sign of them having more confidence about the market back home? Or, why are they being able to pay top dollars to compete with PEs?
I'm happy to take that, and that's a good question. So, the style and type of deal making is very different for most parts, and it overlaps in certain cases. Domestic strategics, have approached market from two perspectives in the recent past, and there are multiple examples of this. There are people who felt, or some strategics or conglomerates have felt that, look, scale is a durable advantage, and let me scale up, and I'm able to drive more synergies out of the acquisition, whether it's in the form of distribution, whether it's in the form of costs, and I'm able to kind of integrate and run these businesses far more better. And there are playbooks that are emerging, across sectors for that, right? There is a second set of strategics or domestic corporates who said, look, I want to diversify and get into new lines of businesses, right? And, ability for them to run those businesses, create scale within those businesses is different. I would say those are the cases where we've seen, corporates, emerge as probably more successful winners, right, for buying businesses. Private equity typically, or, private capital markets, take a very different view. They are more about acquiring a business, doing tuck-in acquisitions, financing them very differently, working off a professional management, and then eventually finding exit paths, right? So it all depends on, what sector you're talking about. It's not a broad brush that, corporates have emerged over, private capital, right? There are examples across both spectrums. The DNA of acquiring, running, and scaling up of a business and the playbooks are very different.
Just to add to what Ashish said, a private equity, 20% hurdle rate cannot afford to pay 40 times EV/EBITDA. They have a limited time frame. Promoter is there for a perpetuity. And many of these are conglomerates. So they have group synergies. A guy who's having 400 million customer, he can use that customer base across the business verticals. So he would tend to pay more. And he knows India, he's familiar with the geography, he knows the DNA. So his ability to pay is significantly higher than the private, but he can't go irrational. To answer your point, I would say private equity and promoter will exist together. It cannot be either of. India is still capital starved. We need to import capital. So this coexistence would continue for a while. But India is still jugaad in a positive sense. So this jugaad will differentiate the bold from the best.
I think we've come to the end of the session. Thank you so much, Dev, Ashish, and Alok for being here with us today.
Thank you for having us. Thank you.
Thank you. Thank you so much. Can we have a round of applause to thank our speakers as well? I'd like to also request Priyambada to present a token of gratitude to all our esteemed panelists. And that being said, we'll also set the stage for our next discussion coming up, which is all about India in a fractured world economy. I'm going to urge you all to please come together. We'll have a photo op as well. Thank you so much again. Thank you. All right, we're now heading to the big shift as we talk about how global economics is at crossroads. And India, in fact, stands out as an opportunity in this volatile landscape, as an opportunity as well as a challenge. A fast-growing market attracting global capital, yet navigating risks from inflation, policy shifts, global uncertainty. So let's get to discuss all that with our next panel discussion that's happening right now. As we quickly set the stage, we're also about to invite our session moderator for the same. In fact, the session will be spearheaded once again by Mr. Alokesh Bhattacharya, Deputy Managing Editor, Mint. And we're about to start the session now, so I'd like to request the delegates to please take your discussions in the pre-function area so that we can move ahead and get our next session started. All right, another pertinent, yet another interesting session in store for all of you. First up, if I could please invite Mr. Alokesh Bhattacharya to please come on stage. And with that, let me also move forward. And let me go ahead to invite our speakers who are here inside the hall. We have with us Ben Powell, Managing Director, Chief Investment Strategist for Middle East and APAC, BlackRock Investment Institute. We have with us Ashima Goyal, Emeritus Professor of Economics, Indira Gandhi Institute for Development Research. Two incredible leaders. Can we have an incredible round of applause, everyone? Let's bring it back in the air. You know, diverse set of discussions happening right over here. So with that, Mr. Alokesh, over to you.
Thank you, Kavya. It's a grim situation, and we are going to talk about West Asia and its impact with somebody who's come from West Asia, and Ben is based in Abu Dhabi, right? I got that right? That's true. Yes. And he said very casually, there's a bit of a problem in West Asia. In India, we understate differently. We say, oh, it's a fractured economy. The world is going to explode, you know. You should look at our news channels for a bit of context. But yeah, jokes aside, you know, the situation is really grim. But today's topic is on, you know, fractured economy and the impact on growth, capital, and risk. But as I've discussed with my panelists, we'll do it in reverse. We'll talk about the risks first, then about capital flow, and then about economic growth, because the first two feed into the third. Now, we are in the midst of a major oil shock, and oil has gone above $110 again today, after being under $100 for 2 days, right, after the president announced a bit of a ceasefire, not really a ceasefire, but a pause on energy infra. But let's say if this disruption stays, right, and oil is in 100, 120 kind of situation, how does the transmission play out, right? How do you see it playing out between inflation, between current account and GDP growth? Where does the first crack appear? Dr. Goyal?
Thank you. So as we discuss this very serious issue, I think 100 is a red flag for us. So we tend to really get worried by that. But I think we need to understand what this 100 means. Because if you deflate it by the GDP deflator, or consumer price index, then this 100 is only equal to 56 today. And it was 71 after the Ukraine war and 100 after the COVID crisis. So the oil shock is not that large. And most estimates, but if it persists, then the issue is, will it persist? Will the war play out beyond 2 months or 3 months, in which case it would have effects on inflation, etc. But most estimates say about 1% rise in inflation, 1 to 2%, 1% fall in growth, and 1% rise in current account deficit. But the catch today is that for India, inflation is at 3%, even below our target, and growth is high at 7%. So when, say, fracture or stagflation, if you're growing at 6% and inflation is 5%, that is certainly not stagflation. The current account deficit also is low, so although foreign portfolio inflows, and I'll leave it to Ben to talk about that, are very worried and are very in highly short positions, even after a lot of outflows. But we have large reserves, and we should be able to deal with that issue. And throughout, we have seen that whenever there are periods of outflows, they sort of come back, and the reserves help smooth these issues. So I think we are in a good space.
We are in a good space, okay.
To
Ben?
deal with the shock. I would say adjustment, not fracture.
Okay. Okay. Would you agree with that, Ben?
Absolutely. So the doctor makes many excellent points. I won't repeat them, but the resilience, I think, is the key point, right? The world has had a number of oil shocks over the last many years and decades, but the starting point is very important, I think it's fair to say. And India, the growth, the inflation dynamics, the reserve dynamics are very different from different examples through history. So it's going to be choppy sailing. It's going to be a difficult kind of set of circumstances for the next period of time, let's say. But clearly India has buffers, has a resilience, and has the ability to get through what should be a slightly difficult time, and then get back to the fantastic structural growth of demography and productivity and all of those things which are true and ongoing, at least in the opinion of BlackRock. They're just going to be a little bit, not obscured, but a little bit confused by the shorter-term energy situation.
But what if this war goes on for, let's say, 6 months? The scenario changes. And would your answer still be the same?
So I would like to flag the COVID playbook here, because what we discovered there was, counter-cyclical use of excise and short-term liquidity injections with a deadline, so they don't create moral hazard and so on. So rescuing the vulnerable in the short term, and in the long term doing reforms. A crisis helps you push through reforms. Right. So we have been pushing for green, for the environment, substitution away from oil, reducing our oil vulnerability. And this will get a big push if the crisis persists. And I think the oil countries are worried. They don't like oil prices to be really high because they know that it creates this substitution away from oil, and some of it sticks and the demand for oil falls. So today oil futures are quite low because they expect oil prices to fall in the future. So then even 6 months we can absorb. The Ukraine inflation stayed for post-Ukraine conflict, stayed for about a year. But the next year we had very good growth, right, and inflation fell within the target. So we were able to absorb.
So you're still positive, even after 6 months. And Ben?
Yeah, again, I think some excellent points, if I may say so. Firstly, I guess over the last even 20 years, going back to the global financial crisis, central banks globally are now, it seems to me, I'm not a central banker, but it seems to me they're so much more prepared for unusual sets of circumstances, because we've had a few of those along the last 10 or 15 years. So the toolkit is now not just theoretical or intellectual, it's been tried and tested. So I think hopefully we don't have a more prolonged situation, but if we do, we should have the tools globally to continue to provide liquidity into the system and keep things, let's say, ticking over. So I don't think it'll be a particularly vibrant time, but there shouldn't be any risk of a sudden stop, let's say, because the central bankers have learnt so much on the field, as it were, not just in the academia. This is very important as well, by the way, but also as practitioners in the market, if you like. And I hope not, but if we need to, we can rely on them to help us get through this moment.
Okay. The other thing that people are really worried about is the rupee. And that rupee has been depreciating quite steadily. And how much depreciation is like macro stable for India? Is it like 3%, 5%, 10%? And does the RBI step in after that, aggressively?
I think the RBI is already stepping in. Their policy is to prevent excess volatility, let the markets discover the equilibrium value. But if you look back in the past, whenever there have been these episodes of crisis, oil shocks and so on, or the COVID pandemic, the rupee did depreciate, but then it recovered after that.
Okay.
So there is a real effective exchange rate that we call, which is around 100, and research shows this is still an equilibrium. So today the rupee is about 10% depreciated compared to that. So actually, if it's going to go back to equilibrium in nominal terms, it should appreciate. Okay. Since last year, unfortunately this time after the elections in the US, the kind of really economic volatility that we have seen, there's been continuous pressure for over a year. So already there's very large depreciation. And I don't think we're really moving away from equilibrium. And the next move, once things calm down, should be for the rupee to appreciate. So I don't, and meanwhile we have reserves. If you say, okay, well, 25 billion FPI has gone out, but total FPI is around 200 billion in India, but our our total reserves are $700 billion. Yes. So we have enough surplus to take care of the risks.
So is there no risk, Ben, or at what level of depreciation do you start to reprice the India risk, or not just the currency risk?
No, I would think of it in a different way. So the joy of a somewhat floating currency is it's a shock absorber. So it's doing its job to some degree. As we're saying, we don't want too much too fast, and it can become a bit untidy. We don't want that. But to a degree, a weakening can be something of a shock absorber for this broader macro shock. I would say in terms of the flows, I can't speak on behalf of all global capital, but BlackRock, the world's largest investor by far, we want to be spending more capital into India. Right? We're a bit nervous. So as they say, capital is a coward. We're very anxious. We want to look after our clients' money. It's appropriate. So we don't want to be too brave. Right? We don't want to be too brave. But as and when, and this will happen, I don't know if it's over the weekend or next week, but when we get clarity, for sure, we want to be investing incrementally into India for all the reasons everyone in this room understands very well. We can summarize as very strong growth, ongoing kind of reform in direction we find favorable. So in terms of the flows, the capital flows, we want to do more, I think it's fair to say. We're just a bit nervous given the short-term energy situation. So when we get resolution, and this will happen, we don't know when, but when we get resolution, I think actually you can see a turnaround in the capital flow picture, I think, quite quickly.
Really? You have something to add to that?
No, I think that is really correct. But would you say that capital is worried about depreciation also, because they are waiting for the rupee to depreciate, and then they're worried they come in and it depreciates more. So therefore, if this reverses, there's confidence that the rupee is going to strengthen. That will help capital.
That will help. So you're supposed to buy low and sell high, is what they teach you. In my experience, people much prefer buy high. They like to buy once it's already going up. So as I call it, price leads sentiment. So why are you happy? Because it went up. So yes, it's a bit non-intellectual argument, but you will have, if you have a stability, even a little bit strength, likely it can accelerate. So I was interested, you remind us, in previous kind of sell-offs, the recovery has been quite sharp. This makes sense to me, because if I'm there trying to run a profit and loss account, I see something going up a bit, appreciate, get a bit stronger, oh, I like it. So it's not intellectual. You should buy low and sell high. But in my experience, people like to buy on the way up, if it makes sense. So yes, it's normal. If we see some stability, even a little bit strength, this can become self-fulfilling a little bit.
Right.
Price can beget buying, beget price, beget more buying for some period of time, and the recovery can be quite sharp.
And similarly for equity, because over the last really volatile year and so on, because of domestic SIPs and DIIs coming in, they now own a larger share of Indian equity than foreign investment. So the equity did not really fall, but after this latest oil and so on, it has fallen. So it's much lower now, and therefore it's profitable for FPI to come in. If they don't now, then DII is going to come in again, and they're buying the opportunity.
But FPIs are going out, right? About 25-30 billion is like any other EM cycle. You're right in that the DIIs have really held up the market in that sense.
Right, they have held up over the last year. But the current crisis, there is more of a dip than there has ever been in the past year. So that is a buying opportunity.
So is it going to remain like any other EM cycle, or is it going to be different? The FPI outflows are quite strong, even though, like Dr. Goyal said, we have $200 billion of
So let me address the title of our panel. We think the world economy is indeed fractured. And for us at BlackRock, we've been talking about this for 4 or 5 years. So we're talking about a world which is choosing to become less efficient. Seems a bit strange, but you're seeing tariffs, you're seeing a rewiring of supply chains, and within the geopolitical kind of sphere, sadly, from my perspective at least, you're seeing less trust, less comfort in relying on your neighbors, and a movement in the direction of self-reliance, as the Chinese sometimes call it, and a more resilient supply chain. So that's fine. That's a political choice that different countries can make. The trade-off for this, though, is a little bit less efficient, a little bit higher inflation. So I think we're going to see this structurally higher kind of inefficiency globally. Maybe India is actually a very interesting, different situation, but globally, more inefficiency, structurally higher inflation, and what we're seeing now is a kind of very acute example of what we're talking about. So hopefully we get through this moment. Surely we will get through this moment at some stage, but even then, our sense is that we are in a fractured, complicated global situation, and we'll get through this one, but that kind of new macro regime we think is now something of a feature which is likely to last for a more medium or even longer term.
Right.
Yeah, but do you think, sorry, can I ask you?
Of course.
But do you think that markets are overpricing risk in EMs like India and underpricing in the US, just because the US is a high per capita income, but their policies,
also,
as you're saying, many of these policies are contributing to the fractured world, while India has been trying to do things right, but that's not recognized.
It will be recognized. Keep going. Really, it will be recognized. So BlackRock, as I say, I don't mean to be marketing to you guys. It's just a fact. We're the largest investor in the world by far. We have a strategic overweight to India for the reasons you spend a lifetime understanding. So the structural growth story, demography, GDP is easy, right? It's just labor force times productivity. Labor force, as we know, by the end of the decade, 1 in 5 global workers will be here in India, and the astonishing efficiency gains. This is what I try and teach the foreigners. They underestimate still the efficiency gains, the productivity side. I think they get the demography because it's quite straightforward, but the efficiency they still, in my judgment, underappreciate. So they will get it, but at the moment, they're just taking their ball home. Right? They're just a bit scared about everything that's going on. Don't complicate it. Just flatten your risk. Sell everything. You like it, you don't like it, it doesn't matter. You just sell it, you hide a bit, then a bit more clarity. We can come back to the list of things which we like. India, again, for the reasons we talk about, should be on the list. So the way I put it, India doesn't do anything wrong. The opposite, right? India is doing many good things, but they suffer a little bit in the last 12 months because they are not currently, I can say more on this if you're interested. Currently, India is not in the spotlight around the AI super boom. This is not India's fault, right? But it's more Korea, Taiwan, some of the American names. Okay, so it's not such an AI. And then the energy problem is obviously relevant as well. So this is not a failing of India, right? It's not their fault, but it's a global reality that the global capital is reacting to. But I think the overall structural view, as per BlackRock, is to be overweight.
Yes,
Dr. Goyal has another
AI,
question for you.
I wanted to touch on this AI because what you're saying is very important. But, we had this AI summit, and the government is trying to tell the story that we have this DPI, digital public infrastructure, and we think AI can really, as you're saying, productivity, efficiency, use cases, refine the big models so that they contribute in health, education, and so on. And that can really improve the low-level productivity, which has been a constraint for us. So then the AI story should actually play out as positive.
So this is the history of technology, roughly. So when I was not there, I'm not so old, but when the guy invented fire, for some period of time, he was the hot ticket, right? But then the magic is when they call it diffusion, when the technology spread and the user is the user of the internet, the user of electricity, the user of fire, that's become the winner over time. So we are going through a normal technology story. In the first instance, the excitement is around the creator. It's not wrong. It's not wrong. It's normal. So the excitement is around the creator. But over time, as per the excellent comment here, it will be the adopters that win. So I challenge all of you, India, you should be using more and more and more individually, at the corporate level, at the societal level. And if you do, can we achieve societal level productivity gains, efficiency gains, at the company level, margin expansion? I think so. Why not? But this is up to you, so keep going. But I think it should be yes. AI should flip from a headwind to a tailwind for India, as the AI story flips from the producer to the adopter. And it's not really just me talking. This is the normal story for technology over the last many hundreds of thousands of years. I think AI will be no exception to this.
So, yeah, you have another question, but let me get you to answer one first. Okay, you've been asking a lot of questions. Need some answers from you as well. Let's come to growth. We've spoken about capital, we've spoken about risks, and we have about less than 4 minutes left. Growth, very recently, Goldman Sachs, I think, cut India's growth forecast, right, from 7% to 5.9%. And so there are such estimates growing around. But what is your view on this? Has the growth really situation now become such that 7% is not to be expected?
No, as we were just talking about productivity improvements and this spending on infrastructure and various kind of financial structuring, which is helping the financing of it, as well as very strong balance sheets in the corporate sector, banks, and so on. So I think there's a lot which is positive for growth. And again, learning after the COVID playbook was the diversity of the economy helps. And both agriculture, services, manufacturing is government. So, even if there is some areas which are affected by fuel price rise and shortages, other parts because it's a diverse economy, other parts are immune and they will continue to do well. So overall, this sort of diverse story means it's like a portfolio, diversified portfolio gives you lower risk and good returns. So I think our growth will stay very decent. And if we do the right things, this green substitution, if we can really push ahead on that, then we can have very good, much even higher growth.
What is your estimate of FY26 growth?
FY26, that is this current year, 7%. But FY27, as I was saying, if this war persists, then it could have about a 1% reduction in growth.
1 percentage point. Ben?
That sounds about right to me and to us. On the diversification point, it is true on, if you like, the asset side, having a diversified economy, and also on the funding side. So I think what we'll see is this acute problem will likely, this is a global comment, maybe it's true in India, I think will be true in Europe, it will create a political kind of response. They say never waste a crisis, right? I don't know if it's a crisis, but it feels a bit like it. So maybe this can create a serious political conversation in many nations around diversity of funding, capital, security of supply, security of energy, and so forth. So I think this is an extraordinarily interesting moment where we are going to be focused, as we say, on the diversity of the economy, but also on how we fuel and fund the economy, because sadly it feels like we need to be more resilient in a more fractured world economy.
Dr. Goyal, I must ask you this question. We have like 50 seconds left to go. As a former member of the MPC, if you were in the MPC today, what would be your recommendation in the meeting, which is going to happen in April, first week?
Yeah, I would say pause because there's a lot of uncertainty and we have time to respond. Yeah?
Hmm.
Yeah.
And stance would be?
Stance would be neutral so that you can move in any direction as required. And the guidance is data-based. We found that really worked. Don't commit to something time-dependent that you won't be able to hold to. Say you're responding and say the structure, what the data is going to teach you. Teach that to the market so they understand, they can anticipate what you're going to do.
And do you expect the current MPC to do that?
I think so, I think so.
You think
At least
so?
in this April.
Okay. Thank you very much. We've just run out of time. I have some more questions, but we don't have time to ask those. I think Dr. Goyal has done a lot of questioning. So we got a lot of insights from Ben and from you too. Thank you very much for coming.
Discussion.
Thank you so much. Thank you.
Thank you. Thank you so much. If I could please request Mr. Alokesh Bhattacharya to present a token of gratitude to both of our speakers, to Ben Powell and to Ashima Goyal. Thank you so much for joining us. That being said, what we're now about to do is take a quick tea coffee break so you can also connect with our speakers offline. And we'll do the break for about 20 minutes so that we can be back again for our next panel discussion, our next session rather, that's about to take place. And the next panel is all about the dispute resolution and contract enforcement in India's investment economy. That's the underlying theme of our next session. Please enjoy the tea coffee and see you all in 20 minutes. Thank you.
break and a whole lot of conversations as well. But that being said, let's quickly deep dive into our next panel discussion. And we often notice that as investments scale and transactions become more complex, the spotlight is firmly on dispute resolution and contract enforcement. We're talking about speed, predictability, and fairness, because these are no longer the legal ideals. They, in fact, are economic imperatives. So this conversation goes to the heart of India's investment story, because in the end, it's not just about how deals are made, but how reliably they are honored. So with that, let's begin. And first up, I'd like to please invite Devina Sen-Gupta, National Editor, Mint, to please come on the stage so that Devina and I, we will welcome your legal Maharathis, your leaders, your incredible speakers here on stage in a minute. With that, ladies and gentlemen, let's bring all the energy as I continue inviting our speakers on stage. First up, we have with us none other than Amar Gupta, Joint Managing Partner, JSA Advocates and Solicitors. Well, up next, let me please invite the Chief Legal Officer of Marico, Amit Bhasin. And we'll keep that applause going as I now invite Debulina Pratap, Senior Vice President, Legal and Group General Counsel, Wokout Group. Let's also have a healthy round of applause, everyone. Let's keep it coming. And this is another important session right here at the summit. So all eyes and all ears, here we go. With that, I'd like to request all of you to take your seats. Thank you so much for joining us. And on that note, Devina, over to you.
Thank you so much. It's so difficult to get lawyers outside courtrooms. I'm not going to waste any more time and just start grilling all of you all right now. Ease of doing business. As per the World Bank data, India ranks 163 out of 190 countries. We have a long way to go. How much are the problems as far as dispute resolution or enforcement contracts, the challenges that we face? How much can that change for us to improve our ease of doing business? And this is a question I would like all of you all to answer before I go one-on-one on the others. Debulina, let's start with you.
Yeah, thanks, Devina, and good evening, everyone. Thank you, Mint, for giving us and myself and my co-panelists this opportunity to be here with you to share our views. At least, as far as I'm concerned, I have a caveat. The views are my personal views and not that of my company. This is very standard compliance requirement. So, Devina, in terms of, why India is so low down in the rank, I have got 3 bullets for this. Firstly, up to a few years back, and especially for in-house counsels, like I have been an in-house counsel for now, I think about 30 years. The dispute resolution clause, the legal, that is the law clause, governing law, and the jurisdiction clause, as we know, they are boilerplates, but they were literally the midnight clauses. So people never gave that much of importance because they thought, that okay, these just, cut, paste, and you do it. But I think it gained a lot of importance when the economy started opening. Of course, that was way back in 90s, but where really investments started coming into India, in the late 2000s. And at the same time, the global economy went for a turmoil. There was, the downturn in 2007-8. A lot of contracts were getting enforced. There was a lot of financial insolvency across the globe. A lot of big banks, including Lehman Brothers, going into insolvency and all. So that was the time where really lawyers started thinking that these boilerplate clauses are very important. And today, lawyers and also in-house counsels give a lot of importance to how do you choose your law. There are judgments in India which says, what can be, how it can be chosen, what can be chosen, what cannot be chosen, how you choose your jurisdiction, and very important, how you choose your dispute resolution, whether you want to go for an ad hoc, institutional, and if institutional, where India suffers there. Because India, the institutional arbitration has really not taken off compared to, you say, Singapore, London, ICC across the globe. London, when I say LCIA, HKIC, Hong Kong, even Malaysian arbitration and Indonesian arbitration is going ahead of, MCIA today. MCIA has gone ahead of Delhi, of course. One of my co-panelists, Mr. Amitji will not agree. But, that's how it is. Our institutional arbitration has not taken off. Second thing is, who is going to be the member of the tribunal? Are they always going to be retired judges? Will they understand the complexities of the transactions which we have? Like a very complex EPC contract, a very complex O&M, a cross-border solar project contract. How would an ad hoc arbitration tribunal be really focused or will really be, I would say, proficient to understand the nuances of the obligations of the parties?
Right.
So it's not, I think India should think, to have non-judicial members also as member of tribunal.
That's right. I will go into the details of what constitutes a good panel in a while. Amit, I know you have no such obligations. Your opinions are...
I will not repeat my disclaimer.
No, there are no such disclaimers. Between reporters and lawyers, there are no disclaimers. Please.
So I will try and answer this question from a point of view of investor, because you asked what is the implication for the investor.
Right.
So put it very simply, I think, if you look at what is an agreement is nothing but really putting pen to paper of the commercial understanding between the parties. That's what essentially it means. The two parties are sat together, they decided that how we will govern relationship between both of us, and they decide to put it in a particular format. That's what agreement is, put it very in a layman term. Now imagine a situation where whatever you have agreed, you are not able to enforce it, right? You are not able to kind of get the other person really go as per our agreed understanding. The whole purpose of agreement fails, right? So that's what enforcement and that's what enforceability of the agreement is important. In that context, I'm trying to put it very, very simply that way, right? If you look at from any party point of view, what are the three things they look at? If tomorrow, obviously when you sign the contract, you always hope and pray that it doesn't get into dispute resolution, because the purpose of signing an agreement is to get the commercial things moving and whatever you have decided from a business point of view achieved, right? But if there is a situation where there is a dispute, you want three things. You want it to be resolved in a timely fashion.
Right.
You don't want to incur additional cost on it because there is already a loss that is being incurred because commercials are struck. And you want that what we call it as the right principles should prevail, which means the judgment should be right and should follow the equity, right? These are three things. Now, in current circumstances in India, what happens is, because we have a complex judiciary system where the cases may take a lot of time, there are procedural aspects to it, the timeliness of a dispute resolution goes completely for a toss, right? That's where from an investor point of view, it becomes more frustrating, right? Then you have commercials which are already stuck. You end up spending more money into litigation, lawyers, the time value of the money that you are losing. That is the second thing. And thirdly, you are not very sure what kind of a judgment you are going to get, right? So those things really put, if I have to again look from an investor point of view, your capital at risk, right? Whatever you have invested or whatever you wanted to put, it puts capital at risk. And therefore, coming back to your point, why the India ranking is low on this, if you are not able to enforce what two parties agreed in a swift way, cost-efficient way, it will definitely bring the things down. If many of the contracts, and all of us sitting here will agree that the counterparty actually agrees that let's take a jurisdiction for arbitration outside India where the process is much swift.
I'm loving the way that neither of you, despite the disclaimers, have, taken the easy way out. You all have said timing has gone for a toss, resolution delays have happened. And Amar, I wanted to know from you that Devadina kept saying Amar may not agree, Amar may not agree. Amar won't agree to what? Is the gap between legislation and implementation that big right now?
Actually, Amit has framed it very well. There are two aspects on which India needs to do better to improve its ranking. One is the efficiency of resolution of dispute, And the second point that Amit made, which is very important, which is actually at the core of rule of law, which is predictability. Being able to foresee or determine the outcome, predict an outcome based on the available decisions and jurisprudence of the court. So predictability is also a very important part of it, which Amit has alluded to. Our deficiency of our systems on both these aspects, there is a study that it has cost us 1.5 to 2% of GDP. That's how significant the failure, the cost of the failure has been. The failure to be able to enforce contract swiftly, efficiently, and in a predictable manner has cost India, in terms of its GDP, 1.5 to 2%. That's how important it is. And therefore, so that's the assessment of where we are. And what we can do to fix it, there are no quick solutions. It's a hard work, and it needs institutional and the regulators' determination. As we go along, we'll elaborate on that more.
Right. You know, one problem that a lot of lawyers keep saying is the judiciary or the bench doesn't probably often understand the economics of business, the cost of time, how much the delays cost companies or corporate sector. Debudin, I wanted to understand from you, what would an ideal or the best case scenario arbitration bench constitute of? Do we have the benches who have the awareness of it right now?
So, Devina, this is, you know, you will not get a straightjacket answer for this. Essentially, it depends on what you have agreed, you know, how you have agreed your arbitration clause or dispute resolution clause in the contract. Now, if you have agreed for a single arbitrator and the counterparty is in a dispute, they will never agree to a common single arbitrator. That means you have to go to court under the Arbitration Act, have a court-appointed arbitrator. We don't know whether that arbitrator would be, would have the knowledge in terms of, you know, the industrial dispute. I don't mean the labor industrial dispute, but the dispute which the company is facing in terms of, you know, the performance under the contract. Of course, he would be an erudite in law. So, you know, there again, you know, you're left at large. Now, if you have a 3-member tribunal clause, then obviously, you know, you have one of the parties will select one arbitrator, the other party will select another arbitrator, and both of them will select a third one. There, at least, you have the leeway. If you have a highly, let's say, an engineering dispute, or if you have an intellectual property dispute, you would see whether you would want a lawyer to be one of the tribunal members, or you want a very sophisticated engineering firm represented by somebody to be a tribunal member. You do have that leeway. Institutional arbitrations, of course, they are expected to have arbitrators who know how to decide on the commercial disputes in terms of various kinds of contracts. So there is no straightjacket answers, but if you only go for, you know, ex-judicial members or ex-judiciary members, there could be the risk.
Right. The practicality of it is missing,
yes,
basically.
Yes.
I mean, they're great in theory, but again, the understanding of economics.
Understanding of economics, and I don't want to comment on the lawyers community because the practicing lawyers community, because whether you do a mediation or you do an arbitration, again I will say, you know, I don't want to comment because Amarji is sitting there.
The disclaimers kick in, right? Amit, coming to you, okay. Pandemic seems now a different lifetime. But in 2021, 22, when corporates across the world were suffering, as far as the business is concerned, a lot of contracts got reworked upon, you know. And just when that happened, we solved the supply chain crisis, etc. Suddenly we have the West Asia, and it is a war. It's not even a crisis anymore, right? And again, we see force majeures coming in. and countries are declaring it as well. How complex is the situation for corporates like y'all and others in the sector and others when you're constantly reworking on your contracts?
Yeah, I think, yeah, you're right. When COVID happened, then most of the business colleagues would have rushed to their lawyers to say, is there a force majeure clause? And yes, there was a force majeure clause. As Deblina said, it was always a boilerplate clause. But it never conceptualized a situation like lockdown, right? So lockdown as a term where people movement, vehicle movement restricted was not conceptualized. So yes, after COVID, it became a thing for lawyers to start looking at the contract and start putting up clauses which contemplate that kind of a situation, because force majeure was always traditionally and conventionally was looked at an act of God kind of a thing. Right? But this was not an act of God kind of a thing. This was a state decision that was taken, which was not contemplated. So yes, there were a lot of disputes also which happened whether this is a force majeure clause or not. Having said that, I think post-pandemic what has happened is that the conversations, and I'm telling from my practical example, that the conversations became more practical, which means you will have a clause which will say if there is a stoppage of the business, which is for X number of months or goes beyond X number of months, leading to a business impact of X, then I will consider this clause as an impact on the business, right? So it moved from a situation of absolutely abstract to a situation where there was some specificity which came in to say that if it impact the business, then I will invoke it, right? It also moves to talking of the example of war, right? The conversation has moved from the discussion of unforeseen events to a seen events. This is happening, right?
Let me understand this. Unforeseen reason, like a pandemic, to a
seen event. This is
seen
happening.
event, like a war.
War is happening, but whether it is impacting your business or not, or the agreement in question or not, is the discussion based on what this agreement is all about.
Right.
Is the business such which is likely to get impacted, at what level, and therefore what should be the penalty or incentives, right? So that's how the contracts are now evolving, where both parties are saying, listen, if it moves to a particular threshold, then only we will bring this clause into play. So it has become more realistic from an agreement's point of view.
Right, and this would be so difficult right now because we are seeing a war, but then the terms and conditions and everything about the war is as unforeseen as it can get. Every other day is a new day for us.
Absolutely. And the last thing you want in any force majeure kind of a clause is that it should not be misused, right? Just because a war is happening, right? But no impact on your contract. You can still perform, but a force majeure is saying act of war. Can you invoke force majeure, right? So you don't want those loopholes also in the agreement, and therefore I'm saying you bring more predictability and bring more elements which makes you determine whether it is actually a force majeure or it is just something which is happening which is not impacting this particular contract. It may be impacting a lot of the contracts. It may be impacting something which is gas, and things like that, but something, example, hypothetically, technology related thing, no impact. Right. So I think you have to then play it case by case.
Right. And Amar, moving away from the morbidities of a war, if I come to you, and in 2023 we had the Mediation Act. The whole point of the Mediation Act was parties can come together, not necessarily go to the court, have a resolution. 2026 right now, how successful do you see it or not?
Mediation will succeed in certain conditions. It is not a solution for all problems of contract enforcement. The sectors which are more oligopolistic, where there are fewer players, in those sectors, mediation will likely succeed because the parties have to live together and do business together. And therefore, mediation provides a creative way to solve their problems. In other sectors where parties have hardened their positions and they are prone to taking very strong positions, mediation is unlikely to succeed. In India, so far as the story of 2023 legislation is concerned, I wouldn't qualify it as a complete failure. In some sectors, it has worked well, particularly in infrastructure sector. At least there is a beginning to see mediation as an option, and it is being resorted to, whether successfully or not, that's a question for debate. But as an option, it has become more popular and more customary than it was. So that's a step forward. And I think to make it more successful and more effective, there are certain regulatory and policy decisions that the government has to take. It has to empower the decision makers in the public sector undertakings, businesses, government enterprises in the infrastructure sector, so that they can take decision effectively without fear of any prosecution or action later on.
That's an important line, without the fear of prosecution. I'll just turn the cue to Amit again. Amar mentioned certain sectors which are more oligoplastic. Did I say it right? Right. Oligopolistic. Tongue twisters again. Would you say that, let's say, a manufacturing sector is going to be hit more by the delays than, let's say, a very promising startup sector? Or is it risky for all?
The short answer is it is risky for all, but the money on the table is, of course, dependent on that particular deal, right? Of course, deals like infrastructure, technological deals will have more financial implications because the clock is ticking. Coming to my previous point, that there's a money which is already at stake, you are in dispute, now the clock is ticking, you are losing more money over that money, right? So financial implication wise, the more money on the table, the more you lose by virtue of a dispute which is struck. That's the short answer.
Debutina, the role of a GC, how has that become very complex right now, given everything happening in the environment?
First thing, Devina, the GC is expected to give no failures. They can't lose a case. That is the expectation from the board, and that is the expectation from whichever entrepreneur you're working on. You just can't lose any case. And that is a very high level stress factor, especially the way global economy has, very frequently changed. Good times, bad times, it's been very cyclical. I mean, you mentioned about pandemic. Before that, I mentioned about, financial insolvencies across the globe. And then after pandemic, suddenly you had the tariffs. And then now you have the war. So the GC has to, he or she has to be a magician. You must have the best structure in place for your company and your subsidiaries in terms of taxation. You should have the best of contracts where, you can claim even in the worst of times. You can make a claim even in the worst of times. And if you're faced with a claim, then you should be a winner. In terms of compliances, you have to be very compliant. You have to, be, I won't say jack of all trades, but master of all trades in terms of, I come from a pharma sector, life sciences sector, so heavily regulated. So you should, be compliant and regulatory compliant, and yet you should not stifle the business because, the mantra is, too much of compliance stifles business. But no, you have to find that magic wand where compliance and business, it's like, the lion and the goat drinking water from the same pond, sitting next to each other. So the GC's role is, I would say, very interesting, very challenging. But yes, that's where we operate at. And I'm sure Amit will agree with me.
Right, there's never a recession for lawyers, right? It's always hiring session across law firms. And we just have 3-4 minutes left. So I'm going to ask one question and for all three of you, and 2 points each is, and I'll start with you, Amar, is 2 points that the government, the country, everything needs to do right now to ensure that this kind of deficit that you mentioned, or erosion of revenue because of dispute delays, resolution delays does not happen? 2 points.
Mainstream institutional arbitration, and secondly, and more importantly, make commercial courts centers of excellence and expertise. Staff it with expert, specialized judges, rather than the judges who does a family court for the most of his life. So specialized expert judges in commercial courts and mainstreaming of arbitration. Institutional arbitration, I think, are the two immediate actions that must be taken.
Right, thank you. Amit?
So I think something similar to what Amar said, but I think getting subject matter experts into picture. Right, because at the end of the day, it is a commercial contract whose enforceability is in question. It's not about interpretation of the law. Get someone who understands the intent of signing that particular contract, why it was done, and what is the commercial implication of it, right? So that the decision is swift, it is in the right direction, it actually helps enforcing the contract. So that's number one. I think second is using technology more. We have started using a lot of technology in solving litigations and arbitration mitigation, but I think we are still far from where it ideally should be, right? So use more technological advancement where physical presence may not be required, right? Use more ODR kind of a mechanism where the disputes can be solved even if two parties are sitting remotely.
Debolina?
Yeah, I will take part of the point of technology from Amit, but what I want to say is to use AI in the first level of processes across all courts and tribunals. Right now, a lot of registry work, filing work, removing objections, they take quite at least around 3-4 months if you really go by the departmental way. So you can just do it through AI, which would be much, much, much faster. And thereafter, in terms of actual arguments, only you have the hearings. Otherwise, do everything online, which is not the case right now, be it the tribunal work or the courts. So your disposal, what you would have done in terms of, your registry work, which is, the basic procedural work, as well as the pleadings work in 1 year or 18 months, you can bring that down to 3 months. And I think the government should encourage this and get some process legislation in this. I don't know how, maybe in every act or one act, and then have combination clauses. That is one thing, my view. The second thing is on adjournments.
Right.
I think there should not be adjournments. And if someone is wrong or then at least the lawyers should get alternatives.
Right.
Yeah, of course, in terms of disputing parties, worst case scenario, if somebody is sick or dead or something, I can understand, but there should not be adjournments. Because today I was reading one review, around 50 to 60% of the cases get delayed today in India is because of adjournments across India. So I think we should be more, government should be more mindful on, how the courts are functioning in terms of adjournments. But again, you get laws, then who will enforce the laws? So you have
the vicious cycle.
Vicious cycle, the chicken and egg story. But these two things are very important if we really want to get into litigation tourism or an arbitration tourism in India, like how we have medical tourism in India.
That's interesting, arbitration tourism. So unless one is sick, someone is grievously injured, dead is what the final thing is. And have a better arbitration panel. Use technology, get the experts who know the sectors, and not because they are just experienced, should help. We still have 20 seconds left, actually. Can we have someone from the, of course, this is one good time to ask the lawyers any questions. Any questions, please? I can't see, sorry.
Yeah, my name is Satish Dantegaukar. I'm from Asset Wise Advisors Private Limited. My question is that, can we, what is the way in which we can, try to pursue the government to reduce the time of decisions because it takes very, very long. And how can we do it as a institute or as maybe somebody like Mint and Times and all come together? And can we reduce the time of this judgment? Because
I will leave Mint out of it. So this question is strictly for the lawyers out here.
Yeah, no, it can be
so, no, we sir, are doing our job raising questions all the time. But of course, lawyers, please.
You were asking government decisions, right? Not the court machinery. You said government decision. You're talking of court machinery. Okay. I think I can kind of.
So we do have legal wings in FICCI, CII. As far as life sciences sector is concerned, you have the Indian Drug Manufacturers Association, where also there's a legal wing. So we do take up a lot of these approach papers and white papers to the government. But at the end of the day, it's the organization like CII, FICCI or IDMA who represents to the law secretary and all. Maybe I'll put in a word next time when I'm attending such meetings. So that's how it's like who will bell the cat and when, you know.
I think if I may just add, I think the good news for you is that government is listening these days, right? There is a lot of consultation that happens, as WNI is saying, through these industry bodies. And I don't know whether you're aware, there are a lot of Jan Vishwas bill, which has really either decriminalized or has kind of taken a lot of steps to fasten the process in the country. So engagement with government, regulator has become much more easier. If you have a valid point, they are ready to listen. So yeah, kindly engage through industry bodies. Thank you.
Amar?
Well, I think talk more and more about the issue at forums like these, and I think the government will listen. As Amit mentioned, the advocacy of a particular cause is best way to make policy changes. In a democracy, that's the best way to bring about policy and regulatory changes.
And if we have experts asking the right questions, I assure you we are writing the right stories. Thank you so very much. And we're out of time as well. Thank you so very much. Thank you.
Thank you, Devina. And thank you to our speakers. Devina, I'm going to request you to please present a token of our gratitude to our speakers for the valuable presence and valuable thoughts right here at the Mint India Investment Summit and Awards 2026. With that being said, the conversations continue, and we're now gearing up for our next session. And this is where, in fact, in our next session, we'll also get to focus on the expanding role of NBFCs in India's growth story. Another exciting topic coming your way. Let's stay tuned. Thank you so much again. Thank you. Thank you, David. Now, from empowering small businesses to bridging credit gaps where banks cannot reach, NBFCs are rewriting the rules of India's financial landscape, which is why today, with this session, we're about to explore how these agile institutions are fueling growth as well as creating opportunities and reshaping the way capital flows in India's economy. Now, to spearhead the session, we will be having Subhana Sheikh, Special Correspondent Mint. So, that being said, looks like our stage is almost set. In the next couple of seconds, we're going to do that really in a jiffy. But we'll have Subhana who will be spearheading this session for us all. And as we do that, we'll be going back to back with these set of sessions for our day 2 of the summit as well. So let's hold on to all that enthusiasm and all that curiosity for the next couple of hours as well. All right, so with that, let me please invite Subhana to come on stage. It's good to have you here. And with that, you and I, let's go ahead and welcome your speakers on the stage. First up, we have with us Shaji Varghese, ladies and gentlemen, the CEO of Muthoot FinCorp. And can we have a huge round of applause to also welcome Mr. Shaji right here at the summit. Thank you so much for joining us. And with that, let's also march ahead and invite none other than Ashish Mehrotra, Managing Director and CEO, Northern Arc Capital. We're talking about India's growth story. Can the applause also grow a little louder and louder? Let's do that. We love that indeed. Thank you so much. And with that, let the session begin. Over to you.
Hello. Yes. Good evening, everyone. Now, we have two veteran bankers here with over 25 years of experience in the industry. I'll start with, Mr. Shaji. He leads Muthoot FinCorp, which is one of the largest gold loan NBFC in the country. Then we have Mr. Ashish Mehrotra. He heads Northern Arc Capital, which is a platform that actually connects capital to undeserved segments in the country. So, sir, as you know, the theme of today is that the role of NBFCs in the country and how they're expanding. I wanted to understand, how are you reading the current environment and where are you seeing the biggest opportunities?
Okay, thank you, Savannah. Thank you, Min, for having me over. Now, the first part is the role. What I understand the question is, first part is the role. Second, where is the opportunity in the current environment? Okay, of course, the role of the NBFC has been so well pronounced for all this while. Just to throw some numbers, all of us know, probably a decade back, of the total supply of credit in India, it used to be just around 12%. Now it crossed that 18% mark is what I understand, and heading towards maybe beyond that. So clearly shows that, NBFCs have been growing and contributing a lot. And when you talk about the opportunity and the growth, it's not just about the growth. It's about the equitable growth, sustainable growth. The reality in India is we have maybe almost 3 dozens of scheduled commercial banks, 1 lakh plus of cooperative banks, and so on and so forth. We often hear this data, 6 crore Indian MSMEs, but only 20-30% do have access to credit. Who will bring that? I think that's the role of NBFCs clearly and responsibly being exhibited with the number which I shared.
Right.
So that relevance is only further pronounced now. Okay? So we are close to the customer. We have our ways of underwriting, offering credit, especially those families are not very rich in papers and documents.
Right.
Okay, so our relevance is far higher. We continue to do that. So the credit expansion is being substantial high because NBFCs have gone deeper with it. So there is a war now, I understand. There is a lot of share of voice suddenly gone up because of war. But this opportunity exists always. I'm sure war, we hope and wish, sooner than later will end. So it's not that war is throwing in, is that you mean current environment if you're referring to the war? I think that is, will pass by. But the core opportunity of India is stable and it's only growing. So because of the war, I don't think this opportunity has any, weekend or a new opportunity. Maybe, but the reality is there are millions. There is a huge, undersupply of credit. We are all at it.
Right.
So we will continue to do that.
Right.
Yeah. So a huge opportunity waiting for us, unfilled opportunity.
True.
We will do that.
So Ashish, sir, if you could just chip in.
Yeah, thanks. Thank you for inviting us. Delighted to be here and speaking with you guys. I think like Shaji said, clearly we live in a grossly underserved credit environment. If the GDP needs to grow, now I know latest estimate by Goldman Sachs, a lot of them has reduced it by about 50 to 80 basis point. If you need to grow at 6.5%, 7%, this means supply of money needs to grow 2.5 times. And you've seen, even in current environment, the credit growth is expected to be about 16 to 17%. Let's look at Feb number. We'll go by March estimate. If that's where the credit growth is, and if you take the overall credit market, systemic credit at about 210 to 20 trillion, 40% being serviced by by NBFCs, about 78 odd trillion INR, and that's growing at about 19%. This means because by the nature of the construct of the financial ecosystem, NBFCs have the last mile connectivity to enable the flow. Our genesis goes back to 2009-10 during the Andhra crisis, and our core thesis is how do we connect capital to the end people, whether you're a finance company or an end borrower. So we believe that the growth trend will continue. Obviously, when you look at from a risk perspective, you say will happen in 1 in 100-year risk events and what will happen in 1 in 10-year risk events. Obviously, scenarios tends to change. But our thesis is, as we navigate this through, obviously current crisis, as we speak, the current moment, you're seeing tightening of liquidity, you're seeing change, significant increase in the 10-year G-Sec yield curve. If the current scenario continues, we know the inflation will move up by about 100, 150 basis point. Current account deficit will go up. As a consequence, the income of the end customers, of the rural economy, of the emerging economy will see a little bit of contraction. And that means it could have a potential impact in a performance of credit. But the demand of credit ain't going away. Correct? I think that's where it is. And that means more robust underwriting using data, alternate data becomes need of it. The core demand for credit, irrespective of the sector, whether you look at MSME, you look at rural, and just try and take 2 or 3 quickly just to put it in context. Rural contributes about 40% of GDP, has about 8% of credit, grossly irrespective of product. So, just not put product in context. MSME, he spoke to 6 crores, what used to be 20 lakh about 10 years ago, registered Udyam Aadhar MSMEs. Now you have 6 crores. 5.7 crores of them are actually micro enterprises. These are smaller businesses, mom and pop. This one push the economy. They contribute large to exports, to services. They need credit. Only 20% of them access to formal credit. All that needs to happen, correct? So while we will navigate it through in the current environment far more cautiously, but the demand is robust, we all need to Shaji's point, act more responsibly, be more vigilant, be more cautious to ensure we serve the need in a way that we continue to run it in a responsible and a scalable manner. That's my take.
So you spoke of, we touched upon the war and, how lenders are, monitoring the war and the development. We're living in uncertain times. Given that, you're a gold loan NBFC, gold is always considered to be, a safe haven asset. And given this situation, it has turned so volatile. How are you managing this volatility, and how do you see this going forward?
Yeah, okay. So, of course, gold price has been elevated for quite a while. So, of course, there's a bit of volatility, maybe volatility further would have added to that. But please understand, the way gold loan as a business operates is little different. Now, there are 2 products in the consumer space, consumer finance space, are LTV, loan to value, regulated as of now. One is housing finance and the other one is loan against gold as a security. Right. See, at least till 31st of March, the maximum LTV allowed is only 75%. What we understand at a sectorial level, whatever report we are reading, at a LTV today is, far below 60%. There is enough loan to value cushion there. Now, lenders calculate the LTV based on the guideline as well, only on the bullion price. But for a consumer to replace, there is another 20% more to be added as making charges and other charges, right? So to that extent, for the consumer, the LTV is much lower than what is in his mind because he has to replace. So one more trend we have seen in gold is they always want the gold back. There are a lot more emotions and behind that than just a asset value, and they will just let go of gold, and it will lead into a situation of credit bureau score getting impacted and so on and so forth for a secured asset. It doesn't make much sense for the family unless they really get into a financial issue. Okay, the question on LTV, the average tenor of gold loan is below 6 months, though the contract period has been 12 months. So the real LTV on book is sub 60%. For 6 months, even if interest gets accumulated, with the correction, a moderate correction, in the event of default and we have to liquidate the asset, we are so well covered. So at a business level, we don't see a risk so far on, or moderate or reasonable volatility on the gold price is not going to really create a risk of unmanageable risk for at the business side.
Okay.
So we believe we are comfortably placed because the tender is also very short.
Right.
And the price which we calculate is only last 30 days average price. And if the latest price is lower than the average, we only take the lowest also. So there is enough cushion and risk tools have been built the way we calculate LTV.
Okay. All right. Thank you, sir. Ashish sir, I wanted to ask, you cater to MSME, unsecured, all of these segments. Which of these segments, you think would crack first if this war is to, get further prolonged? I mean, yesterday we had Neelkant Mishra sir saying that if this war is, continues further on, we'll probably see a world recession. And a couple of, the whole sector is now coming out of the MFI space. The stress is now just started to ease. So which sector you think would probably crack first?
I think let's just put slightly in context. So we are a platform which enables the flow of money to the underserved individuals and businesses. We bank both NBFCs, emerging businesses, and we participate directly. So across sector, but if I say it in the NBFC spectrum, about 2 to 3% of the NBFC credit flows through our pipe between balance sheet, investing through performing credit funds, investing, creating a marketable securities placement and bonds platform and everything. Clearly, if you look at it from 24 to today, or you look at from 23, at the bank level, GNP is down from 3.9 to 3.8 to about 2 or below 2. NBFC down from 3.9 to 3.2. So there is an improvement. But the reality is that you are also coming out of an MFI crisis where the market has almost shrunk by 30%. And they are on an elevated credit cost from 2% in 23 to about 6% today. Now, the reason of that elevated credit cost is a function of over-leveraging. And that means about 5 to 10% of those customers have other products. Now, gold, luckily, worked for them because gold price, barring last few weeks where we've seen a little bit of winning on the gold pricing, the gold price is appreciated. Everywhere else, we've seen the stress in unsecured business loans and a little bit of two-wheeler finance in the small ticket lap where we saw massive overbearing of these customers on both sides of the product, that there is a bit of risk. The good thing is that the MFI over the last 5 to 6 months have demonstrated a sequential improvement in the quality of performance. As a consequence, we believe that should continue for some time and we should see an improvement. However, the current recovery of other products might take a little bit longer. So I think we are in a little bit of that precarious position of the risk we were seeing in MFI, because if this will impact the compression of the income of the end customers because of inflation and other reasons, this could impact a little bit of delay in recovery of what we were there.
Right,
but today, if I look at it till today or till 2 days ago, the payments, the repayment, because we finance a lot of merchants, whether on a Paytm platforms, we finance every day hundreds, and we get to see about 60 million loans which we have done. We get to see a lot of that data. We've not seen any deterioration as of now, but it's too early to comment what it could be. In a moderate scenario, I assume 7 to 10% increase, but if the scenario elongated to what you said, Neelkanta said, then maybe it's much higher.
Right. We don't have as much time, but I'd like to divert the conversation and ask, how are NBFCs, how are you seeing the competitiveness, the competitive equation between banks and NBFCs evolving from here on?
Yeah, okay. Of course, both NBFCs and banks are in the business of supplying credit. But the way things have evolved over the years, of course, we compete undoubtedly. But on the other side, the way the sector evolved today is more collaboration. Such a large country, we just spoke about the underserved and the credit supply needed in this country. There is clearly identified opportunities to coexist and collaborate between banks and NBFCs. Over the many years together, look at the way, thanks to the regulator, the great job done by our regulator to facilitate this collaborative growth, okay, where customer being in the center. Look at the way co-lending guidelines just got revised. A clear message to facilitate supply of credit through NBFCs to the deserving families in India. On the other side, DA has further been, the new guideline, for example, around gold loan as well. We understand that it is further expanded a DA through gold loan as well. So the intent is very clear. Regulation, a conducive atmosphere to supply more. Then, of course, PTC, pass-through certificates. So there are a lot here happening. Right. Okay? Clearly an environment of collaboration, but the interest here is the consumer and supply credit. Very good environment. More competition, because in underserved market, then banks and NBFCs compete also means share of voice also go up. It helps to expand the market. Okay, that's what exactly is happening. Right. Because of competition between NBFC and the banks, we don't foresee margins to skews in the space many of us operate. I am not saying that all NBFCs are in the space. Those companies, NBFCs, identified a niche to operate for them, like Muthoot FinCorp in a space of large play is gold loan. The estimate is that whatever reports, sectorial report we read, even today, only 40% of the total market is part of the formal sector. 60% is still with money lenders and informal. More competition means higher share of voice. So it is, the classic case is gold loan. This product used to be looked at as a last resort for credit. Because of competition, it's not anymore. It's a well-accepted category to raise debt. It's helping the cause to an extent.
Correct. Yeah. We don't have as much time, but sir, my last question would be one thing that you're pretty optimistic, about in the whole India's credit growth story, and one risk, that you foresee in the future.
I think given the amount of demand we have, the ability for we're bullish on the way capital markets will play the role in creating more liquidity. Predominantly NBFCs are funded through the bank. But I believe that is a big trend. Since you cover bonds, we are one of the largest, the biggest issuers of the bonds platform on the credit we play in called Altifi. I think those will become, this means the access to money which NBFCs need, the more doors will open. ECB will see a little bit of stress given the current environment, increase in the hedge cost and so on and so forth. But rest of the others, whether it's securitization, access to capital markets, and the way the capital markets has behaved, we've seen a lot of interest, people participating in the fixed income. Unfortunately, India is a unique country where the fixed income market is less than the capital market. And like in the West, where the fixed income market is 3 times that of capital markets in the country. So I think there is a massive opportunity scaling the fixed income and other sources of funding for the NBFCs, which is a big need of desire. Obviously, one draws the learning from COVID, and if you take a 20 years view, calibrated growth is an important piece. We know the MFI crisis is more led by, it's more of a self-inflicted wound. So cautious, calibrated growth is what we urge people to do. From a Northern Arc perspective, in our ecosystem, it's important that all people we bank are successful in what they do. So I think that's the port of call from my side.
Mr. Shaji, if you could just,
Yeah, I think you said it all on the, see, I think in the risk side, purely on the lending side, if the inflation hits, which means the cost will go up. If cost goes up, of course, margin skews us for those who are retailers and others we spoke about, which also means that disposable income will go down. If the disposable, especially at the bottom of the pyramid or the lower set of the lower income segment, if the disposable income goes low, in turn the velocity of trade and commerce will go down. It can happen, okay? But as you said, there are supply of money comes and overall velocity goes up. Yeah, and sincerely wish that that situation won't happen. It's a moderate increase in inflation. I am sure that the system can absorb because we are in a high growth economy compared to many parts of the world. I am sure that growth will be able to absorb a moderate inflation. So I think overall should go well. The risk which I foresee, I said, if the inflation goes too high and the growth moderates, then of course the disposable income of the bottom of the pyramid will have an impact. I sincerely hope that won't play out.
All right. Thank you so much for giving us this opportunity. It was an insightful conversation. Thank you. Yeah, thank you.
Thank you so much. And if I could also request Subhana to please present a token of gratitude to both of our speakers, to Mr. Shaji Varghese and to Mr. Ashish Mehrotra. Thank you so much again for joining us at the summit. And what an invigorating session, I must say indeed. Thank you so much, sir. Thank you. With that, ladies and gentlemen and everyone, we're now about to move on to our keynote address, featuring someone who's leading India's financial architecture with clarity, with a lot of insight and impact. In fact, we all know him as the IAS officer of the 1993 batch, and under his stewardship, since August 2024, India's financial sector has strengthened its foundation, driving robust credit growth, expanding access to finance, and also deepening the financial inclusion with notable milestones like the Jan Dhan accounts, the UPI accounting for nearly 80% of digital payments, signaling wider financial engagement across society. Well, this evening, we're truly honored and delighted to have none other than Shri M. Nagaraju, Secretary Financial Services, Government of India, joining us at the Mint India Investment Summit 2026. Can we have an august round of applause to welcome Shri M. Nagaraju? Thank you very much, sir. If I could please invite you on stage to share your valuable thoughts with the august gathering. Namaskar, sir. Always a pleasure to meet you.
Good evening to all of you, distinguished leaders from the financial sector, investors, regulators, and industry experts, friends from the media, ladies and gentlemen. It's a pleasure to address this distinguished gathering at the Mint India Investment Summit 2026. This platform has consistently brought together some of the most important voices shaping India's financial and economic future. And I'm delighted to join all of you today. Let me begin by acknowledging the remarkable progress we all have made together. Despite persistent global headwinds, geopolitical conflicts, supply chain realignments, elevated interest rates, and rising uncertainties, India continues to stand out as a bright spot in the world economy today. The last decade has been very transformative for India. Real GDP growth for 25-26 is estimated at 7.6, higher than 7.1 recorded in 24-25. Private final consumption expenditure grew by 7% in financial year 26, reaching 61.5% of GDP, the highest since 2012. This growth is supported by low inflation, stable employment, and increasing real purchasing power. Investment activity strengthened in financial year 26, with the gross fixed capital formation growing by 7.8% and its share remaining steady at 30% of GDP. A significant improvement has been observed in the asset quality of scheduled commercial banks, as evidenced by their gross NPA ratio standing at 2.2 in September 2025 and net NPA ratio of 0.5 in September 25, having reached a multi-decadal low and record low level, respectively. As of 31st December 2025, the year-on-year growth in outstanding credit by scheduled commercial bank increased to 14.5% compared to 11.2% in December 2024. Financial inclusion is central to building a resilient and equitable financial ecosystem. India's DPI has emerged as a foundational driver of the country's economic growth and financial inclusion over the past decade, anchored by platforms such as Aadhaar, UPI, and account aggregator framework. DPI has enabled seamless, secure, and low-cost delivery of financial services at scale. Of the total retail digital payment transactions, the UPI accounts for 81% in the financial year 24-25 and has emerged as the largest real-time retail payment system in the world. PMJDY accounts have crossed 57 crore, with women constituting more than half the account holders and rural semi-urban areas contributing significantly. Deposits exceed 3.02 lakh crore and more than 40 crore Rupee cards have been issued. Pradhan Mantri Jeevan Jyoti Bima Yojana and Pradhan Mantri Suraksha Bima Yojana have together enrolled more than 84 crore beneficiaries, strengthening social security for vulnerable communities and individuals. Mudra has sanctioned over 57 crore loans worth 39 lakh crore, empowering micro and small entrepreneurs. Under Stand Up India scheme, more than 41,000 crore has been disbursed to promote entrepreneurship at grassroots level. PM Swanidhi scheme continues to support street vendors with affordable credit and digital onboarding. With more than 8.8 crore subscribers, Atal Pension Yojana, a social security scheme, has emerged as one of the most inclusive and accessible social security initiatives in India. PM Vishwakarma is uplifting traditional artisans by providing skill training, credit, modern tools, and digital incentives. As Secretary DFS, it's a matter of pride to state that the fintech sector has been at the heart of this transformation. India today hosts one of the world's fastest growing fintech ecosystems, with the startups and established institutions collaborating to deliver technologically advanced solutions in payments, lending, insurance, and wealth management. The government and financial regulators have increasingly adopted a whole-of-government approach, creating an enabling environment that supports fintech innovation while simultaneously strengthening regulatory oversight. Today, as we step into India's digital decade, our vision is to position India as a global leader in digital governance, where technology empowers every citizen, every enterprise, and every institution. What we have achieved so far is significant, but the next phase will be more demanding and interesting. We are moving from scale to complexity, where expectations are higher, risks are sharper, and systems will be tested far more rigorously. But as we look ahead to the next decade, one thing is clear: growth alone will not be enough. India today is a 3.7 trillion economy, and we are moving towards the vision of Viksit Bharat 2047 with a target of becoming a $30 trillion economy. Achieving this transformation will require sustained economic growth of around 9% annually. However, such growth will depend significantly on the ability of four financial systems, particularly the banking system, to our support and investment and credit expansion. Capital is not merely a resource. It is the engine of opportunity, whether it is infrastructure, manufacturing, green energy, startups, or MSME. Every dimension of India's development depends on our ability to mobilize and deploy capital efficiently. India's financial system remains bank-led, with banks playing a dominant role in credit intermediation, even as the scale of financing required in the coming years will be significant. Accordingly, India's credit to GDP ratio will need to rise from the current levels of 55% to approximately 130% by 2047, underscoring the central role of banks in driving capital formation and economic activity. This implies that total credit in the economy will need to expand from about 2 trillion today to nearly 37 trillion, requiring sustained credit growth of around 13% annually. India also has a negative credit to GDP gap, indicating room for further expansion. The encouraging aspect is that the banking sector today is in a much stronger position, providing a solid foundation to support this next phase of growth. Equally important is the need to expand access to financial inclusion services. Growth that is not inclusive cannot be sustained over the long term. India's financial system must cater not only to large corporates, but also to MSMEs, small traders, startups, farmers, and citizens in rural and semi-urban areas. Expanding access to credit in a responsible and efficient manner will be crucial for unlocking entrepreneurship and economic potential at the grassroots level. As we deepen capital and expand access, it is equally important to ensure that our financial system remains resilient and stable. A strong financial system must be capable of supporting growth during favorable times while also withstanding shocks during the periods of uncertainty. Reforms aimed at improving asset quality, strengthening regulatory frameworks, and enhancing credit discipline have contributed significantly to this objective. Going further, technology will play an important role not only in driving innovation but also in strengthening supervision, risk management, and fraud prevention. The next phase will not be driven by any one institution or segment alone. It will require coordinated efforts across the entire ecosystem. Government, regulators, financial institutions, and technology providers will need to work together to achieve the goals. Our role at the Department of Financial Services is to foster an environment where innovation, sustainability, and stability reinforce each other. Policy frameworks must remain adaptive, encouraging innovation through mechanisms such as regulatory sandboxes and pilot projects, while ensuring that risks are identified and managed in a timely manner. The government remains committed to enabling a robust, inclusive, and future-ready financial ecosystem. Our focus continues to be on enhancing credit flow to priority sectors, supporting digital financial innovation, strengthening public sector financial institutions, promoting financial inclusion at scale, and developing policy frameworks that support investment. The Indian banking sector is currently in a strong and stable position, supported by improvements across key financial indicators. Asset quality has improved significantly, with capital adequacy remains strong at around 17%, well above regulatory requirements. At the same time, profitability has improved considerably, with the banking system reporting net profits of over 4 lakh crore last year. While banks will continue to play a central role it is important to recognize that banks alone cannot meet the entire financing requirements. India's corporate bond market is still around 14% of GDP, which is relatively low compared to global standards. There is a need to deepen capital markets, particularly for long-term financing. At the same time, the liability side of banks is evolving, with increasing investments in mutual funds and other financial instruments. The ratio of mutual fund assets to bank deposits has increased from about 10% to nearly 20%, indicating changing savings behavior. Looking ahead, there are 4 key priorities for the banking sector. First, there is a need to build larger and globally competitive banks that can support India's scale. 2, capital raising will be critical, including through internal accruals, market instruments, and external investments. 3, financial inclusion must continue to deepen, focusing not just on access, but also on quality and sustainability of financial services. Fourthly, technology adoption must be strengthened, particularly in credit delivery, monitoring, and risk management. At the same time, maintaining financial stability will continue to remain essential. As credit expands, ensuring asset quality, capital buffers, and strong governance will be critical. In conclusion, the opportunity before us is significant. India's BFSI sector has already demonstrated its ability to transform at scale. The next phase will test our ability to integrate advanced technologies responsibly, secure systems against evolving threats, protect citizens' data, and expand while maintaining stability. If we succeed in deepening our capital markets, expanding access to every citizen and enterprise, and building a resilient financial ecosystem, we will not only finance India's growth, but also empower its future. The journey to 2030 is not incremental, it is transformational. Together, let us build a Viksit Bharat, an India that leads the world in digital governance and ensure that no citizen is left behind. I wish all participants at the Mint India Investment Summit every success, and thank you for inviting me and giving me a very patient hearing. Thank you. Jai Hind.
No, sir. Firstly, thank you. Thank you so much, sir, for sharing with us the key priorities for the banking sector, and at the same time for also sharing across all the initiatives undertaken by the Department of Financial Services. I requested you, sir, to remain on stage for a minute so that I can invite Mr. Ravi Krishnan, the Editor-in-Chief, Mint, to also present you a token of gratitude for your incredible time with us here at the summit. So can we have a huge round of applause one more time for Shri M. Nagaraju, Secretary Financial Services, Government of India. Once again, we thank you very much, sir. And on that pioneering note, we are now about to set the stage for our next session as well. And this is where we move forward to a powerful talk that all of us have also been eagerly looking forward to. And this is why we call it the Fireside Chat with our guest of honor. I'm going to once again request every one of you to continue being seated, because we are about to be joined by a man who has not just witnessed India's financial evolution, but is someone who's been responsible in actively shaping it. And we're about to start that session shortly, so I'd like to request all of you to continue being seated. Thank you. Ladies and gentlemen, it is indeed a matter of deep honor to have one of the most trusted voices in policy, a mentor to leaders, and a custodian of governance integrity. In fact, as a distinguished IAS officer, he's also held some of the most critical positions in India's financial ecosystem, serving as a chairman of SEBI, UTI, and IDBI, where he led transformational turnarounds and strengthened trust in India's markets, and currently the chairperson of Excellence Enablers Private Limited, one of India's foremost champions of corporate governance, regulatory excellence, and institutional reform. Can we have an august round of applause to welcome none other than Shri N. Damodaran, Chairperson, Excellence Enablers Private Limited. Thank you very much, sir, for joining us. If I could please invite you on the stage, and if I could also request Ravi Krishnan, Editor-in-Chief, Mint, to please join in to spearhead this powerful talk for us all. We thank you, sir, for joining us at the summit as our guest of honor. And with that, let me hand over the proceedings to Mr. Ravi Krishnan.
Good evening, everyone. Thank you, Mr. Damodaran, for joining us. So when discussing corporate governance, a recent development where the chairman of a large systemically important private bank recently resigned without any specific reason. And although the bank and the Reserve Bank of India did say that there was no material impact or anything, but as somebody who serves on the board of blue chip companies yourself and as a guru of corporate governance, how do you view this situation? What is the framework you are using to look at this?
First, let me make a prefatory statement. I know nothing about the episode or what led to it, except what I have seen in the papers. But a whole lot of papers have carried a whole lot of articles by pundits who have pronounced judgment without the simple detail of finding out what the facts are, right? So depending on each one's lens, the conclusions have been different. I don't know what went wrong. It's unfortunate that a chairman leaves a board before the end of his term. What led to that decision? Were there issues that could not have been solved by constructive conversations in the boardroom? I don't know, because unless you know what the issues are, you cannot pronounce on whether conversations in the boardroom could have addressed those. But let me say in one word, what happened was sad.
Okay. How would you have handled that situation if you had disagreements?
I wouldn't have got into a situation like that, because you know when there are issues that exist in terms of not minor disagreements, not disagreements in matters of detail, but on the larger issues, and you believe that you cannot be a part of that team, and your continuing there is only going to destroy value, then you leave, but leave for the right reasons. Right? Don't do anything which, as you leave, becomes a kind of a parting kick. You have to continue to live in this world. That's not something I would have done. But very rarely that these situations arise. Indian boards have seen any number of disagreements. I've myself seen a lot of them. I've had a ringside seat on boards where there have been major disagreements, and yet life went on. The board continued to function, the company continued to deliver. If you actually want to look at a difficult board situation, You must read Arthur Haley's last book, Strong Medicine, where he describes in 4 pages the proceedings of a boardroom in the United States. Strong language. They didn't beat up one another, but clearly very extreme positions, and yet they came to a decision. By the end of that 4th page where he has described it beautifully, they came to a decision. Things can't get much worse than that. We, in any case, even if we disagree, use civil language in boardrooms. I don't think we use bad language in boardrooms. So these are not insurmountable issues. This should have been addressed. Yes.
That said, do you think that investors still give a premium to companies that have good governance?
What is good governance? It is not fact. After studying this animal over the last several years, I've discovered good governance is more about perception, less about fact. There are companies which have for years attempted to convince all of us that their middle name is governance. And yet we've seen several things going wrong in those companies. Is there one company which you can say has practiced good governance throughout its existence? If you find one, tell me. I haven't found one so far. I think governance premium is a function of the perception of people understanding how a company is governed and how it translates to the right numbers quarter after quarter, how they are getting rewarded as shareholders. All of that leads to the perception that the company is well run, and therefore the governance premium element gets attached to it. But if you look closer, you might find things that are wrong. Most people don't have the time or the inclination to study it that close. That is, and it's not an Indian phenomenon. We've had companies which elsewhere have prided themselves on good governance, and yet they've had to recall the products from the market. Not that recalling a product, you're not God. Something could go wrong with your product. Did you share that information as soon as you got it? No, you didn't share that information. So therefore, where was that governance? Your products might have been great. Everybody must have said, and people would have got awards. You know, I'll tell you this, stop. Many years ago, I suspect it was when I was Chairman SEBI, I was invited for a function where awards were being given for good governance. I have opposed this, saying that we've not reached a level where enough companies are practicing good governance in order to decide which is the best among them and to give awards. First, let the general standard come up. But I allowed myself to be persuaded to go there. When I went there, I said, can I look at the award winners? It was a somewhat unfair question to ask. They were going to announce it, but since I obliged them by going there, I thought I was entitled to that information. And I saw one name there of a company to whom SEBI had issued notice that morning. Now, I had to find an exit route. Therefore, I organized to receive a phone call. You know, this is where carrying cell phones is important. I managed to organize a call and then pretended that there was something on fire outside and said, I have to leave. I wish I could have stayed. And then left. Later, I told the organizers, if you had only told me this, we would have at least held back that notice till next morning. You didn't tell me that. No, I think where we think that there is a governance premium, and I'll give you one more example. When Satyam happened, when it all blew up, what were the immediate reactions in the market? Some of you who are market veterans might recall that. Somebody said, all Pricewaterhouse auditees, you must look at their books to see whether they're all right. These shares will get hit in the market. Somebody else said all IT companies you need to look at, because if this company, this venerated IT company had done this, how do you know the other IT companies are not reporting the wrong numbers? Somebody said that you must see the companies of the entrepreneurs. You know what I mean by entrepreneurs. And there are lots of them who came from undivided Andhra at that time. Now, what did the market do? The market did not trash any of those shares. It went on with life on basis of its perception. So people can jump to conclusions saying, oh, no, I think this business of tarring a bunch of guys with the same brush, I think is one of our problems.
So coming to a related topic on independent directors who are supposed to be the guardians of governance on boards, do you think that the current regime, which places too much liability on these, is making competent people, too afraid now to take on independent director roles?
Independent directors are and have been soft targets, right? There is a belief that supposing you dropped somebody from space and he studied corporate India, he would conclude that companies in India are run by two sets of people. One is the audit committees and the other is the independent directors. You don't need managements, you don't need anyone else. These are the two guys, because everything that goes wrong leads to the question, what was the audit committee doing? What were the independent directors doing, right? Nobody says, what was the MD doing, what was the chairman doing? Nobody asks about that. Or what the CFO was doing. Very often, he could be the one that is part of the problem. So I think the liabilities have always been there. But because of a few cases that have come up, suddenly the liabilities have become more visible, more, shall we say, frightening to deal with. You have, of course, directors and officers insurance policy doesn't travel far enough. You have section 149(12) of the Companies Act, doesn't travel far enough. So I mentioned this somewhere, saying that you first be a party to the right decisions. Assert yourself. Get a good insurance policy. Study what protection is available to you under statutes. And if all of that fails, as they often will, then pray to God. So when I mentioned this, one of the guys there, it was a board, he said, I'm an atheist, what do I do? I said, are you an atheist by choice or by compulsion? Because if you're by compulsion, I can't help you. If you're by choice, maybe for this one matter, recognize God and pray to Him. There's no other defense that you have. So, independent directors do not have access to information of the kind that whole-timers have. And yet, there is the feeling that you should have known. Now, take the latest animal. It existed all along. It's been just brought into prominence now, which is called the TCWG. I have a problem with any combination of 4 letters which does not have a vowel. 4 consonants, no vowel. And this is a country which is famous for acronyms and abbreviations. And yet we haven't thought up anything for those charged with governance. They could have got a better thing for that. Look at the expectations from that bunch. And who are these people? Members of the audit committee, most of whom are independent directors. A few other independents maybe on the risk management committee who are into this. The expectations have gone up. Now, if you do not manage expectations, then you will reach a situation where it will be difficult to get good independent directors. There will be no shortage. There are a bunch of guys who are dying to get onto the board. What their intentions are, I don't know. But every time there are no public sector bankers here. I think every time there was a vacancy in a public sector bank for a director, you would get, and don't get me wrong, number of people from a particular profession who would then, say that they would signal the candidature. So there's no shortage. The point is, what kind of guys are you looking for? Are there enough of those guys? Do they come in knowing what the liabilities are? And will they? And the last point is, the Companies Act 2013 has a provision for class action suits, which is more strict than what exists in the United States, from where we have copied, but we've also added, we have to be stricter than the rest, so we've added a few things, right? The first case is going on just now, after so many years. But think of 10 class action suits when it comes. You won't find too many independent directors on boards after that. That will be the last nail in the coffin of independent directors.
So what do you think we should do to reform the system? To reform the system in terms of making this really effective?
First, get the right people on the board. Easier said than done. I know a very enlightened promoter, chairman of the board. I asked him this question a few years ago. I said, what value do you see in independent directors? And his answer was very revealing. He said, I want independent directors on my board to protect me from myself. These are the bunch of guys whose presence might discourage me from traveling down the wrong road. If they were not there, not that they would have said, oppose this, but the sheer presence, the fact that they might question my bona fides in taking a particular decision. Therefore, they add value. But you've got to get people who are going to ask the tough questions, not be afraid of them. Second, do we compensate them enough? I think the first Prime Minister of Singapore stated it best when he said, if you give peanuts, you'll get monkeys. Many boards give peanuts, and while monkeys have not yet stormed into boardrooms, you are getting the wrong guys in the board. You got to compensate your directors adequately. The third is to have a very robust evaluation process where a director who is found to be not measuring up is persuaded to leave, told that there are better things you can do. You can write poetry, you can do organic farming. Why sit in the boardroom and waste your time? We have all one life to live. Your talents might lie there. Leave. So a good, robust evaluation process is critical. Good compensation, ensuring that the right guys get into the board, ensuring that the right guys stay on the board. That is also critical.
So, in a bunch of recent acquisitions, M&A transactions, we have seen acquiring investors not only asking for board seats, let us say if they pick up a 20% stake kind of a thing, but also asking that, their nominees be placed on this important board committees like the audit committee and the nomination and remuneration committee. Where do you stand on these?
You see, it's interesting when investors first started getting into companies, writing out checks, there were a number of cases where they said, we will be on your board, but we don't want to be on your audit committee or your risk management committee. Keep us out of that. We don't have the time. The real reason being that you want to distance yourself from the difficult decisions, but on the 30,000 feet issues that boards discuss, you're okay sitting there and sharing your gyan. Now, when you have M&A, when people are writing out checks for the big amounts, clearly they want to know that the company is going the right way. The first thing, of course, is their nominees on the board are not independent. They are recognized as non-independent directors. The second, there is another component of the board which then needs to say that, look, maybe you're investors here, but what you want to do is the wrong thing. So you have to ensure that there are checks and balances within the board. Subject to that, I think you cannot shut the door on them after they have brought in large money. If they say, we want to be a part of the direction setting, because otherwise, why did we write out a board? Not to get a ringside seat to watch what is happening, but to participate in decision making. It will create a lot of friction. So I always explain M&A as marriage and after. So if you get into the marriage, you must be prepared for the after. Right?
Given the situation in West Asia and what is happening in the energy markets, etc., do you consider ESG as a concept to be dead?
A learned professor in the United States, with whom I have the distinction of sharing a surname. He is a valuation guru. I was once asked by somebody, how do you write these difficult books? It was at 33,000 feet. We were flying. I was heading to the US, and he said, I've read your book. It's fascinating, but tell me how much time you take. So I said, show me the book, and I'll tell you how it is written. So he mentioned the name to me, and I went and told the professor, whom I knew. I said, give me 2 copies of your book autographed. I might run into the same guy in the aircraft on my way back, and I will tell him, here is your book, autographed by the author. And I won't tell him who the author is, right? He said, ESG is a feel-good scam. Some of you might have seen this. He said it does nothing for the company because he was looking at it through the lens of the shareholder, the profit, not the stakeholders, the shareholder. The old Chicago school, look after shareholders, the rest can take a walk. So that kind of a thinking. Now, if you look at what has happened in ESG, Europe has been clearly the ones that have done the most, especially in the environment space. USA was not anywhere nearby. They were trying to play catch up. And the present leadership, in any case, thinks that this is all nonsense and does not need to be done. In fact, to the extent, and all of you know this, that even diversity and inclusion are bad words now in their lexicon. Those chapters have been removed. A number of companies have had to rewrite chapters of the reports, taking out the diversity and inclusion provisions. So I think the US is not going to press very hard. In India, we had the BRSR, then the BRSR core. I don't hear anyone talking about it now.
Is it just a checkbox thing?
Pardon?
Just a tick mark, a checkbox?
I don't even know that, whether some of it is greenwashing that is not noticed, whether some of this is really finding easy answers to things that you haven't done. Because there are some things which are difficult in the various things that SEBI has set out. How do I ensure that my vendor, who might be a very small person, might have the right human rights policy in his company? So what do? I send him a letter that as my vendor, you're expected to have a proper human rights policy. And then I say, yes, he has been told this. This is much like, during the emergency, one of the 20-point programs. Sorry, I'm giving you an example from when many of you were not born, but we had something in this country called the emergency, and there was a 20-point program. One of this was abolition of bonded labor. So the ordinance for abolishing bonded labor was put out, and promptly 3 of the states which had to send reports said, we have abolished bonded labor. What did you do? You sent out copies of the ordinance to various people. You have abolished bonded labor. So it's like companies when they report now, we have sent it to HR is shown as a compliance issue in action taken reports. What HR does with it also within the company, and when you're telling the board, you need to give the right position. I think there has been a setback globally. I don't hear even US, UK, Europe pressing too much. US in any case has put it on the back burner. Maybe post the war in West Asia, whenever that happens, when people reflect in a peaceful atmosphere, they might discover that you have to leave the world a better place than you found it. There was the energy company which put out the ad, and I loved that ad many years ago, which said, we haven't inherited the earth from our parents, we borrowed it from our children. That thinking ought to go into how ESG is concerned. The minute you overprescribe, you list a whole lot of things, and then expect people to, then they will start ticking boxes.
Do you think boards should have technology or AI committees now, just like an audit committee and an NRC and stuff like that, a mandatory committee?
Well, if they do not start talking about AI in boardrooms, then you can write their obituaries straight away. That's a fact of life, you can't wish it away. But it doesn't mean that everybody in the boardroom, and I hear this also sometimes, we got to train all our directors on AI. Are you making all of them experts on AI? Is that what you want? That's not what you want. You have to see that the companies are able to use AI in a productive fashion. Address whatever concerns there are. They're not free from concerns, as you know. But if a company has not got started on that yet, they have a huge problem. They'll have a lot of catching up to do if they have to survive. I think it's early days yet. What we hear people talking about when they talk about AI is about scratching the surface. You need to do a lot more. Yes, there will be pain in doing that. But you've got to go through that process. We can't step outside, stand outside the rest of the world and say, you do what you like, we will. Boards have started talking about it. I have been party to a couple of conversations. I'm not on many boards, I'm just one board. But where enlightened people have talked about their experiences elsewhere and tried to see how to make it relevant to India, what I call tropicalization. How do you take something from outside and make it relevant to India? There is that bit that's going on. Yeah.
One final question as we are out of time. If Mr. Tuhin Kanta Pandey was here today, what would be the one rule that you will tell him to scrap, which will make India a better investment destination?
I don't know what I'll tell him to scrap, but I will tell him what I have been telling SEBI for the last 10 years, which is have an effective regulatory impact assessment mechanism. See whether the regulations that are in your books are relevant for today's times. Many of them are past their sell-by date. They are still there. We're having conversations on RIA. Nothing has happened yet. I have some thoughts on this. I think I've shared it with you. So,
thank you, Mr. Damodaran. Ladies and gentlemen, a big hand for Mr. Damodaran.
Thank you. Thank you very much. If I could please request Mr. Ravi to present a token of our gratitude to Shri M. Damodaran. And can we have a louder round of applause one more time, everyone, for gathering that leadership lens. Thank you very much, sir. All right, with that, everyone, we are now about to shift the gears finally to our next segment of the program. And while we do so, this is where I'm going to be urging all of you to continue being seated, because we're also moving on to a session that all of you have been eagerly looking forward to since the morning. But before we do that, we'd like to firstly welcome you to a moment wherein we put spotlight onto celebration. This will be, in fact, an evening where excellence meets recognition. In fact, since yesterday, you've been seeing that it says Mint India Investment Summit and Awards. So we're first coming to the segment of the awards before we move on to the very segment that many of you have been eagerly looking forward to. Now, this evening, it's not just about trophies or titles, because it's about the stories. It's about the innovation and the leadership that is shaping India's investment landscape. So let's all get ready to cheer and celebrate
This evening, we get to honor the very game changers, the risk takers, and the trailblazers that are driving India forward. Now, before we move ahead, while we're calling it the awards, it's only befitting that I also take a minute to talk about the methodology that was involved in selecting our awardees this evening. Now, for the Mint India Investment Awards, the data was sourced from Traction. In fact, the biggest deals of the past year, these were taken into consideration and then split into different categories. In fact, for the Company of the Year category, we also considered private companies in the BSE 100 that are promoter-led and assessed them on the basis of shareholder value creation, as well as operating performance and growth, capital allocation, effectiveness, balance sheet and risk architecture, as well as governance and transparency. So, a bit of that methodology that I wanted to share with you, but while we're talking about the awardees, it's only befitting I also share with you that we had the stalwarts of the industry who in fact were our jury, our eminent jury for the awards. In fact, the eminent jury panel comprised of Mr. K.K. Mistry, former Vice Chairman and Chief Executive Officer, HDFC, Dr. A. Velumani, Founder, Thyrocare and Managing Director, AVM Labs, Ms. Manisha Girotra, Managing Director and Head, India, Moelis, Mr. Ankur Tadani, India Head, TPG Growth and Rise, and Mr. Prashant Prakash, Managing Partner, Axel. So we had such an incredible jury for this awards evening. And what we're now about to do is also go ahead as I announce with the award categories. So this is where I'm going to be requesting all of you to come together and keep that celebrations happening. Before we do so, for the Company of the Year category, however, we'd also like to thank howindialives.com for being our partner for this particular category. Once again, I'd like to share with you all that the data for the investment categories, all of that was sourced from Traction. All right, so with that being said, looks like we're all set for the awards bit right here. In fact, here we are at the Mint India Investment Awards. Quick question, quick raise of hands, just to check the enthusiasm meter. Are you all ready for this segment of the program? Yes? All right, I see all that enthusiasm coming in. I'm ever ready as well. So with that, let me please go ahead and firstly invite our presenters to do the honors for the award categories. So if I could once again request the august presence of Shri N. Damodaran. So if we could please have you back on stage to present the awards this evening. And if I could also request Mr. Ravi Krishnan, Editor-in-Chief Mint, to please join in as well. Well, they're about to present the awards, so let's welcome them with a round of applause one more time. Now, I just have one request that towards the end of the categories, I'm going to be requesting all the winners, all the awardees to come back on stage for a group photograph. And after that, we have the leadership dialogue that all of us are also eagerly looking forward to. So as they say, it's not over until it's over. Let's hold on to that energy and that enthusiasm. And let's begin with the very first category for the evening, M&A Deal of the Year. Ladies and gentlemen, and the award goes to MUFG's Big Bet on Shriram Finance. We'd like to please invite Mr. Shashank Joshi, Deputy CEO, MUFG India, to please come on stage to receive the award. Congratulations to the entire team as well. With that, let's move ahead to our next category, PE Investment of the Year. And the award goes to TPG Capital's investment in TCS Hypervault. Let's also invest ourselves with a huge round of applause. And to receive the honor, we have with us Miteshwar Singh, Vice President TPG.
We march ahead to our next category for the evening, PE Exit of the Year. And the award goes to KKR & Co. Inc.'s exit from JB Pharma. So let's have a huge round of applause there as I invite Mayank Mishra, Director of Private Equity KKR, to please come on stage. You know, while we love the sound of the fanfare, we love the sound of the applause as well. Can we have a round of applause so far for all the awardees? Absolutely, absolutely. We'll keep that tempo on and let's move ahead to our next category. This is VC Investment of the Year. And ladies and gentlemen, VC Investment of the Year, and the award goes to Westbridge Capital's investment in Rapido. Can we have a rapid round of applause, everyone? As I invite Anshuman Khosla, Principal, Westbridge Capital, to please come on stage and receive the honor. Well, on that incredible note, let's also move ahead to our next category. This is VC Exit of the Year. That's right. And for this, let's take our applause to the peak, because the award goes to Peak 15's part exit through Grow's IPO. I'd like to please invite on stage Mr. Prateek Batra, Head of Strategic Development, Peak 15, to please come on stage and receive the honor. That now brings us to our next category. This is Deal Maker of the Year. Ladies and gentlemen, Deal Maker of the Year, and the award goes to Kotak Mahindra Capital. Let's have a huge round of applause. Let's keep that wealthy round of applause coming as I invite on stage Mr. Jayashankar Venkatraman, Mr. Abhijit Vaidya, Mr. Kaushal Shah, and Mr. Viren Jairath. Kotak Mahindra Capital Company. Congratulations. Now that brings us to the next category. This is Company of the Year, ladies and gentlemen. And the award goes to Bharti Airtel. Let's put our hands together, everyone, as I invite on stage Soman Ray, Group CFO, Bharti Airtel. Well, that now brings us to the final category of the awards segment. And as I had promised earlier, after this category, we'll also have a group photograph, and then we'll have the leadership dialogue. But let me bring your attention back again to our final category for the evening. Ladies and gentlemen, the Lifetime Achievement Award. And this time, I decided not to announce it, but to have it unveiled in the form of an AV that's right up on the screen, a visual that's coming up on the screen. So we'll have the AV right here, right now. Here we go.
Aditya Puri, the legendary former managing director and CEO of India's most valuable private lender, HDFC-Bank, traces his roots to a family deeply embedded in the subcontinent's financial history. His family were early shareholders of Punjab National Bank. His lineage is marked by regulators. His grandfather sat on the board of the Reserve Bank in British India, and his granduncle, K.R. Puri, later served as the 12th governor of the RBI. Puri qualified as a chartered accountant after earning a commerce degree from Punjab University. After an inspired look at the air-conditioned lifestyle of a cousin working for Citibank, he made a pivotal shift into banking. Over a 20-year career at Wall Street Bank Citibank, he worked in Saudi Arabia and Hong Kong before becoming CEO of Citibank Malaysia in 1992. In February 1994, HDFC chairman Deepak Parekh visited Puri in Kuala Lumpur to pitch a banking startup. Parekh persuaded him to return to India to build a world-class bank. The early days were far from glamorous. Puri and his founding team operated out of makeshift offices. His leadership was defined by a unique manual style. He operated without a computer or a mobile phone, yet consistently cleared his desk to leave the office by 5:30 every evening. Puri began with wholesale banking for corporations to ensure stability before pivoting to a dominant retail franchise. This approach created a global growth outlier, with HDFC Bank announcing earnings with monotonous precision for decades. Throughout his tenure, Puri forged a vital alliance with Deepak Parekh, who provided professional managers the freedom to operate without board interference. Upon his retirement in October 2020, HDFC Bank was India's highest valued financial institution, boasting loans of over $140 billion and a market cap of $90 billion.
Ladies and gentlemen, can we please have a standing ovation as I invite on stage the visionary leader, former Managing Director, HDFC Bank, Shri Aditya Puri, the recipient of the Lifetime Achievement Award at the Mint India Investment Awards 2026. And now, while I request you all to take your seats, I request all the awardees to please come on stage. We'll also have a group photograph of all the awardees together. And if I could request our presenters to remain on stage, we'll just have a group photograph with all the awardees. And after this, of course, I'm sure all of you have also been waiting to hear from Mr. Aditya Puri. So we will also do that. We'll set the stage for that conversation. But first up, let's have all the awardees on the stage. We'll capture this moment and make it a memory right here at the Mint India Investment Summit and Awards. Well, now that calls for a round of cheers there as well from our members of the audience. Let's have the loudest round of applause for all our awardees here. Thank you very much. Well, I request all the awardees to take their seats. I request Shri Aditya Puri as well to please join us back again. We are about to set the stage. Thank you very much, sir. Thank you once again. We thank Shri Damodaran, sir, and we thank Mr. Ravi as well for doing the honors. Ladies and gentlemen, as I'd mentioned, it's not over until it's over. We're now about to deep dive into the much-awaited leadership dialogue for the evening. And this is going to be another interesting fireside chat for us all. So as my team gets to set the stage, I must tell you that since this morning, everyone has been asking about as to when is the session taking place. So with that, here it is. Lo behold, here it is.
Now, few names in India's financial history carry the weight and respect of Aditya Puri. In fact, we all know him as a visionary leader who transformed HDFC-Bank from a fledgling institution into one of India's most trusted and profitable financial powerhouses. Known for his disciplined rigor, strategic foresight, and unwavering commitment to customer trust, he doesn't just lead, he sets the standard for leadership, innovation, and integrity in India's banking and business ecosystem. And today, we in fact all have the privilege of hearing from a man whose decisions shape the trajectory of modern Indian banking. With that, to spearhead the chat, once again, we have Mr. Ravi Krishnan, Editor-in-Chief, Mint. But one more time, let's have a round of applause because we're all set for this conversation. Please help me welcome on stage Shri Aditya Puri, former Managing Director, HDFC-Bank.
Certainly. Mr. Puri, I mean, we saw those photographs of yours, at a young age, etc. So my first question is, if you were 25 years today with your degree in commerce, would you still join banking?
Why not? What's wrong? Give me the basis, now with AI, you have to have context in view. So give me the context and I'll answer the question.
I mean, there are many opportunities if you're thinking, the opportunities which were there at the time you entered working life are different from today. So it is in that context I'm asking.
I think India is still a very underpenetrated market as far as finance is concerned. So opportunities are phenomenal. Two, I think AI gives, and including general AI and agentic AI and working with in customer-facing organizations, it's one of the biggest opportunity, and I hope you ask me about Gen AI at some time. So fundamentally, I would be as excited. What's the difference? That time we had the public sector and private sector. The public sector has come up. But ultimately, demand exceeds supply in financial services. And I think that exists today. And you have the ability now to meet that demand more easily at a lower cost. Because fundamentally, what are you looking at? You're looking at a customer-focused organization that is agile, resilient, efficient, and transparent. So there were a different set of opportunities available at that time. Now you have phenomenal. You have semi-urban and rural India, which is not penetrated. You have the ability to use the information that is available to fundamentally transform the business. And I think banking will be transformed. And I'll cover that further when we go further. Not with the hype, AI at the moment. Too much hype. It's here to stay. But it's as if everything is going to be implemented overnight. And too much negative hype on job losses. So I'll cover that if you ask me the question at the opportune time. But would I join banking? Yes, because I didn't do engineering.
Fair point. We will get to AI, but before that, I wanted to talk to you a little bit about the institution that you built, or what went into the institution building, right? What made you take the leap of faith from Citibank in Malaysia at a time when everybody was aspiring to work abroad to join what was essentially a startup bank? I mean, this was much before the word startup existed.
So there were multiple factors involved. First, clearly that when you work for a large multinational, you really don't know whether your success is dependent upon the procedures and the brand, etc., of the multinationals. So it was an opportunity to actually put together something from the scratch. And we all had very high ambitions, where we said, why can't we create a world-class Indian bank, starting from zero? And also, as our purpose, we would want to serve all segments of society in India with relevant products at a relevant price. Now, that's a phenomenal canvas to get. And then we had a situation where, It still applies today. What the situation we found was that we had the public sector banks that had the brand, distribution and the money, and we had the private banks plus the foreign, which were at that point of time really only foreign banks. They had the product and the service, and they were making hay, and I was one of them, where they were making hay while the sun shone. You made supernormal profits. So we said, what if we can get together the strengths of a public sector bank in terms of distribution, in terms of reach, in terms of funding, and the strengths of a foreign bank in terms of customer focus, product, service, and efficiency? We should have a winner. Not easy to do, but we should have that. And that was the genesis of the idea. Then Deepak came along and he said, why don't you come back to the country? You made enough money and you've traveled enough around the world. So I said, okay. When he told me the salary, I was going to fall into my pool. I said, Deepak, you must be joking, because that's what my driver was paid in Malaysia. So I said, all this big talk is very good. I am happy to come. Two things. One, I would be able to follow my passion, which would mean that I need to be clear who is going to run the bank. And he was very clear. You will run the bank in a professional manner. And if you need help, you come. And I must say, due credit to him, he maintained that. And the second was that if we were coming back, at that point in time, 100 crores was a lot of money. Today, it's nothing. And the opportunity, we were really a startup. We were going to start from zero. But we thought we had a damn good chance. So we said, look, okay, we'll accept this. Even I'll accept it, but I can't do this alone. I need a team of people to help me through. And knowing them, they will also ask what's in it for me, because all of you sitting here also know the strongest emotion is enlightened self-interest. So it's not only me. If I have to get a team together and I accept what you're saying, then it's not going to work. So we can accept the salary, but if we succeed, then we should make good money and be very proud of ourselves. If we don't succeed, tough luck. We took a chance. On that was the basis we came back on.
Was there any milestone you had set for yourself that within, say, 2 years, 3 years, 5 years, if I don't reach this, I will say, chodo yaar, I'll go back to, you know.
Kaisa negative aadmi hai tu? I am leaving Citibank where, you know, my ex-boss, God bless his soul, Nanupam Nani, Jerry Rao, there were 50 of us who were given golden handcuffs. उस टाइम मेरा $2 million का सैलरी था, और अगर मैं तो लल्लू तो नहीं है छोड़ के आके ये लेगा with we had a 95% chance of success, at least in our mind. Then if God's grace was not there, that would be a different thing. So we knew we'll make it big.
But I mean, see, it's very difficult to encapsulate 26 years in a short answer. But what would you say were the defining moments that shaped HDFC Bank's journey in your mind?
See, what shaped HDFC Bank was two things. One is when I came back from Malaysia and we were in this broken down office telling people we're going to make a world-class bank that will be the best in India. We don't know whether people believed or not. But I knew, I had worked for a long time in Citibank India, that if we got the right people, we set the right culture, we followed the 101 of when you want to go into a venture, is there a market? Can we access the market? Can we make our profit? Are people available to make that a reality? Is the technology available? And what do we want to create? Because upfront, if you don't create the culture, I was listening to Mr. Damodaran, my old friend, and at that time a very competent regulator, including SEBI. So you have to create the culture. You have to have the same, and we had to get a team of people who also believed that they could make it happen. I probably was the public face of 2.5 lakh people, but I'd be very arrogant and egoistic if I said I achieved it. So the milestone was when we got the people. And up front I said, the days of hierarchy are over. I'm the first among equals. Make no mistake, you've been hired for your ability to deliver. You have the same passion and you be same large values that we all want to focus on. But you've been hired to deliver. We will work as a team, open discussion, dissent is welcome, but there is clear definition of shared responsibility, measurement, and if we do well and the bank does well, we will do well for you also. And when we got our team together, we knew we were going to make it.
This first among equals leadership philosophy, I mean, how did you come across that? When did you zero in that this was a thing that was going to work?
So, from day one, I was not going to be the only fellow working. So, there used to be an old magazine called Mad. I don't know how many of you probably...
Alfred Newman.
So, they showed two bosses. One boss was with his legs on the table, having a good cup of coffee, and the other fellow had files all over the place. So I said, I want to be the first boss. Means you do your damn job, which is given to you, and you come to me for the final lot. So that was very clear in the first among you. And secondly, it would be very arrogant of you to presume you know everything. So we would only succeed if each one knew his job, whether it was the technology guy, whether it was the credit guy, whether it was the marketing guy. Everybody need to know his job, and they were given the same leeway. You go and hire who you want. But this is what we want delivered. And first among equal, all that it means is that there is no mandate that this is how it's to be done. You give the broad vision. And then you discuss it there. And if everything goes through, no problem, which it never does. If there are differences, then the boss decides, with a majority backing him, and then you follow it. Because ultimately what you need even today, and what you needed at that point of time, was an agile CEO and management team, which had a clear vision, and had the ability to simplify it and make everybody in the bank understand that. Be committed to that with flawless execution at speed and scale. Simple.
When you say it is simple, but I'm sure it must have been tougher in practice.
No, of course, you've got to work bloody hard. And it started from the fact that we didn't have money. We went to Kamla Mills. We put all this in the morning. The rats had eaten the wires. So obviously that's a part of it. The execution is a must. If your plan is right, and sometimes when I look around and these fellows say, top line hai, फिर EBITDA है, adjusted EBITDA है. अरे बाबा, profit है कि नहीं? Do you have unit profitability or not? It's not very complicated. And it doesn't differ today from what it was 10 years back or 20 years back. You have to have unit profitability. This top line valuation, यहाँ सब हीरो बैठे हुए हैं top line valuation के. But when I looked at credit cards, they said, no, sir, we'll do volume. I said, but if your individual card is making a loss, you'll only double my loss. No. And I think some of them are going to learn those lessons the hard way because that time is gone.
So are you referring to fintechs when you're obliquely referring to adjusted EBITDA?
I am not referring to anything. I'm saying basics is very simple. Is there unit profitability to your product? Is there a demand for your product? Can you deliver at that price? And can you take all stakeholders? So if you only look at top line, it's not going to work. Rokra to aana chahiye na. So I'm not saying anything about anybody.
You've also spoken about balancing passion with compassion.
Yes.
How did this philosophy play out in practice?
Actually, if you're going to follow it, it's very easy. Fundamentally, you have to realize that employee benefits, welfare, and they must want to come to work, must be embedded in your systems, embedded in your culture. So all that is saying is, if you're going to spend 60 to 70% of your time when you're awake in the office, I think I, as an employee, am entitled to demand what's the purpose of the company, what's our plan, what's my position in it, how is my job going to be defined, how will I be, what will be my assessment, and the compensation matrix linked to that. But more important, that's fine. And that, when we hear about all this mental health, if 90% can be institutionalized. If you want to then have, we had town hall on mental health. Big deal, yeah. So it has to be done at the ground. So you institutionalize where he feels happy about himself and he doesn't feel unfair. If there is, he's got to have a review mechanism. And it can't be you go to your boss, you'll be sacked. Okay? So you have to have a situation where HR is doing a skip assessment, not necessarily as a formal review, but you got to get to know who are the toxic people and you're walking the talk. And if the fellow is in difficulty, we actually created a trust fund. I don't know what the value is, but it was very large, where if the fellow really got into difficulty, we would pay from that fund. And if he had a problem, we would help. Simple thing that you make it sound so big for others. He just wants to shift. He's living in Borivali and you give him branch posting in Churchgate. वो बोलता है change कर दो तो change कर दो ना. How does it affect you? If he has a problem, give him a sabbatical. They know when you walk the talk, human beings are sensible. I think Damodaran Saab also said the same thing. It's more important that you put your, when the rubber hits the road, they must know. You got to walk the talk. You say, I am very concerned, but when cases come up and you don't stand tall, they'll say, yes, sir, but they won't believe you. We were fortunate enough to have a very motivated force that believed in our culture, believed in our vision, believed clearly that there would be open discussion, there would be fairness, and they would be compensated, and so would we work for an ethical organization. Like somebody said, I was happy to say, I don't know where it was, a government conference. How do you manage the government? I said, we have never paid a bribe in our life. And I think that's insulting the government. No, seriously. You pay the bribe. Why? Because you want to go against the rules. You don't ask for a favor like that, and Damodaran Saab will watch for that. Nobody, neither politician nor bureaucrat, anybody. You don't ask for a favor, you go and deal professionally. Then we are like any other country. We don't have a monopoly on bribes or anything. Everywhere is there. Here, people cry foul. That American company bribed India. Arey, tum bribe kyun kiya? Means you've done something wrong, you got to pay for it, no? So I can tell you, in all my 26 years in NBFC-Bank, we never paid a bribe. We never got a deal where, and because of that, when they knew that we were, what was the culture of the bank, we got a lot of government deals, because everybody knew that there was nothing underneath. So you walk the talk.
As a leader, what do you think is the most critical ingredient in building a culture? Because we all talk about culture beating strategy, this, that, but how do you actually do that? What is a...
It's very simple. Kya culture? What are you saying? We are saying we are customer focused. We will make the customer happy. He must have delight. Right? We will have the right product fix. We will be transparent. We will have integrity. And we will take care of all our shareholders. इसमें मुश्किल क्या है?
Sir, ये तो अंग्रेजी है. How do you put it in action?
ऐसा करके. You talk and you demonstrate. No. Then you haven't understood what I said. If your systems are clear, like for instance, coming from a foreign bank, first thing I said, look, you do your work, you go home. You work late, it's your problem. 5:30, I'm going. I'm not watching you. And you don't have to come and give me Diwali present, and I want this to follow right down the organization. No Diwali present, no entertaining of the boss. I have enough, I can't meet all my friends only. Why will I come to your party? You do your work, you go. Here is the system, and that's what it is. So every human being, I can assure you, comes with about the same brain. And he knows when you mean it and when you don't mean it. And that's the difference. When we, and I'm proud to say that, when we said we would do something, people believed in it, they trusted the culture, they trusted the organization and said that you will also be compensated fairly. That's how we got the growth. You can't get above market growth. And if any CEO thinks he can do it, he must be a nut. If everybody has to be committed, then you'll do it.
Right. Now coming to AI, which we touched upon earlier, in which area of banking? I mean, is it like going to be marketing, fraud detection, or credit underwriting? Where do you think AI will have the biggest impact?
Now, you've asked for a long lecture now. So first, let's understand whether you're talking AI, Gen AI, or what. So if you look at the origin, it started with automation. Then you have machine learning, which is regular AI. Then now all the problems are coming because machines are going to get cognitive thinking under Gen AI and agentic AI. What it also does is all artificial intelligence prior to now was deterministic. You accessed a preset data warehouse with preset questions and the same answers came. I would say you ask the same question to a large language model today at 10-minute intervals and you'll get 3 different answers. That is because they are being fine-tuned, they are accessing an unstructured database. And so what happens? When it comes, then you need a human being to validate it. You need a human being to apply his mind to see ethical considerations, data security, cyber security, prompt engineering so that you can actually use AI properly. And then finally say, does it meet our problem? So if you take AI, because it's unstructured data, there are about 4 layers. So the first is the energy layer. Electricity, water, whatever your power this thing is. Then you have multiple types of chips. Then you have the AI infrastructure. Then you have the models. And then you have the applications. Okay? So this much is there. Now, we have done that. Now, the models don't hallucinate enough, but ultimately, always there is a gap between what the tech guy says and what society is willing to adopt. Partly it's because of clarity, you want trust, you want to see whether ethical considerations are concerned, you want to see whether society will accept it. So this part is ready, and everybody is hyping. How much of this part has actually been tailored or converted into solving problems? That is, how are you going to get the ROI? So all these, what do we call them, investors and अरे क्या करेगा वो left behind, India वाले क्या करेंगे? This is just a raw material. When you get the output, so you need to, so now there is a whole new set of jobs coming about. So, which I explained to you earlier, that somebody has to do also. So now you have the prompt engineer. He has to be familiar enough with the tools to ask the language model the right question so that you get the answer. Then you, after that, you have the context engineer who makes sure that everything is taken into account before it goes into the system. Then you have the technologist. Then you have now a different data scientist, because now you're not building all models from the top, you'll build something from there, on top of that. That's where the Indian companies would come. Who has 150 million engineers? We. Who had 250 million plumbers? We. So the bloody US companies are doing us no favor. ऐसे नहीं भाग के आते. They're more Marwadi than the Marwadis, having worked for 20 years in a US company. क्यों आता है इधर? हम train करेंगे. क्या train करोगे? Infosys train कर रहा है. I just went to the campus in Mysore. So the point is that somebody has to convert what is there as a possibility into reality. So as Damodaran Saab said, AI is here to stay. We have to, now the raw material is available. You will have to transform your models, right? On a broad basis, AI, if we take into account the infrastructure, etc., the amount of plumbers, electricians, masons you need is unbelievable. You will lose some coders, but there's no need to say the world is coming to an end. This will come out better. So then you have then I'll put down all the engineers, etc., etc. So somebody has to convert what is now available into use. What commercial use is ChatGPT? Now you have to make it. Now I come to your question of what will it do for a bank? There are 2 parts to it. One is you have 2 pillars, top down and bottoms up. top down, well, what the senior management will say, these are the domains in which I can get the maximum bang for the buck. You, I can see, have done some reading, but not enough. So, what those domains are, credit, because as I told you now, if you can give credit on the basis, if you know his GST, you know his electricity bill, you know the car he has, you know his petrol, you know where he's staying. If you can't frame a credit line for him, I don't know what to say. So, credit, marketing research, marketing test, campaign management, personal marketing are one. Then you have campaign management coming after that. Then you have fraud. Then you have fundamental operation changes. But you have to change, not, what should I say, fixing a puncture. You have to change the tube. So the entire customer journey has to be changed. And then only you will get the advantage. When you say you go for cloud, it's supposed to be cheaper, but only if you negotiate the pricing properly. Otherwise, now cloud is more expensive. And if you don't put compression for storage, you're screwed. Okay? So, operations in itself. Then pre-meeting a client. All his work, all what he may want, the analysis, what it shows, what you are making your presentation, doing your research. For lawyers, it's getting all the case for each. So this is on a day-to-day basis. So you're at the top, which is a good example. I would recommend all of you look at what JP Morgan has done. They've got an LLM suite which is powered by a large language model, and they've got a top-down and a bottom-up approach. And in addition, there'll be connectivity because the whole area has to work. And the last but not the least is the adoption, which will be determined by the human being who, if you put too much care, job loss ho jayega, ye ho jayega. Also look at the Stanford study. The drop in initial hiring was only 6%. And this is probably easier to transform and train than the original internet thing. So it applies everywhere. AI can and should be used either for growth or for efficiency or for profit. And we'll have fun, then everybody can go at 5:30. I would have gone at 2:30 then.
What AI tool do you use personally?
Sorry?
What AI tool do you use personally?
Pro GPT, Chat GPT, Pro, because it answers my question. Like your next question, what is the, I'm just guessing.
Please guess. Please.
And if you ask me a question, and Damodaran Sahab advised me over tea, if you ask me a question that I don't want to answer, I'll say not in syllabus. Okay, so be very careful what you ask, because then it'll be the next question. So, I use ChatGPT Pro because I asked them everything that I want to know. Otherwise, I had to go to the economy, then I have to go here, then I have to go there. That is one part of it. Two, when we issued, when the bank went in for a 10-second loan 7 years back, that was agentic AI. Instead of vertical, you had horizontal processing. I was the agentic. Similar thing happens. So, if you're asking personally, there's so much knowledge to be gained. So I use it regularly. Every time I don't know something, I go there. For cooperation, I defined it. You have to define what your problem is and how you're going to solve it and monitor it, etc. And don't see, and please understand, phone is what? Phone is an access device. You got it? It's not technology. Technology is understanding the simple things that I'm telling you. What can it do for you? How will you get it done? And where is the result? Not all this sexy talk, ye ho raha hai, wo ho raha hai, mar gaya, ye ho gaya, wo ho gaya. Pehle samjho to sahi.
Great. One final question, as we are out of time. Don't look so happy.
See, you please understand, I'm no longer in the worker class, I'm boss class. If I don't like your question, so I look happy. What is the problem? I have no downside. You have the downside.
You have always been a structural bull as far as India has been concerned.
Sorry?
A structural bull as far as India has been concerned.
Yeah, so what's wrong with that?
No, nothing is wrong. I mean, I'm not always negative. I just wanted your assessment of what you're seeing around the West Asia war. How are you analyzing India's economic prospects?
Okay, split this into two, medium and long term.
Yeah.
Fundamentally, everybody agreed that we would achieve our 7 trillion economy, which was the World Bank, the IMF, all these great economists who say subject to other things being equal. All of them said it would be achieved. It was based on some fundamental facts that we have a strong foundation, both in terms of inflation, fiscal deficit, current account deficit, and now a good banking system without the problems. We've also got the infrastructure, that is electricity, water, road to most parts of the country. What needs and what there are lots of studies which say what would take you to the 7 trillion. So manufacturing, there's a clear idea that it should be in the high 20s. So we have to focus on manufacturing. I think that focus is coming about. That focus will have 3 or 4 pillars to it. One is obviously the PLI is a good thing. Second is the supply chain. Third is semi-urban and rural India, where most of the SMEs are, which normally account for 40% of the GDP and 60% of the employment, right? And then you have the new businesses that will come up because we have the infrastructure for public good. So that is one aspect. 2 is the logistical part. We have about 14% of GDP is our logistic cost. It has to come to single digit. Ports, airports, trains, simplifying. When it will happen, we may take a little longer, but it will be there. So this will also happen. Then I think a lot of people have not realized, and I think we should tom it, just like we didn't realize our Brahmastra, which was that missile which went and put Pakistan right, is our focus on non-fossil fuels and alternative sources of energy has actually put us in a damn good position. If you look at, I don't know whether it was 5 billion barrels or what, it doesn't make a difference, 10 years back, it's about 5.75 or 6 billion barrels today. So there's only a 20% increase. So the fossil fuel intensity has already gone down and it'll go down further, in 10 years, whereas the economy has more than doubled. I think, and there are lots, and that I'm sure of, there are lots of projects on which will bring this down further. We've also got, for our energy needs, we've got alternate supplies. So we didn't have Russia. We now have 35%. That's why they can confidently say that price may be an issue, but fundamental availability will not be that much of an issue. And so we've got our sources tied up. LPG, I was very happy to hear that they said if you don't go in for pipe gas, we'll cut off your connection. You can't expect the government to do everything. But in the pipe gas, you can have it locally manufactured. And you can even use biogas. So that's one thing that should be understood clearly, and I'll come to this Middle East thing also. I think we handled the Middle East situation excellently, both diplomatically and as to what should be done. The fact is we didn't start the war, but once it is there, we've done the best we could. Look at the countries around you. I mean, give the government a fair pat on the back when it's due. So that is there, and then let's come to the digital economy. So the infrastructure for public good, I think no other country will be able to create it at our price level. Apple is trying to come in. Where will he come in? UPI 0 में करता है. तो minus करेगा, मेरे को पैसा देगा. So let's recognize where the strengths are with this thing. And I know personally, because I'm looking to investors and I meet a lot of people, a lot of things are going on, whether it's on LLM modules, whether what is going to happen on banks, whether what is going to happen to financial inclusion. Yeah, I was watching TV the other day, and there's this fellow called Khan Academy. Now, he's taken education right to the bottom at a very low price, And he was offered, I don't know how much that he refused. But we can create scale for specific needs rather quickly. And we have the only missing part between conception and execution. That is the 150 million engineers that I talked about. Only other person who has it is China. Yeah, baki to unpad hai. Right? So, when I look at it, India will remain the fastest growing economy. This war is a problem. I'm not trying to say there is no problem to it. But what will happen? The worst case, for a little while, you go to 6.2 GDP. You still, if we go to 6.2, the others will go to 1. Okay? But the second part that you should carefully look at is we had been left out of most trade treaties. Today, we are at the center of every one of them. So the world will change. You have geoeconomics and geopolitics converging. So might is right. There will be lots of teams formed, like the IPL team. So they can all negotiate at the right price. So this is a temporary blip. I mean, God forbid, if you have two madmen on two sides, this could last a little longer. But all indication seems to suggest that it will probably not take more than 2 to 3 weeks. In any case, they are letting our ships through the Hormuz Strait. So what is the problem if you're friends with everybody? And there's a difference between a TV anchor asking you and saying, why didn't you tell Trump to go to hell? Or the opposition saying. The fact is, the fellow sitting on the seat has to balance, and you see India's interest first, and I think they have been looked at.
On that positive note, I think we'll bring the discussion to a close. Thank you, Mr. Puri.
Thank you.
Ladies and gentlemen, big hand for Mr. Aditya Puri.
Thank you very much. Ravi, if I could also request you to present a token of gratitude to Mr. Puri. Sir, if I could request you to remain on stage for just 1 minute. And so we'll be there. Okay. We'll do that. We'll do that, sir. Done. But can we have a huge round of applause one more time for Mr. Aditya Puri? That's got to be the coolest leadership dialogue ever. Thank you so much. Thank you indeed. And with that, ladies and gentlemen, we call it a wrap to another phenomenal edition of the Mint India Investment Summit and Awards 2026, presented by JSA Advocates and Solicitors and powered by SAIL. We'd like to thank our associate partners, Grip Invest, PFRDA, Equitas Capital, Muthoot FinCorp, and M-Profit. Looks like we have raised the bar of the evening, so let's all hit the bar. And let's do that. Let's take the conversations over drinks, dinner, and let's continue doing that for the rest of the evening. Yes, we cordially invite you all to join us right across in the pre-function area. Please do join in for drinks and dinner. And thank you so much for being such a phenomenal audience. Thank you for being part of the 2 days of the fabulous Summit and Awards 2026. We look forward to hosting you in the next edition. This is Kavya signing off. Thank you.